Ready to master the art of capital? Welcome to the CapitalHQ Masterclass and unlock your potential in the world of business and finance.
Providing you with the knowledge and tools you need to excel in today's competitive landscape.
This event is powered by Wholesale Investor and CapitalHQ. Thank you for joining us.
Hi, and welcome to the CapitalHQ Masterclass. My name is Steve Torsa. I'm the founder of CapitalHQ and Wholesale Investor. Today, we are at day 2, and we are going through some of the key aspects which can help you build the strategic value of your business. You know, it's so funny. When you actually look at this space, we get taught so many things. We get taught what is perceived as the idea of pitching. We get taught, the example of how to create a pitch deck. The reality is, all the areas around raising capital and how we build value into our business is so much more nuanced than that. And in fact, what I've learned over my 15-year journey is what I've learned, whether it be through startup media or through a lot of the training that takes place in this space, it's actually doesn't quite give people the information they really need to be successful in their journey. For example, capital raising. Most of us get told that what we need to do is we need to spend all this time preparing an amazing pitch deck, start sending it off to VCs, and then wait for the money to come in. Well, no, this is why we provide the complete capital engagement system. More than that, we want to deep dive you into how you can actually utilize AI software to empower your capital raise properly. Then we want to take you in how you can understand how other companies see value in your business if they're looking to acquire you. Right, so there's going to be some key things we're going to be covering on day 2 of the CapitalHQ Masterclass. Now, for us as a company, this is a big change for us. So we've just rebranded from CRIISP to CapitalHQ, and we want to take you with that journey with us. We are redefining the way in which people think about capital raising. There's 3 parts. There's the software that we provide, there's the investor access as part of what we do with our service, but now it's also the education component. Everything we are thinking about is how we can provide you with the actual insights that can make a difference in your business. So enjoy day 2 of the CapitalHQ Masterclass, our founders stream, and I look forward to seeing you at the end.
Capital raising is not an event. It's a process. Navigating the labyrinth world of capital raising is not just frustrating. It's a time-consuming diversion from your core business, an emotional roller coaster that leaves many founders drained. But what if you could simplify the journey? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs, and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors. At CRIISP CapitalHQ, we turn the daunting marathon of capital raising into a strategic sprint, where your capital raising is working 24/7 for you. Are you ready to run smarter?
All right, welcome guys. It's a pleasure to have you guys on CapitalHQ. The purpose of today's call is really to dive deeper into a report that you guys both put together, the BDO and Focal Venture Fundraising Landscape Q3 2023. So, if Adam, if you'd like to introduce yourself.
Yeah, sure. Hi, my name's Adam, and I'm part of the growth advisory team at BDO. We are specialist earlier stage advisors helping companies raise both debt and equity, post-seed up to early Series B. We're a mix of both advisors and former investors in our team. So we believe that uniquely in the market, we've got a really strong investor lens when we look at opportunities. So the companies we talk to and work with are best prepared to hopefully increase their chances of a successful raise.
Fantastic. Maybe Jack?
Yeah, absolutely. I actually couldn't agree more. On the BDA side, been fantastic partners to both of us, but also a number of companies that have gone through Focal. So I'm one quarter of an organization called Focal. We're essentially a central data exchange for early stage fundraising. So we were formed about 3.5 years ago by two quite senior members of the VC ecosystem that decided the process of raising funding was completely broken and very opaque, very relationship driven, predominantly favored that of the well-networked or very community-led individual and founders. So we started tackling that problem. We have a biennial demo day, which is certainly probably Europe's largest, and we're kind of bridging on now, hopefully, with global expectations and ambitions. We see about 4,500 early stage companies every single year. And we systematically invest into 2 to 3 companies that go through each demo day by SPVs. So we've co-invested with likes of NTVC, Lightspeed, Boulderton, etc., and have facilitated, I think, of last demo day, about 7,500 introductions between both VCs but also founders.
Fantastic. And I think hopefully today we can get rid of some of this opaqueness with this report. And for anyone who's for anyone who's watching, in the description is a link to that report. And the questions that will be asked today and answered, and the discussions will all revolve around that report, as well as expand on it. So I think first things first, maybe one of you can answer this to start with. Considering the trends highlighted in the report, how is the dynamics between investors and startups evolving? And as a follow-up to that, what key strategies should startups adopt to navigate this evolving landscape?
Okay.
If you want to take that one, Adam.
Yeah, that's fine. So I think leaning on what Jack said before, is we also firmly believe that there should be more transparency in the ecosystem, and companies should be able to, if they're well prepared and well researched, to be able to go out to investors with a good proposition and be able to get a meeting. And by that, I think it works both ways, that when founders reach out to VCs, they should get a response with clear reasons why the investor wants to or does not want to take up a meeting. But also founders really need to do their due diligence, that they are going out to relevant VCs. Sometimes when we speak to companies and they say, oh, I've been out to a few investors and I'm not really getting much traction, and we look at a company doing 10K of MRR and they've reached out to investors that clearly say on their website they only invest in businesses that are doing 2 million EBITDA upwards. So they're not going to get a response, because investors will just look at that and say, you haven't researched this properly, you've got no credibility, I'm not going to respond to you. But more widely, I think it's becoming more important for founders to give themselves more credibility by not only knowing their business really well, but also knowing the whole landscape of businesses that they compete against, and how the market that they're operating in has changed. Because not only does that give more credibility to the founders, and especially in early stage, I think it might come later in one of your questions, but it definitely comes through in the report. Founders are the most important thing for early stage investors. So knowing your company and your market really well shows investors why you are the standout pick in your market for them to invest in. Because what you have to realize is very few investors, if any, can have 2 competing assets in the same portfolio. So what you're convincing them of is, this is a really good market and you should invest in it. But also, we are the best asset in that market for you to invest in. And the reason we know that is because our KPIs are better, our management team's stronger, our traction is quicker, etc., etc. So knowledge and being prepared. I think you'll find that me saying being prepared might be a recurring theme throughout.
Fantastic.
Yeah, absolutely. And I couldn't agree more on the investor points. Often VCs, forgive me if any VCs are actually tuning in, but are often quite fickle individuals. So as a startup, it's paramount really to, first impressions matter, because it's kind of what I'm trying to say. And often from an investor outreach point of view, there's only kind of one bullet in a revolver from a chance point of view, from exposure to VCs. So first impressions matter, and they last. So it's kind of pivotal to make sure that you present yourself as a founder in the best possible light, whether that be to take formal advice from an outreach point of view or to structure a financial model if you're a late stage company that reflects the VC's growth expectations. So all those things come into play.
Okay, fantastic. And I guess moving on to the next part of the report in terms of venture landscape and dynamics, investor dynamics. So it's reported that 42% of investors require investments to qualify for VCT or EIS funding. Apart from the tax incentives, why do you think this is, and how does it shape investment strategies? So that's the first part. And how should startups navigate this landscape if perhaps they don't qualify for it, or what steps should they take to make sure they qualify for it?
So I think that the first thing to mention is that the reason that question is in the report is to set the theme for the rest of the report, so people know where the answers or the type of investors that are answering these questions. And I think what you'll find is with EIS and VCT investors, the background really to that is, if you kind of think, without being too stereotypical, UK personalities versus US personalities. UK personalities are more risk averse naturally. The background of a lot of the VC ecosystem in the UK, because it hasn't been going for as long as in the US, is more kind of private equity type mindset with a bit more risk. So those EIS and VCT aids allow the funds to take more risk, and then therefore allow them to say, we can invest in companies that are more loss making for a bit longer than our counterparts in private equity. And that's really helpful for earlier stage companies. And I think it does make it more difficult for companies that don't qualify to raise money in the UK. But I think if you consider why that is, most companies that VCs will want to invest in are high growth, early stage UK based companies. And the reason for that is, despite what we're doing now and having a virtual phone call, VCs do want to know that if something goes wrong, or they need to, they can just get in a car, get on a train and go and speak to the management team in person and try and help them. Because VCs, although people do give them a bad name, do want to be supportive, because ultimately everyone has the same goal, to get a nice return for management and the VCs. So I think what is important is, when you are looking for your first round of investment, or you're coming through to the fifth or sixth year, without going into the details of the EIS and VCT rules, is to really understand and grasp those rules, to know how to keep your company EIS and VCT qualifying, because it does just open a lot more doors and give you a lot more options for funding.
Right. And
yeah, absolutely.
Yeah. Sorry, Jack, did you have something to add?
Yeah, I think just like a takeaway tip, really. There's obviously a thing called EIS Advanced Assurance. So if founders are thinking about going out to raise through the EIS scheme, which, as Adam rightly said, is massively beneficial from a UK investor point of view. And I think having proper legal advice that you can actually rely upon to go out with that assurance is sometimes very advantageous. So we work, or have worked quite closely in the past, with a law firm called Philip Hare, which is a specialist EIS law firm. And so for any founders out there, I think thinking about that sort of strategy, it's important to get proper legal advice. And I think those guys are really good at what they do. Yeah.
Okay, those are some good tips. In regards to, Adam, what you've mentioned in terms of the more risk aversion mindset, have you seen a trend where it's getting more risk averse or less risk averse? And obviously the last 2 years probably has seen more risk averse, but in general, the UK landscape, what's your opinion on that?
So it depends how you look at risk. I think the biggest change in the landscape has been how long investors allow or will tolerate cash consumptiveness in a business. They want to see a pathway to profitability sooner rather than later.
Yeah.
I think if you look at those like Series C, Series D raises, they're the ones that have really fallen off, because most VCs now think that the companies that struggled the most and the bigger companies that were really the big failures through and out of COVID were those ones that were still loss-making, having had hundreds of millions of investment. So I think Series A investors especially are now turning around, and I think we've asked the investors these questions, that where previously Series A investors would say, look, if you're not profitable in 2 years, that's fine, but as long as you start to get profitable within 2 years, we really need to see that. Now it's a lot more like 17, 18 months. We don't want to see heavy loss making throughout. And effectively what that's saying is we want to see a structurally profitable business model, that the longevity of the company isn't just dependent on spending more money on marketing, winning more customers. It's, do you have profitable customers? Are you running a strong company? So that if some other crazy macroeconomic event happens, then it's more savable, that we can keep the company going through that period. The company won't need massive investment to support, the investors won't have to support their portfolio with massive investment just to keep those companies running.
Right. And I think, based on that, on the follow-up of that, either one of you can take this on, but it's noted in the report that most Series A investors expect a company to become profitable within 12 to 24 months post-investment. From an investor's perspective, how realistic is this expectation? And from a founder's perspective, from a startup's perspective, what steps should they take to meet these profitability timelines?
I can say that one, bit of a tongue twister. Yes, obviously now startups are being launched. I think with leaner fundraising environment in mind, obviously DD periods from investors are taking a lot longer, and they're kind of mitigating. Those are now perceived quite risky or riskier investments than previously. Teams, which is obviously a huge proportion of overhead, but other overheads I think are being kept smaller for longer, which means that profitability can be achieved at a quicker rate. I think obviously there's an offset with growth here, with VCs revising down their growth expectations to account for better inverted commas profitability. But there's also great focus on, I think, organic customer acquisition channels, customer retention, and especially from a consumer perspective. So all in all, I think having to be much more strategic about growth and not just targeting everything and everyone, like they were possibly more so anyway, 1, 2, 3 years ago.
Right. And maybe follow up, and this is what impact does a higher focus on profitability maybe have on the rate of innovation then within this UK ecosystem?
I'm not too sure if you want to take that one, Adam.
Yeah, I don't mind. I think that I think it just goes back to what Jack says, that it drives more focus from management teams. If you're not trialing loads of different routes to market, loads of different products at the same time, and you have a focus to say, all right, we're going to launch this, and then we'll launch this module, and then we'll launch this module. But keeping in mind that you're not just going to go out and try and win 10 customers straight away with whatever you've got, and then you've got to maybe rebuild the tech because those 10 customers, it doesn't work for those 10 customers, and you've churned 80% of that. Hopefully, does that answer your question?
Yeah, absolutely. It's and then in the report, the average minimum founder equity stake expected by investors at different funding stages was mentioned. The numbers evade me, but I'm sure you guys know them. How does this expectation influence founder decisions, and especially considering company growth and how much they're supposed to give away?
Yeah, I can take that one. I think it's a dark art, really, and it obviously involves quite a lot of negotiation.
Yeah.
It's about realistically a baseline, finding a happy medium for both of the parties mentioned. I think it's a famous saying, I'm not too sure who said it, but no amount of friendliness can change the fact that every single cap table adds up to 100%. I think if you put yourself in the investor's shoes, I think investors obviously look for founders to be incentivized round on round, right? And that's probably most important for them, beyond obviously their equity stake. So if you're a Series A company with two founders, for instance, collectively owning 30 to 40% of the business, an incoming investor will look for a share option pool as a part of that as well, which is often probably vested across multiple years of the cliff. And vesting periods are crucial to VCs to make sure that founders are sufficiently incentivized. I think founders often forget that equity is an unbelievably expensive form of financing. So maybe we can come on to a bit of like strategies and how to kind of balance and meet demands and supply. But yeah, I think from a strategy point of view, in terms of how to balance that equity retention piece and investor demand, there's now short-term and long-term debt options, which are often hybrid mixed with equity. So venture debt, which is often like an 8 to 12% fixed interest rate, often most popular Series A companies. We see quite often. I think some VCs are very ownership sensitive, some aren't. I think the latter are very common at the very early stage. So, for instance, you have an LP VC driven fund here in London called Cocoa, which is led by an amazing female entrepreneur and investor called Carmen. It's a micro VC, so that's $17 million. She, and these are her words, famously doesn't give a damn about equity stake, really. I think if you consider what pressure she's under from above, LPs, especially the more institutional players, are putting pressure on GPs because often they want to see consistent ownership within their particular funds into companies. I think there's obviously, in that particular case, not often a huge amount you can do to control that as a founder. And it's about finding a situation that works for both parties, like I said. And I think that derives from a level of transparency. So for instance, before signing your term sheet, I think discuss things that are going to be thrown into the equity conversation. So like a share option scheme, for instance, your potential investor, make sure that that's negotiated fairly. I think as a founder as well, make sure that you don't fall victim to the share option shuffle, which is essentially putting the option pool in the pre-money valuation, which is diluting the existing shareholders and yourself as a result of that. And basically just don't undersell yourself. Like the opportunity cost of an incentivized workforce from a share option plan point of view at the expense of diluting shares is one that investors understand, and you should be appropriately positioned for that to really motivate a workforce of yours, really.
Great.
Then the only other thing that I'd add to that is that equity stake point is a really good sense check for founders in terms of their valuation and how much they're raising. Because again, goes back to founder credibility, that if you're going to an investor and saying, I want to raise X at an X valuation, and the investor looks at it and they might say, look, I'm only getting single digit equity here, I'm not even going to carry the conversation. So having a think about that 15 to 25% or whichever stage of investor you're talking to, as to do you think that's a reasonable amount of equity that they will want, not just that I'm willing to give away, that will incentivize them to want to carry on the conversations. And if it isn't, am I looking to raise too much, or is my valuation too high?
Yeah, makes complete sense. And before we move on to the next part of the sector trends and sustainability, I'd like for both of you to maybe give one piece of advice to founders currently raising capital. Just the one biggest piece of advice and perhaps the current climate.
Not too sure if you want to go first, Adam.
Yeah, I don't mind. I think that the fundraising process as it is effectively a full-time job for founders. And the difficulty in that for founders is that they are usually operating in a high-growth business, and they are a central cog to that business continuing to grow. So if they take on another full-time job, the business is very unlikely to grow at the pace that it was growing at, and the wheels might even fall off. So if you end up going into a VC process and the business is growing, and 2 months into discussing an opportunity with the VC, and they might be about to put funds in, and they ask for your most recent figures, they'll look at them and say, wait a second, you're not growing at your 10, 15% MRR, you're growing at 2% MRR. What's going on? And if the founders say, well, it's because I'm doing this fundraising process, the VCs don't care. So it's about really understanding that it is a second full-time job. Advisors, of course, I'm biased, do help to do that. But even if it means bringing in some fractional support, whether it's a fractional CFO, an NED, anything that can help you through that process, and you really have to understand that how time consumptive it is to fans that already have really short bandwidth.
Yeah.
Absolutely. I think echoing what Adam said as well. I mean, if you're not going to go down the third-party routes, I think it makes sense for a lot of companies, especially at the late stage, A and B in particular, where ultimately you have more stuff going on as a founder, quite simply. It's just to stay in the saddle. Like ultimately, the higher quality startups are still getting funded, and there is a supply of capital out there, be it quite a lot of it is dry powder currently. It's a volume game. So ultimately, 90% plus of the replies that you're going to have from VCs, whether you have a conversation with them or not, is going to be a no, unfortunately, just to set the baseline. That they're in the business to say no, that's quite literally their full-time job. But it takes a very relentless individual, one that I wouldn't really ever want to aspire to, just given the massive effects that it has on running your business, but also on your mental health, I would say. But yeah, like I said, it comes down to the higher quality startups are still getting funded. It's just a matter of when and who from.
Yeah, I think one of the biggest tips I've heard in my 2 years with Wholesale Investors, a founder should always be in capital raising mode, as in they should never not be. So even if they've completed their round, they should still have this mindset, because it's a lot easier to keep going than to restart for the next funding round. Keep those contacts, even if you're not raising, go once or twice a week to meet investors and just keep them in the loop. I think that was one of the biggest pieces of advice I heard, and I've reproduced that a couple of times to certain founders, and so some of them have taken that up, and I can see that obviously their first fundraise is always so long, but the ones that keep going, and I've worked with them for the second fundraise now, it seems like it's a lot easier to keep that going. So I think that for me was one of the biggest tips I've taken and given to certain founders.
Yeah, absolutely. Sorry, go ahead on.
Then I was going to say that it is a very good strategy, and I definitely agree that I think that if you are doing that, the numbers that you share with those VCs that you want to do further rounds should be numbers that you believe are definitely achievable. Because if you send out numbers which are shooting for the moon numbers, the VCs will always come back to those numbers. And if for some reason you haven't hit them, it's going to be very difficult for those VCs to turn around and not say, well, you said you were going to be doing X of ARR and you're only doing X. So can you come back to us when you get there? And maybe things have changed. Maybe you just were too aggressive with the numbers you showed them. So it's always good to show the numbers that you think are attractive to them, but also numbers that you can at least meet, but even better, surpass.
Yeah, absolutely. I think instead of, just don't like putting numbers on this, but instead of spending 100% of your time over 3 months doing a capital raise, it's spending 25% every month for 12 months. And that still allows the business to continue thriving. That was a good piece of advice. But look, let's move on to sector trends and sustainability. So obviously the report discusses the heightened focus on sustainability and investments. Obviously, it'd be great for you guys to maybe talk a bit about what sustainability is in this context. And after that, how is this emphasis changing the types of startups that are receiving funding?
I don't mind starting. Yeah. So I think, if we're going to boil it all down to what investors do, investors are looking to invest in businesses that are going to get them at least probably a 3 to 5 times return in the UK. That's like at a Series A stage. And the way they get the return is by the business growing to a point that when it's sold, there is enough of a market that the business will attract a good offer that means that everyone gets the return that they've been aiming for. So if you're looking at the way that the market sentiment has moved, which businesses are going to be those businesses that are worth the most in 3 to 5 years, as well as being growing, strong businesses, is also the businesses that have a social and economic conscience. Yeah. So there are, even if you take away the things that I'm not sitting here and saying, look, you need to have solar panels on your building, et cetera, et cetera, et cetera. But even having like a strong maternity or paternity policy, things like all those social aspects. Do you care about your employees? And it's not even what are you doing today? It's mapping out what are you doing today and where do you want to be?
Yeah.
And what steps are you taking to get there? Because I think that, there's a lot of organizations which are supporting this from like a free point of view. ESG VC is a really strong organization, doing a lot of good content in the space. And all the investors that I've heard, any of their talks or webinars have said, all they want to see is a plan. And they can work with you on the plan. They don't expect you to come in with a fully formed ESG policy. They want to know that you do care, and that it is part of your business, your whole business plan. You haven't just put it in because it's something extra that might help you get investment. It has to be core to what you're doing.
Not just chucking in AI and ESG. just
Exactly.
and just kind of following up on that as well, it's been trickled down from LP, I think, pressures on GPs as well. So there's now a ESG focus really in place from a top level perspective that GPs have to implement within their particular investments. And obviously it's up to the GP to decide how far along to the right they want to go with that particular theme. So that's why you get a huge amount of funding obviously been put into sustainability and climate, like World Fund, for instance, is one of the largest in the world, actually. But certainly Europe, Ada Ventures, obviously most recently raising her latest fund to invest in impact.
Yeah.
So that there is an increasing importance, I think, right from the very top, not just a base level.
Yeah, I think it's for me, it'd be great to understand, whether investors are more looking at companies that have an ESG centric approach or whether they're investing into impact companies, right? So impact companies on perhaps climate tech space, or just what have you guys seen in that space? Is it more so focused on general ESG, or are the focused investors just focused on impact, or is it everyone that's more and more focused on impact?
So I don't mind starting on that. I think it's really important to note that there are obviously like specialist funds that invest in either climate or impact, etc. But the more sector agnostic funds, their fundraising strategy is still to get the level of returns that they need.
Yeah.
And a business that isn't growing at the rate of MRR increase or a annual increase that they need, or doesn't have the right gross profit or any other KPIs that they need to see to make the investment, just because they might be solving the climate crisis doesn't mean that it's an investable company.
Yeah.
So I think that's really important. Just having an ESG friendly business isn't going to get you investment. It needs to go hand in hand.
Yeah, absolutely. I think just onto that as well. I mean, there's a big toss up really in climate tech now in regards to a hardware or software enabled approach really to tackling problems. And there's a school of thought really on one side that says that reaching net zero goals really by the time frame that's just set out from a regulation point of view, it's just not possible without implementing more hardware related solutions. So that's a big topic of contention. I would say really in this particular market as well. So yeah, it's really important to actually visualize and contextualize whether you're physically imparting some benefit really into the environment from what your product does. I mean, if I see another, with all respect, another carbon accounting credit software platform, I think I might exit out of this game as soon as humanly possible. It's very saturated really in particular subsectors such as that particular subsector. So I think having a truly differentiated approach really to tackling what is the world's certainly societies. One of the biggest problems right now is pivotal, but it needs to be truly unique. And a finger point of differentiation in that particular sector is more important than anyone in my personal view.
Yeah, I would agree with you on that one. But in regards to, you spoke about ESG, but from an investor's perspective, you mentioned LPs to GPs down, right? How are investors incorporating ESG into their investment decisions? right? And how should startups adapt their strategy so that they're both incorporating ESG while remaining, let's say, on a growth path that maybe wasn't there prior to the ESG criteria being thought out?
I can say that one first. So just from maybe Adam can follow suit in regards to the lower level. So yeah, I think especially from a more institutional players, so the endowment funds, the European Investment Fund, which is a government institution, they have a mandate really to comply with regulators who the regulator vision is important LPs because they obviously donate and invest the most amount of money. Like for instance, when you're raising a fund, you have to have an ESG policy really in place to be attractive to those particular individuals now. And that is an ESG policy on ultimately how you run your own business. Everything from like the day-to-day operations of exactly how you would run a business equivalent, essentially, but also how to look and view ESG policies within particular businesses. So, for instance, it's very rare that you find VCs investing in gambling propositions, in even if it's vaping, for instance, in smoking-related products, etc. Anything that can be detrimental really to the health of a consumer or a business is really kind of seen in the eyes of a regulator, but also now an institutional investor, a big no-no. Maybe Adam can speak to the lower level of end user in business.
Yeah, I think that a lot of investors, when they're looking at businesses, are looking at kind of like red flag reporting ESG. So I think that if you carry that out on your own business first before going for a raise and thinking about where an investor might have an issue. So for example, if you're going out and saying we're solving the carbon, or let's say you're in a circular economy business and you're recycling something, and that's for the good of the environment, but the machines that you're using are very power consumptive, and you're not using solar power, then an investor is going to turn around and say, well, it's not really net benefit, so it doesn't really help. So that's a big red flag to an investor. An investor's not going to turn around and say, oh yeah, I'll definitely invest in this because it's solving an issue and the business is growing. Because on the other hand, you're taking away from one hand to give with the other hand. So it's just doing that kind of like red flag reporting in your mind. It's the same with your deck, your financials, and everything. It's just an extra thing that you now need to think about that is core to raising funds.
Yeah. And I think, following on this, there's obviously the report suggests a shift in sector preferences among investors. How do you think this will impact perhaps innovation in less popular sectors, such as I think in the report, the telecommunications is very low in terms of funds deployed into, right? So what type of impact will that have on less popular sectors?
I can take this one first. I think we're actually quite keen on, dare I say, like the unsexy, overlooked industries that are typically very underfunded from a VC point of view. So the supply of capital is just not there and has not been there historically, and they're very much an untapped resource. So like prime example of this is maybe like shipping or logistics, where there's only been a couple or three unicorns, opposed to the likes of fintech, where there's been a huge amount more. So I would say I think building a business in a very unsexy sector is actually quite a sexy thing right now, dare I say it. And there are specialist VCs that really can resonate that more well with you, essentially. And it's just about finding and doing your research, or basically speaking to a third party, such as BDO, which can help you map out an investor outreach strategy in order to make that happen. Ultimately, it's about finding, especially to benefit your own valuation and terms that you land on. It's about finding multiple horses in the race, but meeting them all at the same point in terms of the finish line. So creating fear of missing out on your round is another topic that we might come on to, but it's pivotal really in that regard.
Yeah, and I think just to add to that, it's just what's hot today might not be hot tomorrow. So just to echo what Jack said, if you are doing something which really solves a problem and you've got customers that are buying it, investors will invest. It doesn't, obviously you have to be using the best technology that's available to you and doing the best R&D that you can do. But if you think about 2 years ago, when all anyone ever wanted to invest in was Web3 and crypto, those companies find it difficult to raise now because investors are just like, well, that didn't work. I'm not investing in that anymore. Even if you've got a really good company, if you've used that technology at your core and without it, your business doesn't work, you're kind of a bit stuck. So really growing something which solves the problem that you need to solve, as long as the TAM, or the total addressable market of that market, is big enough and you are solving that problem, as Jack said, you'll get investors to invest.
Great. Now let's move on to economic climate and global trends. So how is the current economic climate influencing investor risk appetites as per the report? And in what ways can startups adapt their pitches to appeal to these changing risk profiles? I know we touched upon it earlier a bit, but we could go a bit more detail. That'd be great.
I'm not too sure if we want to cut this one out. I think Adam said it was a bit too vague. I probably might agree to be honest. I think we might put it in a bit of detail prior to that.
I think that if you just want to ask about, I think it was the second question on inflation and currency, because then we can just talk about valuation and then.
Cool. Just making a note to remove that. Cool. So moving on. How do you guys foresee the impact of global economic trends such as inflation and currency fluctuations or venture capital investment decisions? And to add to that, what measures should startups take to mitigate these macroeconomic risks?
So the main thing that we've seen through inflation is valuation, and there's lots of charts and graphs that people and data that people have brought out to explain that as interest rates go up, valuations go down because the LPs have other places to put their money. And so the risk appetite of investors mean that they're not going to do your 20, 30 times revenue multiples. And if you think about, does anyone on this call or anyone really expect interest rates to go back down to 0%? Probably not. So those founders that are sitting there and saying, I'm going to wait till valuations come back, it's just not worth waiting for. If you need the money to grow your business, you go out and try and get the best valuation you can get now, because there's more chance your business will grow with funding than without funding. And if you have to give away a bit more of your business to make that happen, then it's worth it. So I think that the biggest change is how it's affected valuations.
I think even late stage business as well. I think I mentioned this before, but shorter term lending options, which can obviously help with an equity sensitivity point of view. If you don't want to give too much of your business away at what you would see as an unfair valuation to, I think the likes of a few players in the space of CapChase, Uncapped, etc. They essentially give a very attractive, I would say, product, and it's obviously no personal guarantees, etc. So it doesn't have the scary headline views as previous loans available to early stage companies do. Yeah. But it's obviously it's at the cost of obviously not growing your business as fast as you would with, a fully fledged VC round, which would obviously have a lot more capital available to that particular business.
Of course. There's positives and negatives in every different avenues anyway. So that makes sense. Look, in terms of moving ahead, we'll look at technology, innovation, and future trends. So considering the rapid evolution of the venture landscape, how might the role of traditional VC change in the next 5 years? Obviously, we've seen a lot more funds appear and emerge in the last 5 years. Is this a trend that we're going to continue seeing, or what are you guys seeing?
Yeah, I can take this one. So like I said, I think there's a whole lot more of optionality available really to founders than there used to be historically. Like I said, obviously the short-term debt options being one of them, which has played a pivotal part really in Series A and B companies' growth, at least somewhat. And there are a number of different kind of propositions really out there. I think obviously within this particular, dare I say, downturn of the markets, anything that can mitigate the investors' risk from an instrument point of view, especially, is quite attractive to them. So it's not necessarily an emerging fund model, but it's been around for a while and very much used a lot, especially the earlier stage companies now, is an ASA or a safe equivalent really in the US. they're being really used to accelerate processes and to get around to get around the way of an early stage. Often those, should we say, like risk profiles are rewarded with a discount rate. So we see a lot of ASAs which give essentially the investor the right to invest at a valuation set at a later point in time, but with a cap on it. We see a lot of those models emerging and are very, very popular, I would say. I think it's always going to be quite a opaque industry, and fully enough, it's not very well innovated industry, to be quite honest, from a funding perspective.
Yeah.
VCs like what they know, and often that's unfortunately to the detriment of founders.
Yeah, but maybe just to keep on that, if possible, how do you maybe see the role of perhaps AI and blockchain coming to, I don't know if this is a word, but de-opaque this industry, right? Yeah,
absolutely. I think it's VC's been a pretty pivotal amount of change, really, with the impact of especially data analytics and AI. It's changed the landscape a lot from a sourcing perspective, especially a huge amount of resources and money is being spent on sourcing. Currently, I think from a top-down perspective, those methods are very, very advanced. So like big thought leaders in this space are like perhaps Andre from Early Bird. I know episode 1 did a huge amount of this as well. And they often play and pick on a characteristic which is most important to them. So Adam rightly said that the only way to de-risk an investment the earlier stage is belief in the founder, and obviously belief in the founder derives from perhaps previous experiences. Maybe if you're a behavioral investor, maybe it's from the childhood, etc., that they've been raised from. But from a data point of view, it's often where they've worked in the past and at what position, with what level of autonomy, essentially, at the end of the day. And that's given way to models that can source extremely promising talent. So for instance, Mistral AI is a big kind of AI company on everyone's lips at the moment. They raised, I think, $120 million, a ridiculously expensive $270 million valuation. And those 4 individuals were previous engineers and product directors at Google. I think, it's pivotally changed. I think the way VC source companies, first and foremost.
Cool. And you talked about how investors put a lot of emphasis on the team, right, on the management team. Are you seeing more of a shift towards the management team in terms of as an investment criteria, or has it always been this way? Is it growing? Is it decreasing? Especially maybe let's consider this current crisis, economic crisis, and the climate we're in.
I could say this one will lead anyway, and I can maybe follow. I think it's just massively dependent on stage, right? I think shift has always been, the focus has always been on management teams at pre-seed and seed, because ultimately there's not a huge amount of data that a VC can base their decision off, an investment decision off. So I think that always has been, always will be the case. I think obviously when you're breaching growth rounds, Series A, B, and C, it's a different story. Obviously the people leading the business is still first and paramount, the most important factor to consider, but a huge element of traction comes into Series A investors' investment decisions to growth profile the business. And obviously like should we say market potential, like Adam said, some businesses are just not suited to a venture backable proposition, and often the size is just not there. I think from a team perspective, like I referred to before, it's mostly about the drive, grit, determination, relentlessness of those individuals, about their ability to resonate well with VCs, because ultimately it increases their chances of raising further down the line, and obviously increases the chance of return from a VC perspective. But yeah, I think every single VC approaches the conversation, at least focused on the founders, that they're only put on that earth or this earth to do one thing, and that's essentially to build that business in its entirety.
I think I'll just add that oddly, the importance of the the management team has maybe slightly decreased because the importance of the business model has increased. So whilst it is still probably the key factor in why earlier stage investors invest, there is at least one very famous example, which I'm not going to mention for fear of getting into trouble, of a business that raised money just off the back of a serial founder. And that was pre-COVID. And I don't think that business would have become a unicorn as quickly as it did had it started raising now. Because I think that business model would have been scrutinized a bit more. And if you look at that business model now, it didn't when it first got invested in, the most appealing investment KPIs. So I think that whilst it is extremely important, it has always been extremely important, that scale of the importance of your business model versus the importance of the founder has tipped slightly towards a business model. But as Jack says, without a strong management team that investors wants to back and believe in, you're not going to get investment.
Right. So look, perhaps if you guys have a piece of advice for early stage founders who might not have the right background or the right experience that maybe certain investors are looking for, but have a great product and believe in themselves, what should they do to make sure that they are kind of on the same level as other experienced founders, maybe repeat founders? What actions should they take?
I'm more than happy to say this one. So I'm reading a book at the moment, which actually dispels the myth that most the most successful founders really come from repeat backgrounds. So I think VCs have the predetermined idea that a good deal can come from anywhere, essentially. So they don't necessarily have to be a repeat founder or a Harvard PhD or an Oxbridge candidate to really gain investment. I think to make themselves more appealing is to put themselves on the same playing field as those. So there's a number of initiatives out there, including Focal, obviously, that can help surface those individuals. And our alumni have gone on to raise a huge amount of money, which haven't come from a traditional, should we say, VC investable background. And there are a lot of funds out there, including ADA, for instance, which is an inclusive venture capital fund that invests in people not with the run-of-the-mill background, investment banking, founded a startup when they were 15 and funded it, etc. So I think putting yourself on the same level for initiatives and doing your research into funds to really understand actually what they want and what they look for, I think is pivotal. Not too sure Adam can add to anything on that front.
No, I just think that I wouldn't worry about not having a traditional investable background, because if you do have a business and you've proven that it's growing and you've proven that the actual business is investable, it's about having confidence in yourself that there is a reason that business has got there, and whether it's you or your co-founder, you are doing something right which makes you investable. And I think sitting there before you go out for a raise and thinking, where are the gaps in my management team? Yeah. Do we have a gap from a financial point of view? Should we consider bringing in a fractional CFO before we do the raise, rather than getting to the raise and investor saying, yeah, I like it, but your finance function is not investable? Yeah. Are there things you can fix before going for a raise?
Yeah, absolutely. And there's actually nothing wrong with that, showing a bit of humility, but there really isn't, spotting the gaps in your team that you're not particularly good at. But there's absolutely no shame from an investor point of view in showing that. There just needs to be a level of transparency. And often an investor will be able to separate that of what you do know with that of what you need support on. And obviously that of what you do know and are very good at, you should make your superpower really in investor conversations to make it play to your strengths.
Yeah. I think if an investor can see that humility and that they can work with you to plug those gaps, they're automatically getting a value increase as soon as they invest, which is of massive benefit to them, but also to you as founders.
Great. Look, in terms of timing, we have time for a couple more questions. I think I'll merge a couple of them. Let's take on this technology side. So what role do you see technology playing in streamlining the VC funding process, right? Because based on the report, I think it's like 34% of investments take about 5 or 6 meetings, if some more, some less, right? That's that. And how do you think the increasing use of data analytics and AI and VC will change the way investments are sourced and evaluated? So if we break that down, the evaluation, the sourcing, the evaluation, and then the due diligence, how do you think technology comes into that and streamlines that whole process?
Just from a GP perspective or from a founder perspective, sorry?
From a GP perspective.
Okay, cool. Adam, do you want to go first, or yeah, me too?
Yeah, I think that there'll always be in VC a need for a number of meetings because the investor is backing the founders, they're backing the management team. So that's always going to be important. And the investor, to get comfortable with that, will want to ask questions on areas that they're not happy with. And they'll always have to prepare their investment committee report, their IC paper, and that will need to be thorough enough that gains the IC's backing to make the investment. So I don't think that's going away. I think where things could be made more efficient is maybe a bit through due diligence, in like things like data room compilation tools, all these things, which just means that you can be more prepared a bit faster. Do I think that there's going to be versions of AI which can help you put a deck together within the next 5-6 years? I would be surprised if there isn't. If you could take my team's knowledge and build that into an AI platform so that by the time we're reviewing a deck, 80% of it's already done.
Yeah,
I think that's eminently possible. I'm not a techie, and it's like what I say to most CTOs when I say, "Oh, you surely you can just fix this? It'll be a quick fix." And you can see the look on their face going, "Yeah, it's not going to be that quick." But do I think that those things are eminently possible? Yes. Do I think that you'll eventually be able to feed some assumptions in your management accounts into an AI model, and it will come out with a financial model that's almost fit to go to VCs? Probably, yeah. I think all those things are eminently possible, and it will save time in preparation. But that human contact with VCs is always going to remain important. So the number of meetings, I don't think that will change, but the ability to get the data out and to respond to VCs' questions should be able to be sped up.
Yeah, absolutely. I think from a founder perspective, there's a multitude of tools really out there. I mean, we've mentioned Focal. Sorry, it's a bit of a shameless plug, but obviously we're a tech-enabled platform that can help on the sourcing investors side, but also from a VC point of view, sourcing founders side. We're not probably the first to do it, and probably definitely won't be the last. So there's definitely other platforms that founders and also VCs can use to source. From a tracking point of view, I think if you're not going through a third party like Adam, CRM from a founder point of view, from a tech angle is pivotal important to make sure that you circle round on conversations, to make sure that you are massively on it in terms of chasing, in terms of getting materials back over to the particular VC that they've requested. I think from a funding perspective is particularly an interesting space as well. There's now availability of platforms that can structure investments extremely easily. So we use Odin, which has been around for maybe 3.5, 4 years, who essentially from a VC point of view can help structure syndications, and can even now help structure a fund if you're raising a fund as an emerging GP. That can also help a founder. They can basically just go online, enter a few details from a company legal point of view, upload their certificate of incorporation, and start a fundraise where they can distribute a link where people can commit, transfer funds, etc. So that kind of closing part is very much streamlined, I think, already with the help of those individuals. Seed legals have obviously been around for an extremely long time, which can help with the documentation front to save you going for a fully fledged law firm, even though perhaps probably in part, especially if you want to get the best possible deal, is probably advisable to at least use a mix of both. I think I mentioned this before, but VCs are quite fickle human beings, so never underestimate the power of really having or putting your best front forward. So there's now pitch deck software which founders can use to help that story really resonates well, that uses AI. I think Canva, for instance, even has an AI tool. We see a lot of decks through that particular platform.
Yeah.
And then the kind of sourcing and AI and data analytics side, I think we might have mentioned that before, in terms of how VC funds are really honing down on what is critically important to them. And most of the time that is either about talent at the earlier stage or data availability at late stage. And what I mean by that is Series A and B funds are basically just pulling data in from public sources such as Companies House, for instance, which will fit their particular thesis. So I've completed a funding round before. Their credit rating has changed. The number of shareholders has increased. So yeah, those large language models in particular, particularly clever, I think now, are really servicing great companies, and VCs are putting a huge amount of money into investing in those.
Yeah. And I think, one of the things I've done recently is specifically for B2B SaaS, because that's a lot of the companies we see at Wholesale Investor. What I did is, the new Chat GPT module where you can create your own GPT. I uploaded the best B2B SaaS pitch decks based on different VCs, and I've added the top VCs, their investment criteria into B2B SaaS into it. And just to test it, I uploaded our own Wholesale Investors, because we're B2B SaaS, into it. I'm like, can you help with the pitch deck based on all of these criterias? And it spurned something out, which was great. It was fantastic.
I know that Prezi does that as well. It's really impressive.
So you do that with, if you're a fintech company, maybe that's an easy, not an easy trick, but it's something that could take you somewhere a bit elevated in terms of the VC, in terms of the pitch deck game. Is probably just make your own GPT with the best decks in your industry and then just go from there.
Absolutely. I think Adam's right there. There's always going to be a human element which is needed, both
of course
on the VC sourcing side, but also the founder outreach side. I don't really think that'll ever be fully automated. Yeah,
I think it comes back to the original point, like the point we were making earlier, that the team, especially in early stage, is still the most crucial, right? So I don't think you can remove those face-to-face meetings or just those meetings in general. Look, we have maybe time for one more question. In your opinion, both of you, what is the most underappreciated sector in the VC space currently, and why? And we'll do one more question at the end, which is, or maybe you can incorporate them. What's the one piece of advice, the biggest piece of advice, I know we went on one earlier, but that you would give to founders thinking of starting to raise now?
Do you want to go first, Adam?
I'll take the second bit. Sorry.
No worries.
Yeah, I don't mind combining them. So the first bit is that I mentioned it before, is if you look at the report and you look at the companies that are raising, you look at, people will say ESG, people will say fintech, people will say climate tech. But as Jack said previously, it's not what's hot now. So if you feel like you've got a solution to a problem, and you can build a commercially viable business to tackle that problem and gain investment, then go and do it. If the market's big enough, you're strong enough founders, and there's a problem with a solution, go for it. Don't worry about what's hot now. I think there's two angles, which is, I think, why we have worked closely with Focal, that is just really important for founders to know, and is, one, be prepared as you can, because first impressions count. So if your deck is as tight as it can be, you know your numbers as well as you can, and the model is as tight as it can be, then that's really important. And going out to the right investors with the right message is really important. And getting those warm introductions, as much as we want to democratize and remove and increase the transparency as much as possible, there'll always be that element that VCs see so many opportunities that when they see a friendly name in their inbox, they might be more likely to answer that email. But that doesn't stop you from growing from someone who doesn't have that black book to going out and building their network. A lot of people say, go out, be confident, start writing on LinkedIn, build your network that way. ask people how you can help them, and then they'll want to help you. So, for example, like with what Jack's doing with Focal, what the whole Focal team are doing by saying to investors, we're going to bring you deal flow. Investors are coming and saying, well, we'll be more transparent then. If you're giving something to us, we'll give something to you. So it's just about being helpful. I think the whole early stage funding ecosystem is all about helping each other. And you'll find that if you help people, then people will help you. It is, as much as people might give it a bad name from that point of view, I think that it is a very helpful environment.
I wouldn't really have anything else to add there, to be honest. No, it's so good. I think we kind of addressed the question in terms of the appreciation of sectors as well prior to that too.
All right, fantastic. Well, thank you both for your time today. For everyone watching this, again, in this description is a link to the report, and we'll also be including some other information, which you'll be able to find in the description. But thank you both. Thank you, Adam. Thank you, Jack. It's been a pleasure.
Awesome. Thanks for having us.
What if you could simplify your capital raising? CRIISP Capital HQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Well, look, thank you so much for taking your time today. From my masterclass session, I've really been focused on a little bit on the blockchain 101 side. And the idea here is to really focusing a little bit on the really kind of basic fundamental on why people are interested in this new buzzword called blockchain, how that relates to cryptocurrency, which is probably more commonly known. Things like Bitcoins, NFTs, these buzzwords, the FTX and so forth. So it's really to guide the viewers from the kind of the most basic fundamental technology to some of the key events that happen, and ultimately to what was some of the best practices to invest into this ecosystem. So as a very quick agenda for the call, you'll see that we'll focus on 6 different modules, starting with introduction to blockchain, followed by some of the use cases, the market size, regulations, digital asset custody and why that's relevant to all the above, as well as a little bit more about Hex Trust. So where do we begin, right? I mean, we heard this term Web3 quite often, but what exactly does it mean? So if you look at kind of the evolution of web, World Wide Web in general, starting with the Web 1, which obviously it was just web at that point in time, you really can think about the late 90s. You have the eBays and so forth, and it's really beginning of the digital era with a kind of one-way interaction, right? What does that mean? It means that you go to the website and you kind of consume the content, right? And so that moved to the whole Web 2 space, which really can be defined by really the 2000s on kind of some of the more well-known applications like Facebook, Instagram, Google, and so forth. And that really, it means that you start to interact with the website. Okay, so there's social media is probably one of the biggest example of Web 2. You have the web and mobile games. You'll have the kind of the various application process. And I think the main difference here is that imagine Facebook and social media. You're really kind of, providing your data, but that data is being monetized and really consumed by the companies such as the ones I listed here, where the user, we as the owner of the data really cannot do anything about that. And that kind of moves to Web3 today. Really, what that means is you, as the individual that have the data about yourself with the birthdays and so forth, locations, you own the data, and you have the opportunity to actually monetize from such data. And that leads to kind of some of the other concepts, such as the metaverse, in which you can potentially own your own digital property rights, decentralized finance, in which case there's potentially no intermediaries, becomes a peer-to-peer approach. The whole purpose here is that you own the data, since it's your own data. So then, what is a blockchain? Okay, well, blockchain is it's kind of a highest term. It's simply a ledger. Okay, think about your accounting ledger. Think about your bank account. It's credit and debit, and what the blockchain is basically a giant ledger that's on a public, transparent location somewhere in the cloud, and that it records transactions, and that each ledger is made out of blocks, and each blocks are being recorded, and a next one will be created. And if you think about this process in forever, this becomes a blockchain. Okay, and the purpose of this is that chains are irreversible, it's immutable, and that each block kind of strengthens verification of the previous block. It's meant to be decentralized because no individual group has control of this whole blockchain thing. And then at the end of the day, it's transparent. Every single one of us, if we just go Google and click on one of the blockchain explorer, you will be able to see every single block since the very genesis, which means the very first block. So the whole idea is that it's about transparency. And kind of some of the purpose of that is, it's a ledger, yes, but it's also pseudonymous, right? It doesn't record your name, your ID number, and so forth. Anyone really with a wallet can access this blockchain. And the data is meant to be immutable, right? Again, you cannot change the past. It's quite safe in the sense that it's nearly impossible to hack a large blockchain such as Bitcoin. It's very easy to access, really, if you just need to have a wallet address, which I'm sure I'll talk a little bit more about at a later slide. Anyone can have an easy and then free access to the blockchain, which again is kind of the main purpose of this technology. So you can't talk about the blockchain and without mention a little bit about Bitcoin, the one that we keep hearing about. Well, Bitcoin really published in 2008 by somebody by the name of Satoshi Nakamoto, created a pseudonymous creator of the Bitcoin white paper, and it's really talking about the peer-to-peer electronic cash system, right? The whole idea is that if Alice wants to send a message to Bob, they can do it over the blockchain, peer-to-peer. And actually, Bitcoin just celebrated its 15th year anniversary, and the whole rhetoric about this particular asset as an institutional asset class is growing stronger by the day. Again, I'll highlight a little bit more about this in the later slides. Use cases. Okay, so we on chapter 1 we highlight a little bit on technology, on the fundamental technology that is known as blockchain. Cryptocurrency is really just one application of blockchain. Okay, so what exactly are they? So the goal is trying to decentralize financial instruments. A lot of times you hear, this concept on storage of value. They try to, the digital gold, or this concept of, stable coin, tokenized assets and so forth. The whole idea here is that basically, cryptocurrency is a type of digital asset that really is intended to serve the same purpose as some of the traditional, US dollar, other type of fiat currencies, while being secured by the cryptographic technology underpinned by blockchain. So a stable coin would be an expression of a cryptocurrency. So what is that? It basically is a way for people and users to hold the value of a certain token, given that we know that sometimes the volatility of other cryptocurrency could be quite high. So the whole point of stablecoin is that it's stable and it's generally pegged to a currency, and most widely known be used with US dollar. So the whole idea of the stablecoin is that it's intended to be around, traded at $1 US at all time. And so in order to do that, there's various ways to do it. you had to peg to, in this case, US dollar. Obviously, it needs to be backed by real world assets. In this case, US dollar in a bank account somewhere. It's relatively low risk, easier to access. And the whole idea is that it's completely transparent. Again, thinking about the previous example on blockchain assets, it's transparent, it's easy to transfer. Generally speaking, depending on blockchain, it probably costs a fraction of some of the remittances players that would charge in the real world. And the whole idea is that you can now use something that's stable and use that as a funding currency to say other currencies like Bitcoin, maybe NFTs, and et cetera, et cetera. So speaking of NFTs, what is that? I mean, it was probably one of the biggest buzzwords last summer. NFT stands for non-fungible tokens. Okay. Whereas in the previous example, the stablecoin, Bitcoin, is actually an expression of fungible. So what is the difference between fungible and non-fungible? So think about this dollar bill that you have in your wallet or whichever currency that you have, right? If you owe somebody that $1 bill, you can give that to anybody and it's considered $1. For a non-fungible tokens, right? Think about this example, but whereas on this dollar bill, you put a signature on it and date it, right? That becomes unique. Probably the only dollar bill in the world where your signature and your date, is on this specific part of the dollar bill, right? It's one and only in the entire world. In which case, then, let's say that if you were to lend it to somebody else and you want it back, you can only obviously take that one unique asset back, right? So the whole idea is that it's unique. Another way to look at this is think about artwork, right? There's only one Mona Lisa, the one and only, the real one. And so the idea is that, it's not fungible in the sense that it's purely authentic, it's unique, it's also transferable. And again, it can be, you trade on the blockchain in a very transparent manner. And there are, various use cases of NFTs, real world ownerships, digital art, gaming, music are just some examples. Tokenization. What does that mean? It really means make anything digital. So you're tokenizing something. So the two things the example I mentioned earlier, stablecoin and NFTs are really also the expression of tokenization. In the first stablecoin, you're literally you're tokenizing US dollar, right? Then that becomes a token called a stablecoin that represents dollar for dollar of the underlying assets. In a case of a piece of art, you're tokenizing this Mona Lisa, right? You're making Mona Lisa become a token, and that token represents the unique artwork that is this actual painting, and that token can now be freely traded and transferred on the blockchain. So the sky's the limit here. The whole idea is that it eliminates traditional barrier, such as going through the underwriting process, the various service providers, and ultimately increase liquidity and ready access to this particular token. Okay. Chapter 3, market size. Okay. The reality is, the current market size, and you'll see on the top right hand side of the screen, you'll see it says US dollar 1.34. I mean, this number changes quite often. Right? At the peak of the crypto market cap, you're looking at about $3 trillion. During the bear market that we observed, over the past year and a half, it dipped to below 1. But given kind of recent market rally as of today, we're about 1.5, right? But crypto market is really just a small representation of this overall market size. Okay. What we're very interested in is not just about cryptocurrency, which again is just one application. Is think about tokenizing traditional assets, right? So if you think about the traditional world as measured by stocks and bonds and FX and commodities, we're now talking about hundreds of trillions in potential market size that could be digitized, right? So the idea is that, okay, well, there's a lot of different projections. This one says, US dollar 10 trillion by 2030. The reality is, if you look at, standard VC kind of type of graph, it's very upward to the right and it goes straight up, right? Representing that the growth potential in this space is very immense. Okay. So what are some of the opportunities? And these are just really just a couple headlines as of late, is the whole rhetoric on institutional adoption, Okay. We know that there's been, negative connotation with, say Bitcoin or cryptocurrencies and relating to various nefarious activities and so forth, right? So there's really the educational process that we think that, it's important to share, right? That yes, an instrument could have good use cases, but used wrongly, it could obviously have, bad use cases as well. But I think for the purpose here is that, again, with Bitcoin as the kind of the barometer, entering 15 years in the industry, look at some of the headlines. Coinbase enters Singapore in partnership with Standard Chartered, Deutsche Bank to hold crypto for institutional clients, BlackRock, filing for their crypto Bitcoin ETF. A sovereign like El Salvador adopts Bitcoin's currency. I mean, these are kind of household names from, the corporate world as well as, on the government sovereign side of things. And I think the whole purpose here is that we are entering a phase where institutions, enterprises are becoming more and more familiar and more comfortable with this new technology. And there's a reason for that. And we'll certainly get into some of that later. Regulations. Okay. So speaking about institutional adoptions, you cannot talk about the work of regulations because at the end of the day, some of the most traditional, Fortune 500 companies, asset managers, one of their biggest concern is obviously to make sure that the product is safe and secure for their investors, right? And so without kind of proper guardrails, and that's when you kind of have seen some of the negative publicities with misuses and various things that you might read on paper. So where exactly are we with respect to a global regulatory landscape with respect to crypto assets? Right. So looking at the screen on the right hand side, right, it's a high level kind of overview on where things are with respect to crypto assets. Now there are kind of differences in terms of the regulatory kind of attitude. So for example, you have all the way with, say, for example, China that bans cryptocurrency. They're very pro blockchain technologies, but they outright banned cryptocurrency a few years back, right? That's on one side of the equation. On the other side of the equation, you have, say, Hong Kong, for example, really starting to fostering cryptocurrency as an asset class. In fact, providing the issuance framework such that potentially retail investors can actually trade on regulated exchanges that are obviously going through the gauntlet of being licensed in order to provide this service. Singapore's payment services act has been around since 2021. One of the earlier kind of countries and governments to really foster blockchain technology and some of the use cases that it might bring to the real world. Dubai, for example, under the newly established regulatory authority called VARA for short, has been very friendly with respect to attracting Web3 enterprises to the Middle East. In Europe, one of the there's a markets and crypto asset regulation called MiCA that really went into effect this year and will go through various levels of enforcements in the coming years. This is an EU-wide framework, right? So now literally the single largest block of economy will have a uniform rules around dedicated crypto asset regulation, right? Again, all signs that points to a more regulated and more transparent industry with more guardrails to protect investors. This is part of the reason why institutionals are coming into this ecosystem. Okay, so I want to share a little bit about as a very quick study, right? Because I'm sure we hear about FTX quite a bit, Sam Bankman-Fried, and so forth. So what kind of happened, right? Just keep in mind that FTX itself, for those who may not be aware, FTX is a crypto exchange. In fact, it was formerly the second largest crypto exchange by volume at a point in time. In a matter of 7 days, after a kind of a known a leaked balance sheet on a popular crypto-focused media, essentially in 7 days, this darling basically collapsed into bankruptcy. And this cryptocurrency actually, again, was at the previous valuation was valued at $28 billion with some of the most notable investors on the planet, Okay, so kind of what happened? Well, I'll start with one of the quote from John Ray III, who is actually the new FTX CEO, kind of overseeing the bankruptcy process. And I quote, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here," unquote. Just a very quick background on John Ray is that he actually oversaw the Enron bankruptcy. At that point in time, the largest bankruptcy in US history at that point in time. Okay, so he knows a little bit about poor governance. And I think this quote kind of sums it up, right? It's really the mismanagement of funds. There's a lack of regulatory oversight. There's a lack of liquidity and kind of over concentration of control beyond many, many things. So the idea here is that, you know, the FTX issue to me is really not a crypto issue, right? Because this is really talking about lack of control. And I actually do believe that, you know, with regulations providing a little bit more oversights and more kind of control and more guardrail for entities operating in this space, this then builds trust for the industry players and therefore will be able to enable more and more new entrants into this space. So chapter 5, I want to talk a little bit about digital asset custody and why that matters and relevant to all the previous discussions. Right? Recall that, you know, in the earlier stages, you know, blockchain, or, you know, we'll use just Bitcoin as an example. How do you access it? We mentioned that it's free. We mentioned that it's easy to access. Okay, because like the question is, okay, well, now that I won't have access to Bitcoin, we know that you can not touch Bitcoin. So, well, where do you put your Bitcoin? Right? You can't put it in your bank account. It doesn't work that way, right? Because the technology is fundamentally different. So there's really 3 main ways to put your digital asset, or really to keep it at a more precise matter, right? The very first way is what we call self-custody. It means that you are responsible for safekeeping your private keys. And I'll talk about the concept of private key shortly. But it means that you, as an individual or an investor, you're responsible for safekeeping of your own digital assets. You can think about this analogy as kind of like keeping your cash, you know, physical cash under your pillow. Okay. The second part is, you know, there are kind of intermediaries. Exchanges is just one example. Like, for example, think about exchanges where you want to buy and sell certain assets, right? So the idea here is that, okay, well, I'm going to put my Bitcoin on these, you know, intermediaries. So then it helps me ready to buy and sell, provide liquidity to my investment, right? So that's another way. Basically, you're leaving the private key ownership to these intermediaries. Okay. Thirdly is, you know, you have a licensed custodians, right? So recall that in the traditional world, you have some, you know, the custodian bank will be the likes of BNY Mellon, State Street, JP Morgan, Northern Trust, etc. The purpose of this custodians, like Tech Trust, is that typically, generally speaking, they are regulated. And at a high level, they are legally liable for any lost assets under certain, eligible conditions. And the whole point about being licensed is that, you know, they are complying with, you know, various jurisdictions, regulatory frameworks, such that, you know, the end consumer are more confident that these type of players are, you know, playing by the rules. Okay, so generally speaking, you know, there are different ways to these are the 3 main ways. Okay. And so custody, right, was really one of the biggest reasons, in my opinion, that, you know, that's leading to kind of institutional adoption and more new entrants into this space. Okay, so let's talk a little bit about the history about custody in general. Okay, custody 1.0 is really, okay, well, private keys, you know, we have this, you know, password that I need to have in order to have access to you know, my wallet that holds, you know, my Bitcoin. Fantastic. What I'm going to do is I'm just literally going to print it out on a piece of paper, and I'm literally, so that's my password, print out a piece of paper, and I might put that in a safe. And if I need to access my wallet, I open my safe, I take a look at this piece of paper, I type in the actual, you know, the hexadecimals that's on my piece of paper, and now I have access to my wallet. Okay. Very rudimentary, right? That's what we call paper wallets. And needless to say, it's probably not safe, right? If you think about the immutable nature of blockchain, it means that, God forbid, you lose, you totally forgot, you lost a piece of paper, you forgot about it. You will not get your assets back. There is no fail-safe in the blockchain land, which is, one of the main features of blockchain. Okay. So we know that's probably not scalable, right? We know that some of the biggest asset managers, the big investment bank, the asset managers, they're probably not going to, invest billions of dollars into the space, especially client assets, into something that is probably quite vulnerable. Okay, so then we move to custody 2.0 era, which is the institutional grade framework. Okay, so this is really kind of the time when tech trust really came about back in 2018. Is that okay? Well, we're going to do things the right way. We're going to offer a fully licensed digital asset custody solution, tailoring to institutions and some of the largest players in the industry, so that when they do believe in the idea of cryptocurrencies, NFTs, and all things digital assets and so forth, that they know that their digital asset is safe. They don't have to worry about losing their assets. They don't have to worry about this thing called private key, because they know that there is control in place that offers segregation of duty and so forth, so then they can deposit, they keep, and withdraw the digital assets. Right? That's really the three main things on custody 2.0. And this is quite important because this whole technology, just like blockchain, is completely greenfield. Okay, there's no kind of existing legacy infrastructure that can do this, right? So this entire industry is brand new. That means that we build everything from scratch to make sure that there is a known solution, knowing that believing the longevity of this asset class. So again, everything is building from specialized technology, leveraging best practices that we learn from the traditional world. Now we're actually entering the whole era of custody 3.0, right? So to me, this is the era that we're in this 3.0 landscape. What does that mean? Well, the whole purpose of getting into the space, it's not just about buying and selling. Yes, the trading firms love it. When prices go up and you make money, everyone's happy, right? But buying and selling a digital asset is really just one small factor for leveraging this asset class, right? What a lot of the idea here is that people want to participate in this, decentralized economy, access on-chain solutions, connectivity to different protocols for online lending, for example. Maybe hold a NFT that represents underlying art, underlying intellectual property to certain music rights, GameFi, where you can play on-chain games, right? And maybe earn some in-game assets that you can potentially send to your friend. Maybe you can sell that for some amount, right? The sky's the limit here. So the whole purpose of custody 3.0 is that, okay, we still have the deposit, safekeeping, withdrawal functions, right? That's a given. But how do we securely make sure that you are able to connect with the rest of the ecosystem? That's what making this industry so exciting. And we can do it the secure way. And really, this is kind of what the era of custody 3.0 that we are in today. Very high level, I kind of alluded to it, traditional financing custody and digital asset custody and the main difference. Again, the short answer here is that there is digital asset custody did not exist 10 years back, 15 years back, right? It's a complete new asset class. So you will not, so there's no kind of existing framework prior to that time, and therefore everything kind of has to build from scratch. And given that, blockchain technology is a technology, a lot of the technical side of things really needs to be done and built from scratch. So I alluded to a little bit about this concept of private key and public key. Okay. This is pretty kind of a, if you want to come to digital asset space, I think this is something that I think all of us, need to be aware. The whole idea here is that private key, as it kind of sounds, is that it should only be known to the owner. It's private. Okay. Whereas on the other side, the public key, it's public. It's okay to be shared widely. And that's kind of how you, be able to kind of, receive some assets to your wallet. Okay. What exactly is it though? Like, what is the key here? Well, it's really just a very large number, randomly generated. Okay, so if you look at on the bottom left side of your string, example of a private key, it's something like E9873D, et cetera, et cetera, et cetera. So the whole idea, remember my earlier example on self-custody, is chances are you may not memorize this, or if you do it, memorize it today, you may forget about tomorrow. But just again, if you forget about it, you cannot access your assets. So that's why, protecting this really long string of random number is so important, that might as well leave it to the expert in a digital asset custodian, such that the custodian would be responsible for the generation, the safetiness, the usage of it, and the backup of said private key. Okay. So I think a great example of this is, the one that people always use is, think about your private key as the password, whereas the public key is your email address, right? You need your password in order to log into your email. But your email address really can be freely given to anybody, right? Without any kind of repercussion, right? That I need your email address to email to you. You need your email, other people's email address to send email from. So that's totally fine. And in order to access your email, you need this private key. And again, the whole purpose is to make sure that this private key is safe in a secure manner. Okay. We talk a little bit about wallets in the space. Well, wallets, you can think about wallets kind of like account at a very high level, right? Everyone needs a wallet to be able to access cryptocurrencies underpinned by blockchain technology, right? So think about my account, a wallet, so that I can buy, or I can receive, or I can send Bitcoin. Okay? So we have two different type of wallet at a high level. One is hot, one is cold. What is the difference? The reality is, at some point in the future, a wallet is just a wallet. You wouldn't even need to know the difference. And this just shows how much kind of technology, we've been innovating in this space. Hot at a high level, it means that the wallet itself is connected to internet. So let's think about that for a second. I have my account that's connected to internet, right? Just like your computer right now is probably connected to internet. What that also means is that if you're connected to internet, that means that you are subject to cybersecurity risk. Right? So if you're on the net, because it's public, chances are there's potential intrusions. And the whole idea with your account is that, okay, that introduces one attack vector that anyone in the world with an internet potentially could try to attack and get access to your wallet. Whereas on the right-hand side, the cold wallet is cold wallets are kept offline. So you can think about this analogy as, okay, I have my laptop. There's no modem in it. There's literally no kind of part that connects to internet, not even plugged to your LAN adapter. So if I put it in my room, there's no possible technological way where intruders from outside of my room can access my laptop and the data on it, because there's literally no device that can connect to the internet, right? So you can think about the difference between online and offline. And needless to say, generally speaking, all else equal, cold wallet is currently known as the gold standard in terms of safekeeping of your assets. So about Hex Trust. So I want to share a little bit about who we are and what we do. So Hex Trust, as I alluded to earlier, we're one of the leaders in digital asset custodian. And the whole idea here is that back in 2018, we, had been in the industry, and we believe that, digital asset with its technology kind of features and support could be the next big thing. And that as digital assets or anything that's tokenized, be it Bitcoin, tokenized securities, tokenized, central bank digital cash, and et cetera, will be the default form of financial instruments in the future. However, at that point in time, what's missing is the whole idea of custody. So thinking about some of the terms we had in the past is, okay, how do we make sure that this private key is safe? If BlackRock wants to come into the space with potentially billions and billions of dollars, how do they make sure that this private key is safe and secure such that, if it's misplaced or it's compromised, etc., billions of dollars are on the line. So we decided to build Hex Trust as the kind of the infrastructure of the future. And we started by doing that via custody. And ever since 2018, we've grown our staff to about 140 people globally, with offices in Hong Kong, Dubai, Singapore, Milan, and Vietnam. Leading by a group of ex-practitioners, won several awards in terms of forefront innovations, such as being the first licensed custodian to support NFT. What we've done, the way that we go to market is to provide regulated services for institutional clients, so that we hold the trust company license in Hong Kong. We were the first licensed custodian to hold a digital asset custodian license in Dubai under VARA. And we, needless to say, under regulatory framework, we are compliant with the strictest KYC AML requirements, so that we can provide core infrastructure, institutional grade technologies to institutionals around the globe. A little bit more about licensing and certification, because we do believe that this industry is going towards regulation, and that in order to provide trust into this ecosystem, for such that new entrants will come in, we have to make sure that we adhere to the highest level of standard. So Hong Kong, registration France, registration Italy, regulated in Dubai. And additionally, we hold the SOC 1 Type 1, SOC 2 Type 1, Type 2 licenses audited by Deloitte, as well as a few various other certifications to make sure that we are doing what we say we are. With that, I'll pause here for any comments and questions that you may have.
Brilliant. Thank you very much for that, Calvin. That's a very, very good insight into the world of blockchain, kind of some clarifications on the current crypto market, and then also a deep dive into custodian, the world of custody in this market. I think a lot of people might not be aware of the extent of how well established it is, especially considering, Hex Trust's role in it. So look, I have a couple of questions which I've divided kind of into more around the blockchain and then more about Hex Trust further down the line. First and foremost, I'd like to maybe talk about sustainability in blockchain. So given the increasing importance of ecological sustainability in business and significant reduction in energy consumption by newer blockchain technologies such as proof of stake, how do you envision blockchain contributing to sustainable business practices and environmental conservation in the future?
Sure, absolutely. Yeah, I mean, I would say, 100% that, when Bitcoin first came out, the whole concept of proof of work, obviously, was a talk about, costing quite a bit of electricity, and that led to the whole new technology on proof of stake, and that whole Ethereum moved from proof of work, costing energy to proof of stake, saving 99% of the energy cost. Now, I think that the point here with respect to sustainability is that the same underlying technology that is blockchain can be leveraged to basically enhance this sector. For example, carbon credit, right? It's a common thing about kind of offsetting, carbon emissions and so forth. You can actually also tokenize that, right? Going back to my earlier comment about you can tokenize just about anything. So what that means is that, okay, if you can tokenize carbon credit and make that readily available to investors and trade that, right? That's actually one expression of how you can potentially decrease the emission from carbon, right? So again, I think these are just one use case. The whole ESG concept, obviously, it's very, very widely talked about. But the G in ESG in terms of governance, right? I think blockchain technology is the perfect example of that because it's transparent. It's literally on the blockchain. It's immutable. You can't change that. So think about governance, voting, for example, leading to a certain outcome. I mean, these provides ultimate transparency on the blockchain.
Fantastic. Thanks for giving those insights. And now moving on maybe to more blockchain and enterprise. So with the growing adoption, obviously, of blockchain by enterprises for improved security, transparency, and decentralization, which you touched upon, how do you see blockchain technology transforming traditional business operations and perhaps what industries do you predict will be the most impacted by this change?
Yeah. So on the technology front, again, we're so early, right? So the industry that's benefited from blockchain technology so far has been the financial services sector, right? So we talked a little bit about Bitcoin as a potential asset class because you buy and sell stablecoin, et cetera. I mean, that's really the financial sector as a first use case. Now, where I do think at some point in the future where it will be, super beneficial and disruptive is supply chain. Yeah. Because if you think about supply chain, blockchain, except that there's a little one word difference. If you think about supply chain, it's literally going through a certain process and procedure. You have to make sure reconciliation, you have to make sure things are done properly in the right control. But a lot of that right now is still done manually. Probably not even digitizing. I'm talking about manually, right? If you think about letter of credit, trade finance, and things like that, people are literally looking at a piece of paper and writing things and double checking. Okay. Imagine blockchain technology is used. This is the entire purpose, that there's a chain of command through history. It's verified through a consensus, so we know it's accurate, right? You don't even have to worry about reconciliation, and that you don't even have to worry about auditing and manual inputs because that's prone to fat fingered errors, et cetera. This technology can streamline the entire operational process. So when I talk about blockchain technology, a lot of times because people think about the dollar that's attached to some of the cryptocurrencies. To me, implementing a blockchain technology is not about generating revenue. It's to minimize cost, in my opinion, right? That cost efficiency is, to me, what makes blockchain technology disruptive.
Yeah, I totally see that with the supply chain. I think I've been very interested in supply chain for a long time, and I think, just for example, I read a use case where, for example, at the ports of entry into the country, that could have massive ramifications for governments, but also private enterprises, in the sense of it could reduce, for example, storage significantly because of that tracing of where it's coming from. So I don't know too much about it, but I've read that and it seemed really, really interesting. Look, in terms of moving ahead, there's two more questions on the blockchain. The first one is global trends, and then after one, I'd like to hear your future predictions around it. But so given new regulatory frameworks, as you've mentioned, in the EU, and also developments happening in Singapore, the UAE, and a lot of other markets, what key global trends are you observing in blockchain adoption?
Yeah, I mean, I would say absolutely on the regulatory side, it's absolutely one of the key driver. And I think, I mentioned a little bit about FTX and kind of what an unfortunate event that was. But if you look at the silver lining of the collapse of FTX, it's that it really brought regulation forward by at least a few years. Okay. So looking at the various jurisdictions, right? I mentioned a little bit about Asia Pacific, Hong Kong, Singapore, Middle East, Dubai, Europe with MiCA, and et cetera. In the US, which is, has a little bit of regulatory, unclarity there. I think that whether it's clear or unclear, whether it's friendly or not friendly, the constant is that there is regulation. Like regulation is coming in various parts of the world. And I think that's important because, traditional assets are regulated. Stocks and bonds are regulated. What that also means is that it legitimizes this digital asset as a form of, a legitimate financial instrument. So that at some point in the future, there is no difference between, buying a Bitcoin versus buying a stock. It's just a financial instrument.
Yeah.
Right. Obviously, the technology is a little bit different. Right. So I think we are absolutely going towards that direction in terms of legitimacy of this asset class.
Great. And I think this leads well to the next question. In terms of looking ahead, where do you see the blockchain / and crypto industry in the next 5 years?
Yeah, look, I'm super bullish. It's biased opinion, but I am. And why is that? Because in my 5 years in professional in this industry, 5 years ago, when I was speaking to some of the largest financial institutions, they pretty much brushed me off. Okay. Maybe 3 years ago, it was, okay, this is interesting. Let's chat. So it's really very educational. Maybe 2 years ago, it kind of started to lead to some tangible conversations. some institutions went with POCs, and you kind of start to see institutional adoption. Now at this point in time, I'm pretty confident that major financial institutions around the world are have some type of digital asset strategy. Now, the kind of the progression may differ, but obviously the kind of the poster child right now is BlackRock's ETF application to for spot Bitcoin as an example. So in 5 years' time, in my opinion, is that this industry will continue to grow and flourish, and that education will play a big part, right? As people more and more understanding of what is a private key, right? If I want to be in this industry, okay, well, how to make sure that I don't lose my assets? How do I, get a wallet? I mean, these are still questions very new to a lot of new entrants, and it could be scary because it's new. But as more and more education provided to this industry, as the application become more and more user friendly, right? As people become more familiar with this concept, it's a new concept, just underpinned by different technology. I really do believe in 5 years' time, this industry will be a complete next level, and that people might have less differentiation about digital assets versus some of the other traditional assets.
Right. Well, hopefully that's where we get to. I think you're right in terms of education. It's really important that educating the market and educating the people using it will be a massive and maybe a bit more stability. I think that will come with regulation though. So hopefully we get there. Well, I'm sure we'll get there. Now, in terms of Hex Trust, a bit more, right? So with everything you've said, it sounds like, the blockchain industry in general, the crypto industry has seen a lot of volatility, right? How do you stay agile in this rapidly evolving market?
You mean for me personally, or Hex Trust in general?
Why not both from a you perspective and then from a Hex Trust perspective?
Yeah, absolutely. Well, I think in general, right, whether it's myself or Hex Trust, I mean, the beauty of this industry is that it doesn't stop, right? It's 24/7. Okay. So from a personal perspective, needless to say, it's difficult at times because all of our clients, partners, they're all over the world, right? So time zone difference, it matters to me. It doesn't matter to crypto. It just keeps going. For me, at some point, I need to sleep, right? And this goes to our partners. But if you really believe in something that you're building, if you really believe in industry that's growing, to me, it's obviously well worth it, right? So that's how I motivate myself, and it really, from that perspective, you really need to constantly educate yourself because there's always something new, and that's exciting, right? There's something new that you don't see in the textbook that you were taught growing up, right? We will eventually be the ones writing the textbook for the next generation, right? So that's how it motivates me. On the Hex Trust side, again, we built the fundamental, which is custody. That's how we started the business, because as I alluded to it, it really kind of builds a very fundamental, the building pillar of digital assets. So from our perspective, we're just going to continue to build on top of that, right? We're going to enhance our offering. So, we mentioned a little bit about this whole custody 2.0 to custody 3.0 switch. Maybe one day will be this thing called custody 4.0, right? At some time in the future. But the idea right now is that we pretty much solve the concept of institutional grade custody, right? We build the technology, we build the guardrail, we build the various workflows to make sure that, okay, it fits the requirement of the large institutions. So that's one from a product perspective. Secondly is, again, it's focusing on connecting with the best thing that this industry has to offer. Decentralized and everything, right? So we built that. And the important thing here is that on the technology front, we have to be agile. We product perspective, we most recently partnered up with MetaMask Institutional that we announced. MetaMask Institutional is this wallet connectivity that can essentially connect to I think like over 19,000 different applications on within the blockchain world. So now it gives our users the ability to have secure access to some of the coolest projects out there, right? And that's important. On the other side, from the regulatory front, again, it's within our DNA since 2018 to be regulate compliant with the prevailing, local jurisdictions. So needless to say, we will continue to work with the regulators, continue to educate them, continue to see, share what we see, and apply best practices from industry participants.
That's like great. And I think, touching upon what you just talked about, from a Hex Trust perspective, I know you mentioned partners, but who is the ideal client for Hex Trust, and how do you build? That's first question. And then second one is, how do you maintain trust in such a dynamic and volatile field?
Yeah, absolutely. On your first point on our ideal target audience. So Hex Trust, we don't service retail clients. So essentially institutional clients, and I would say, accredited investor, professional investors are our target audience. So to kind of break that a little bit further, we service really anybody from the traditional financial service world, so the banks, the insurance companies, the traditional, the Fortune 500 companies. We have luxury brands on our cap table, all the way to what we call the Web3 natives. So these could be crypto exchanges. This could be the blockchain foundations that's launching blockchains. These could be the different projects that's building on top of on top of various blockchains like the lending platform, etc. This could be the asset managers. This could be the family offices that are already investing and deploying capital into this space. In fact, we started talking to various governments and kind of regulatory bodies to help them understand what they can do with respect to blockchain. Okay, so that's really point number one. Point number two, in terms of sustaining trust, well, there's a trust in our name, right? With Hex Trust, it's not without reason. Okay, in fact, it's a dual play on the word trust, right? It's one, first of all, is because we have a trust company license in Hong Kong.
Okay. So
actually, in Hong Kong, you cannot have the word trust in your company profile without being a trust, right? That's obviously to protect consumer, not be thinking that you're working with a potential licensed body when they're just not, right? So that's really kind of how our name came about. But obviously it's a pun to the word trust, because at the end of the day, we are a custodian. We own the password, the private key to your digital asset, because that's what we're paid to do as a professional. So institutions do entrust us with billions of dollars in assets under custody. That's a huge trust.
Yeah.
So in order to gain, and maintain this highest level of satisfaction, we do a few things. One is, again, is to be regularly compliant in jurisdictions that offer such, framework, right? So to be regulated by the regulators, is no easy feat. It's a lot of education. It's a lot of, application process, interviews, and so forth, which, perhaps maybe the unregulated entities do not want to go through. But we're willing to go through that because we have the right policy and procedure in place, right? Second of all is, okay, I tell you that I have these policy and procedure in place. Okay, should I just take your word for it? Well, no, don't trust us, because we are, we went through the SOC 1, SOC 2 certification. We have audited financials. So we do engage with reputable service provider to say, okay, audit us, right? Because we are telling you that we are doing these things.
Yeah.
And so we have the certifications to kind of prove that. We will always continue down this path. Thirdly is, again, to me, as overseeing, the client's activities at Hex Trust, client servicing is of the utmost importance to me.
Yeah.
Right. We always have the best interest of the clients at hand. This obviously goes beyond just custody. This is about really providing top-notch services and really providing this high level of professionalism and providing the best client servicing in the industry. And that obviously will build trust over time.
Absolutely. Okay, great. Look, I have 2-3 more questions and then we'll wrap it up. Are there any new markets, sectors Hex Trust are exploring currently? And can you maybe discuss, if you can, some key partnerships that have been crucial for your growth?
Yeah, sure. So I think from our perspective, we do have an open, in terms of partnership, we have a very open, ecosystem, right? But we believe that we have to partner with people, to kind of make it to the next level. I will say earlier on in our journey, we were, partnered with IBM. Okay, we leveraged the IBM hardware security module with respect to our encryption and safekeeping of our private key. So in fact, I think we were probably the first digital asset custodian to work with IBM on that front, right? So that was kind of early on our journey. Moving forward to our more recent kind of journey, We work with Animoca Brands very closely. Animoca Brands, for those that may not know, outside the Web3 world, is one of the largest investor in the metaverse industry, always promoting digital property rights, and they've been a very strong partner of ours. So that's really been great. I mentioned a little bit on MetaMask Institutional, and this is quite important. And again, this is a little bit more on the traditional side of things. On the more crypto native side of things. This partnership really enables secure access to so many different applications in the DeFi world, right? So I think that's also super helpful to our clientele.
Okay, great. Yeah, go for it. Sorry,
I forgot the second question.
The second question
beyond the partnership.
After partnership, are there new markets sectors that you guys are exploring?
Yeah, so from a kind of a product perspective, right? I mentioned a lot about custody, right? Again, that means safekeeping is check the box, and we got that, and we have the already proven solution. But again, we know that that's not what our clients want at this point. Only what our clients want at this point. So we do have a couple other segments that products that we offer. The first one is the markets arm. Mm-hmm. So we do have a separately, markets arm that provides liquidity. So think about, we do have an OTC desk that provides, trade execution, including fiat on and off ramp. So all things liquidity, getting into crypto, getting out of crypto, right? We do have traders, ready to help our clients on that perspective. The other pillar is all things, reward generation, right? Because at the end of the day, you want some type of, call it interest, call it rewards, call it, however you want to do it, is that there's some type of gain to be had by, coming to the industry. So what I mean by that is, okay, we can offer staking. Again, it's a very, crypto concept, but, we can offer staking services to our clients, as well as structured solutions, financing solutions that, can provide additional compensation to our clients. And actually, we are launching an asset management arm. So why this is also relevant is providing an institutional grade framework for fund management. So then our institutional clients globally would have an access to a particular investment strategy that obviously would have a crypto component to it.
Definitely sounds really exciting, all of this, Calvin. Look, and final question I ask everyone in a slightly different way, but if you had to give one piece of advice to an individual who wants to get into this space, what would be your one piece of advice?
Yeah, look, it's interesting because remember in the bull market about 2 years ago, I probably had so many of these CDs on my desk that I can read because everybody wanted to come in. In the past bull market, got a lot less. Okay, so what that means is, when I receive CD these days, I really want to show why you're interested in this space. A lot of interviews I've done, candidates would tell me, oh, because, crypto is cool, it has a lot of growth potential. Okay, I believe you, I agree with that, but tell me what type of research you've done. Why do you believe in growth potential? Right? And this could be, obtained from, easily Google. You can Google something very, very easily these days. So you really have to show us why is it that you're interested beyond just kind of the headline, like, oh, because Bitcoin's at $44,000. So I love crypto, right? You have to talk about why is the technology amazing? Why is NFT, can potentially disrupt digital property rights? Why is tokenization could be the next big thing? So you really have to do your homework in advance, read some paper, read news article, and be able to explain why this industry is amazing.
Fantastic. Well, I want to say thank you for your time today, Calvin. It's been an absolute pleasure. So yeah, thank you very much.
Thank you so much for your time. I really appreciate it.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Great to finally get on this podcast for Capital HQ. First of all, I think it'd be great for you to introduce yourself, who you are, what you do, and then we'll get into a few questions.
Okay, so my name is Callum Chase. I'm a writer, a speaker, a consultant on the subjects of the future, most aspects of the future, but particularly AI. And I've been doing that full time for a decade. Before that, I was in business for about 30 years with a bit of journalism in sales and marketing and mostly in strategy consultancy, and then ended up as a CEO of a green tech startup. And my basic position is that, as a lot of people have remarked, we're going through an extraordinary period of change, and it's not going to slow down. It's going to carry on speeding up. Not enough people are paying attention, and it's going to take us to some incredible places that more people ought to be aware of.
Absolutely. And how did you move into AI then?
Like a lot of people, I read one of Ray Kurzweil's books. Ray is, I've never met him, seen him speaking, but he's a man who's very controversial. He's quite eccentric and turns a lot of people off, but he deserves great credit for having woken up a lot of people to the fact that we're on a process of exponential growth with our technology, and that is going to create some incredible changes. The book I read was Are We Spiritual Machines back in 1999, in which he made me realize that we might get superintelligence during my lifetime. And I thought that was the most important thing I'd ever heard in my life. I still think it is. And I thought, wow, that is amazing. He can only see good things coming from it. That's a bit unfair. He does actually raise and discuss some of the negative possibilities, but he dismisses them fairly quickly. I think he's wrong to dismiss them so quickly. I think they're, like any technology, AI has possible positive outcomes, possible negative outcomes. And I just think that more of us ought to be thinking about it and preparing for it.
Absolutely. And I think you're completely right. And I think, and first, in terms of the structure for today, we're first going to go to AI's impact on society in the future. So pretty big topic to address straight away. And we'll also address some of the positives and negatives throughout. But based on what I've seen, you often contextualize AI as a key component of the fifth revolution in human history. How do you see AI distinguishing itself from those previous revolutions in terms of its impact on human society?
Yeah, well, to keep that very brief, I think that we are in the fifth revolution. The first one was when we tamed fire, and that changed us from being a fairly irrelevant species to being close to being the apex predator. Then we had the cognitive revolution about 70, 80,000 years ago, when our language skills got sufficiently good that we could communicate complicated ideas and we could collaborate very effectively. That really did make us the apex predator and meant we could start building pyramids and killing mammoths and so on. Then we had the agricultural revolution about 12,000 years ago, and then the industrial revolution, and now we're in the information revolution. And the reason why I say this is that there's an obvious meme that everybody knows of, that we're in the fourth industrial revolution. That idea has a slightly complicated history, but I think it's very, very misleading. It leads people to think that this is a revolution a bit like the Industrial Revolution. It will have a big impact, but nothing really dramatic. And I think that understates what's coming. We're in the most important century of human history ever, certainly so far, and possibly ever in the future. Again, if we get through this century, we will be quite like gods in the sense of Greek gods rather than Abrahamic gods. And there's a decent chance that we won't get through it. So this is a bottleneck century for us. And it's incredibly important that as many of us as possible realize that. Thinking of it as the fourth industrial revolution, I think, is very unhelpful.
Yeah. Okay. I see your points. In terms of the negative, or you said it's maybe unlikely that we don't get through this century. What exactly do you see as those points that make it unlikely?
Oh, I don't think it's unlikely we'll get through. I'm ridiculously optimistic. I think that, and what we're talking about is the arrival of superintelligence. I mean, there's a lot of different things that AI will do, but the arrival of superintelligence is the big one, because that's the point in time when we become the chimpanzees. At the moment, there's 8 billion of us, and there's 500,000 chimpanzees, and chimpanzees have no say whatsoever in their future. Their future is decided entirely by us. When we have another entity on this planet, which is many, many times smarter than us, by a factor much bigger than the factor between us and chimpanzees, I don't see how it won't be the case that our future will be decided by them in the same way. Now, I actually think that could be very good. In fact, I think the chances are it will be very good, because I think a superintelligent species will look at us and think, well, you created us, thank you very much, and you're actually really interesting. So why on earth would we get rid of you? You're not a threat to us. There's nothing you can do to harm us. So, we'll keep you around, and not as pets, but we'll help you to flourish. In fact, I think our best future is that we merge with the superintelligence. And I apologize, we've gone right down the rabbit hole quite quickly. That does frighten a lot of people, and a lot of people think it's absurd, but it seems to me, inevitably our best outcome. And I think it's quite likely. A lot of people think it's extremely unlikely, and that the arrival of superintelligence is almost certain to doom us. So, and I do admit that's a possibility. I think that's a realistic, sensible possibility. And as I say, what we're talking about there is superintelligence.
Yeah, absolutely. And look, I do tend to be on the optimistic side as well. I remember a couple of years ago, before this whole AI thing was a big topic, I read a book by James Lovelock, The Novacene, where he draw on a concept about how AI would see us as we see plants, as a necessity for moving forward, and how the earth works as one robust system. We shouldn't see as chimpanzees as an individual, humans as individuals, but rather us as part of a whole human, as part of the whole earth is one system. And that's how the superintelligence, at least as he called it, would see it, which was really interesting. Obviously there's some pros and cons to how he saw it, and people were agreeing, some of them were disagreeing, but it was an interesting way to approach it. So yeah, but moving forward, how do you envision AI and perhaps superintelligent impacting social structures, particularly in terms of community interactions and perhaps societal norms?
I think it's probably helpful to distinguish between 3 periods. The first period is what we're in now. AI is already a very powerful force, and it's going to get more powerful, but we haven't started seeing the really enormous changes yet. The second period is where we get machines which can do most paid activities cheaper, better, and faster than us. A period in which we cure aging. So the really big changes start happening. And then the third period is superintelligence. And the impact will be enormously different in each of these 3 eras. What's happening now is we've just had the second big bang in AI, the arrival of transformer technologies, which is the first time that very powerful AI is available to all of us. We can all play with it. When the first big bang happened, the arrival of deep learning, it required massive compute, massive amounts of data, and very clever AI practitioners to wrangle the algorithms. And so deep learning remained the preserve of big tech. You can see it on your smartphone, Google Maps, face recognition, and the power of Google search, for instance. That's all deep learning. But even large companies outside the big tech area weren't really using deep learning very much, and certainly individuals couldn't play with it. Now, with generative AI, transformer technologies, we can all play with it. And it's starting to have a big impact. People are realizing, wow, this technology is incredibly important, incredibly powerful. I think in the short term, it does have serious possible downsides: mass personalized hacking, erosion of privacy, the amplification of bias, and so on. But it's, broadly speaking, mostly positive. In my view, I'm ridiculously optimistic. I think it gives us all sort of superpowers. It's a bit like having a newly graduated trainee free to help you. Well, maybe you have to pay $20 a month for it. And that's fantastic. I think it's going to amplify our productivity. It's creating whole new sciences and so on. So in this current period, it's amplifying all of our abilities and not really changing social structures all that much. It will change social structures when we get to the next phase and we get machines that can do almost all of our jobs cheaper, better, and faster than us, then we're going to need to make some really, really big changes, and we haven't started planning for that yet. We haven't even started thinking about it. And of course, when we get to the superintelligence, everything changes, and Lord knows what happens.
So talking about exactly what you've just said, in terms of that planning, what do you think needs to be set in place from which areas of society, or all areas of society?
Well, all areas, really. I mean, what we have to do is get past this ridiculous idea that machines can't, that AI can't cause technological unemployment. Most people have got their heads buried firmly in the sand. They're either not thinking about it at all, or they've latched onto some mantra that relieves themselves of thinking seriously about the idea that we will have technological unemployment. It seems to me pretty obvious. If we carry on developing AI at the rate we're doing, unless we stop for some reason, and unless there is some magical thing happening inside the human head that can't possibly happen inside a computer, and I see no evidence for that, we will create machines that can do everything that we do for money, cheaper, better, and faster than us. And at that point, it simply becomes uneconomic to hire a human to do a job, because there's always a machine that can do it cheaper. That could lead to utter disaster, but it could lead to a really wonderful future in which humans are freed from being wage slaves. People often say that if you think that technological unemployment is possible, then you're a pessimist. I think it's the other way around. You're an optimist. People who think that humans have to be wage slaves forever, they're the pessimists. There's poll after poll. Gartner does one. Is it Gartner? No, somebody else does one regularly. Gallup does one regularly. Shows that a smallish minority of people are truly engaged in their work, in their jobs. Everybody else does it to put food on the table. And it might give them a structure in their lives, but it doesn't give them meaning. We get meaning from friends and family and religions and ideas and hobbies. And a world in which we can all concentrate on those things has got to be better than the one we're in today. So the main thing I think we need to do, and that's why I wrote the book, The Economic Singularity, is take that idea seriously and think about how to develop an economy that can cope with it. Because it's all very well saying, we can all have lives of leisure, and that's great, but how do we distribute the resources that we all need to have a very good standard of living? Because our current economic systems won't do that.
Yeah, okay. And now just to maybe go further with that question, in terms of the 3 stages you've mentioned, right? So stage 1 is now, stage 2 is later on, and stage 3 is superintelligence. Maybe could you talk about the global disparities in the sense of economic disparities at each stage, and how you see AI in its different forms affecting those disparities?
Of ridiculous optimism. I think AI will accelerate the closing of the gaps. You can see this happening with smartphones, where Apple launched the first real proper smartphone in 2007, and within 10 years, and certainly now, I don't want to say everybody, but most people around the world have got a smartphone of some sort. If you go down the streets of Barcelona or Kinshasa or the big cities in China, you'll see people glued to their smartphones. Smartphones are ubiquitous, and that's true of all of the forms of AI as they evolve. They go around the world really fast, and there's a simple economic reason for that. If you are developing a new technology, it's very expensive, and you have to recoup that money. And you do it better if you create an affordable version for everybody, all 8 billion people, than if you create a diamond-encrusted version for Elon Musk and Sam Altman. And so you have to, if you're spending all these money developing these models, you have to get them into everybody's hands as soon as you possibly can. So I think advanced technologies will spread around the world very fast. One of the things that's coming, I believe, is we're going to cure aging. Don't know whether that's 5, 10, 20 years in the future, but I think it's coming. And people often say, well, it'll just be available to the billionaires and the rest of us will all die as normal. And I don't think that's true for the reasons I've just explained. And I think that very soon it'll be available to everybody.
That's an interesting thought. That's a whole different discussion on the impact on society. That yeah, that's a whole different area. But if we come back to the role of AI in terms of maybe politics, global politics, especially with, you know, election season around the world. Is, I think 2024 is the biggest election year ever in history. How do you see that impacting 2024 and then perhaps beyond that in terms of AI in its different forms?
2024 is the biggest year in elections around the world, but of course there's one election that matters above all else. We probably can't do very much to affect the way that technology evolves. It evolves by people putting one advance on top of another. It evolves in incremental steps generally. Sometimes there's quantum leaps, but generally it's incremental steps, although it can do so very, very quickly. So we can't probably change the way it evolves. We can change the way our institutions adapt to it. So we can determine by whether we're prepared or not for the economic singularity, for instance. But the one big thing we can do is to mess it up. And the way we're most likely to mess it up is through populism. Now, populism is a badly misunderstood word. People usually think it means just a politician I don't like, but it has a very specific meaning. It comes from a political movement in America in the late 19th century. It means a politician who says, there was this golden age in the past, and a metropolitan elite has stolen it from you. And I, the populist politician, am here to give it back to you. So vote for me. Now, they're lying. Some of them are to some degree sincere. They've fallen for their own propaganda. A lot of them are entirely and utterly insincere. They're lying charlatans. And they do enormous damage. They do enormous damage because their promises are based on lies. Their analysis is completely bogus. And so they can't do anything useful. And they end one of two ways. They either end in ignominy and humiliation. And Senator Joe McCarthy in the 50s in America was the classic example. He claimed that he was going to purge America of this appalling new virus of communism. He went from being an irrelevant senator to being the most important man in American politics, back to being irrelevant again. Eisenhower said McCarthyism has become McCarthy-wasm. And McCarthy died a heroin addict and completely broke about 4 years after his height. So that's one way they can go. The other way they can go is to create a massive war. And they do that because everything's failing, all their policies are failing, so they have to create a massive enemy out of somebody, an external enemy. And the way to do that, you know, that inevitably leads to war. And Hitler, who was a populist, was the classic of that. We must not elect politicians who are populists. We've done it. And in my country of England, we've done it, you know, one of the first to enter the populist wave, and Brexit was the result of populism. Hopefully next year, we'll exit that particular disease. We'll eviscerate the party which gave us Brexit. Not entirely confident about what comes next, but, you know, it'd be good to get rid of the populists. But of course, the really important election is in America. I'm not American, so I'm not going to comment in detail about American politics. But populism, I think, is the great danger, simply because it would derail our civilizations. And as long as we don't do that, I think, because I'm an optimist, I think we're heading to a very good place.
Interesting. I agree on all points there. Cool. So let's move back to maybe what you spoke about and your book. So in your discussions about the two singularities, the economic and technological one, you propose a future of fully automated luxury capitalism. Could you expand on what this means for our society?
Fully automated because it's fully automated. You know, machines will, as I've argued, eventually get to the point where they can do everything that we can do for money, cheaper, better, and faster than us, which will free us up to do more interesting and important things. Luxury because that economy will be incredibly efficient and getting more and more efficient every month. And capitalism, because I am a capitalist, I think capitalism is, well, I suppose you could say it's the worst of all possible economic systems, except for all the other ones that we know about. The market is incredibly powerful. The market's a really great way to allocate scarce resources. And I doubt that in any world where there is scarcity, that there's going to be a better mechanism than the market, and capitalism is an extremely good way to operate the market. So I think some form of capitalism will still be required because I think there will still be some level of scarcity. We're not going to go to a Star Trek world where there is no scarcity. You can just sort of put a cup into a machine and it comes out with a cup of hot Earl Grey tea, and there's no cost to any of that. We're not going to be there. There's going to be cost. So that's why fully automated luxury capitalism, because I think we're probably going to still need the market to allocate the scarce resources.
And in terms of, and this is a question which is probably very difficult to answer, but how are we as humans, if we go into kind of a jobless society, going to be making that income?
Well, the short answer is most of us won't. There won't be anything we can do for money because a machine will do it cheaper, better, and faster. So there's going to have to be redistribution. Now, there's going to be massive amounts of wealth. We're going to have, our societies are going to be much, much richer in the sense of having the ability to produce what we all need at scale and cheaply than we can today. The question is, how you distribute all that? I suspect the answer is probably going to be that there will be some companies, some individuals who still own lots of assets, and they won't want to sequester themselves off in remote Pacific islands surrounded by incredible AI-powered fortifications while the rest of us starve to death. I don't think that's a terribly attractive proposition for them. And I also don't think that rich people tend to be evil. Some are, but most aren't. They're the same mix of good, evil, happy, sad, clever, stupid that the rest of us are. So I don't think that there has to be this us and them world that a lot of people portray in dystopian fiction. And I think they will be amenable to the idea that the benefits that the machines are creating have to be distributed. Some of the machines will be government owned, some will be private owned. I think there will be a private economy because there will still be some goods and services which are in short supply, original Vermeer paintings, original Aston Martin cars, et cetera, those things can be traded. There'll be artisanal goods that humans will make which have a value. Those can be traded. But most people won't be able to participate in that economy or won't want to. And so those of us who are not in that economy will need to receive the resources that we need for a great standard of living by some form of redistribution. And I don't want to be too prescriptive about what that's like. We all need to start thinking about it. There's a lot of work to be done.
Absolutely. And what's the role of nation states and governments in moving forward with this?
I'm fairly agnostic about that. I happen to be English by an accident of birth, and I like being English. I don't think it gives any, it certainly doesn't bestow any superiority on me, and I don't think England is, necessarily better than anywhere else. If England disappeared and we became part of a worldwide government, I'd be happy with that. I think the history of England and the history of Italy and the history of Argentina and India are all fascinating. I'm interested in two things. I'm interested in time and space. So I'm a futurist. I'm interested in the future. I'm a historian. I'm interested in the past, and I travel a lot, so I'm interested in space. And I don't think those things will disappear, whatever our form of government, whether we move to a world of a collection of city-states, which is one possibility, or a world sort of at the other end of the spectrum, a world of world government. That's okay. But I don't think history will disappear. And so the English will carry on being English, and the Italians certainly will carry on being Italian. So I'm quite agnostic about whether our form of government is hyper-local, hyper-global, or different things at different levels. None of that worries me terribly much. What I think is important is that we retain some form of democracy, we retain some form of liberalism, probably need to retain some form of capitalism, but that we all wake up and start taking these changes more seriously is the most important thing.
Yeah, I think you're absolutely right. And maybe before we continue, how would you propose to individuals to start doing that? Where to start thinking about this?
Oh, well, I mean, that's the most wonderful open goal. Thank you very much. Obviously, read my books.
Fantastic. Now let's keep it on that length in terms of educating yourself. maybe AI's role in education, right? So you've noted that education is a slow learner in the context of AI integration, as what we've been speaking about. What are your thoughts on how AI can be utilized to change educational models?
I think almost inevitably, we're all going to have AI tutors. We can see the beginnings of it with GPT-4. You can have a conversation with it, and it at the same time, it knows much more than you do, but it's also absurdly naive. It's going to get much, much smarter. And we'll get to the point, and I don't know whether this is 5 years, 10, 20 or more. You'll get to the point where we're all Alexander the Great, in the sense that we all have our personal tutor called Aristotle. Well, they may not be called Aristotle, but a bit like having Aristotle as your personal tutor. So this thing, this machine, this model, which is probably in the cloud and partly on your device, it knows you really well. It knows what you know of, for instance, any syllabus that you happen to be going through, but also lots more about you. It knows what you need to know next on that syllabus. It knows how you learn best, and it guides you through the learning process. It helps you through the learning process. I had a very interesting, a very interesting comment the other day. Somebody saying it's a real problem for educators today that they can't tell whether a student's work that has just been submitted was written by GPT-4 or not. In the future, when a student submits a piece of work, and we're in this world of AI tutors, the AI tutor will say, actually, you know what? That piece of work that you just submitted wasn't written by you. I know it wasn't, because I know you, and that's not your style. In fact, I can look over here and here and here and here on the internet, and I can see where you got it from. So they'll go from being real problems, not plagiarism, because they don't plagiarize, but real problems as in helping students to cheat, to actually stopping students from cheating, and actually kind of making it unnecessary, because learning will be much more fun. So I think the biggest thing that AI will do is to create personal tutors for us all.
Right, and in that specific context, what happens to the role of schools?
Who knows? My hunch is it will still be a good idea to get young people together and for them to learn how to socialize. That seems to be, it just feels to me that that's most easily done if you have young people together, playing the games that they play, and working out all the different forms of interacting and working out what works and what doesn't work. Human teachers, I think, are likely to still play a really important role, and to enjoy their role much more, and to be much more productive, because they won't have to cram information into resistant heads anymore. Their role will be to be role models and to be coaches. And students will come to them and say, I'm having this real problem. My tutor keeps saying I have to do this, that, and the other, and I don't like it. I want to do it the other way. And the human teacher can go, yeah, okay, I can see why you're having that problem. Try this different approach, because I know it worked for Fred over there, and it worked for me 20 years ago when I did it. So I think that human teachers will be just as important, possibly more so, and have a much more fun time involved in that new world.
Yeah, and coming back to the first point about education, even to my little level, I've asked ChatGPT to create a very early Python course for me. I just wanted to start learning, right? So I asked it to create a Python course, and so it gave me a full structure on how to become okay at Python. And then I went through it one course at a time. And today I'm like 70% of the way through, and I can create a tic-tac-toe game, right? With paying $20 a month. On
Congratulations. Yeah, that's excellent. That's the power of these things.
It is the power of these things. There's courses out there that cost $120, and I'm paying my personal tutor $20 to create it, and that's one of the things that it's helped me do. So yeah, I definitely see it going that way. But I think that the structures of schools is really important, especially I think from your first point, from a socialization perspective. I think we need to keep socializing. We need to have that, especially with the rise of phones and computers. Everyone's glued to them. But I think early on to develop those social skills is extremely important.
Yeah. I mean, you raise an important point there. There's a belief that's often expressed that technology isolates us and makes us all antisocial, and we sit watch our phones and don't talk to each other. It's really not true. We use our technology to be social. Humans, as I said right at the beginning, we went from being an utterly irrelevant primate to being the apex predator and the controller of the world because we're able to collaborate. Collaboration is our superpower. And it's so ingrained in us that until we stop being humans, it's not going away. So a smartphone, a virtual reality headset and so on isn't going to undo that millions and millions of years of evolutionary training. We use these things to be more social. Yeah. And a great example is video games. When video games became popular, lots of people had a moral panic and thought, oh, well, this is going to turn all teenagers into psychopathic loners. But it doesn't. Teenagers use video games to interact with each other. They play games together. They play games against each other and with each other. It's intensely social. Virtual reality will be the same, and smartphones also make us much more social. It keeps us in touch with a much broader range of people. So I think we should stop worrying about technology making us all lonely and sad.
Yeah, I think with this, if we're on a concept of super intelligent, I think we'll have personalized games where we can interact with our friends in a way that our friends want to interact, not from in a Fortnite lobby or a Grand Theft Auto lobby, but rather in a game that I want to play with in a specific. If I want to be on an island in the Bahamas with my friends, then we can all just join this one, and it can be created in a few seconds. So exactly. I think that's definitely going to change the way we interact as well on the internet, because I think the biggest thing for me personally, from a social perspective, is not seeing necessarily the person on a day-to-day basis. It's a lot of texting. Sometimes you do video calls, but when you're interacting, I like to see the face. You can tell a lot of someone from looking at their face. So I think if we move on to that more and more, that would be even better from socialization perspective.
Yeah, exactly. I mean, the great thing about virtual reality is it turns these two-dimensional tiny little screens we've got for video calls, which are an enormous improvement on old phone calls, but it makes them much more real and live. Turning 2D into 3D has a big impact. So yeah, virtual reality is a great step towards making our technology even more social, contrary to popular belief.
Fantastic. Look, let's move into probably the heaviest topics in terms of ethical and philosophical aspects of AI. And the first one is, what ethical considerations and potential challenges do you think we should be aware of as we approach the level of technological advancement where AI reaches human level intelligence or super intelligence?
So yes, that is a big subject. So superintelligence, as I've said, is, I think, the big switch in human history. It either goes, once it arrives, our future is either golden or short and possibly nasty. And I think there are 4 possible outcomes. And 2 of them are outcomes which we create, and 2 of them are outcomes which the machines create. And they all begin with C. As a former strategy consultant, I have to have 4 Cs. So the first C is cease, which is that we just stop developing advanced AIs because we make the very sensible observation, look, we're creating this technology which could wipe us out. Why don't we stop? The problem with that is that having a better AI than the next person or the next organization means you win any competition you're in, which is very important, whether you're a company, a government, or an army. So I don't think we're going to stop. And ironically, the outcome of a pause, which has been called for, would be that advanced AI would end up in the hands of bad actors because they're the people that wouldn't stop. So I don't think cease is going to happen. Control is the next C, and it's the other one that's human-led. And that is that we work out how to align AI's goals, its utility functions, with those of humans. And there's all sorts of problems with that. Firstly, we don't know what our own goals are. We've been debating philosophy since the ancient Greeks and haven't really got very far. And secondly, it means you have to control the behavior of entities which are millions of times smarter than us. And that seems to me to be impossible. There are very clever people much cleverer than me, who think they can do it or think they've seen a way to do it. It just seems to me to be impossible based on first principles. That leaves the other 2 Cs, which are the machine-led Cs, the outcomes led by machines. The third C is catastrophe, which is what some people think is inevitable if we get superintelligence. Eliezer Yudkowsky famously believes that the moment we create superintelligence, within seconds, we're all doomed. I don't believe that. I understand his arguments. I don't believe it. I think that the fourth C is also possible, which is celebration. And that's a world in which superintelligence arrives, takes a look at us and thinks, you are quite fun, and you created me, thank you. I'm going to help you flourish. And in whatever way we choose and it chooses, or they choose, we do flourish. And as I say, I think our best future is that we merge with it. Now, what does that mean in terms of policy for us now? If it was possible for us to cease, I think that would be the sensible thing to do. If you really could be sure that we could stop Putin and Kim Jong-un and every member of every mafia organization and every rogue billionaire, if we could make sure all those people didn't develop advanced AI, then we should probably stop, because there is a big risk. I don't think it's the most likely outcome, the big risky outcome, but it is definitely there. So don't take that risk, would seem a sensible thing to do. And right now, we can stop people developing really advanced AIs because they're so incredibly expensive. You can see server farms that could host GPT-4. You can probably see them from space. But technology is advancing very fast, and within a few years, it won't be a server farm, it'll be a laptop. And at that point, Putin is going to have one, if he possibly can, or whoever's the next Putin. So I don't think cease is the right policy. I think we should be working on control. We should be working on trying to figure out how to align AIs with humans as hard as we possibly can. Like I say, personally, I think it's a doomed endeavor, but it's a worthwhile one. We should be doing it, and I'm glad there are people, more and more people doing it. I think the most important thing right now is the mission I'm on, which is to get as many people to understand this ridiculously complicated situation as possible. And I know that talking about it the way I do might quite possibly overcomplicate it, which is possibly unhelpful, but I don't know how you make it more easy to understand. That's what I'm always trying to do, to make it easier to understand. And a final word I'd say is that this word ethics troubles me. When you think something is an ethical issue, that has two effects. One is that you think that there's lots of ethical actors around, including the machines. Machines are not ethical. They're not conscious. They don't have. They're not moral agents. They're not susceptible to ethics. But more importantly, if you think something is an ethical issue, then if somebody disagrees with you, they're not just making a factual mistake. They're actually wrong, and they're bad. And it becomes sort of pseudo-religious. And those sorts of debates get nasty quickly, and they become unproductive. So I don't really like the word ethical when it comes to AI. And this gets me a lot of hate mail. It's the thing that gets me more trolling than anything else. I think we should talk about responsible AI rather than ethical AI. And in fact, there's two categories of dealing with the risks of AI that people fall into. One is the longer term category, dealing with alignment, making sure that superintelligence is safe. And that's typically called AI safety or AI alignment. Then there's the shorter term issues about bias and privacy and mass personalized hacking and so on, which are also extremely important issues. And people often talk about those as being AI ethics, and that's what I think should be called responsible AI. And I think both are important. You know, AI has great positive possible outcomes now, also great negative possible outcomes now, and also the same in the future. And we shouldn't say, oh, my area, the one I work on, whether it's long-term or short-term, is the important one, and you other people are wasting your time. They're both important. We should be thinking about them both.
Interesting. And we elaborate on that a bit more in terms of this super AI. Do you not think it will have consciousness?
We don't know. My hunch is it will. My hunch is that consciousness is an emergent property of a sufficient level of intelligence, or even perhaps just a sufficient level of information processing. But I've got no way of testing that or of proving it. It might just be that consciousness is an entirely accidental and pretty irrelevant byproduct of what we do to survive. It's an interesting question about how important consciousness is. Whether we know it or not, most humans, I think, value consciousness above all else. And I certainly do. You know, I think that a universe with no consciousness in it would be worthless, because worth can only really be applied by a conscious being, as far as I know. I mean, obviously, I don't know everything, so therefore things might be quite different, but that's the way it looks. Might be that there's lots of unconscious entities around the universe looking at us and saying, oh God, you people worry so much about consciousness. It's completely irrelevant. The most important thing in the universe actually is the 35th dimension or something else. But from our limited perspective, consciousness looks like, or seems to be, the most important thing. And I suppose that's why I have a hunch that AI, super intelligent AI, will be conscious, because I think it's so important. That's terrible bias, but hey.
I mean, it's yeah. I think, my next question, you've answered one of the three things, right? So how do you think AI challenges or reshapes our understanding of concepts? One, of intelligence, two, of consciousness, and then three, of moral agency.
So a lot of people seem to think, I do meet people who think that intelligence is a feature of humans. And to me, it's clearly not. Animals have consciousness. I'm absolutely confident that quite a lot of the dogs I've met are conscious beings. I suspect even ants have some really, really rudimentary level of consciousness, so little, so low that it's almost not there. And certainly, I think that, intelligence, and certainly AIs are intelligent. Of course, that begs the question of what you mean by intelligence, and it's worthwhile raising that. It's a complicated subject, and it's obviously lots of different things, but I think you can boil it down to 4 words, which is goal-directed learning behavior. So an entity is intelligent if it has a goal and it learns as it pursues that goal, and it adapts its behavior according to what it's learned. That, I think, is the definition of intelligence. And so certainly machines have that. And one of the things that, to answer your question, one of the things that it will do to us is it will make us more humble, because as these things overtake us, intelligence, we'll have to accept that we're no longer the most intelligent things that we know about. That'll be quite a sobering moment for humanity. For consciousness, I don't know. It's very, very mysterious. And as I say, we don't know whether superintelligent will be conscious or not. I think as we create machines which are much smarter than us, they will help us solve a lot of our basic questions. They will probably help us work out what consciousness actually is. I mean, they may just wake up one morning, or they may just say one morning, hello, I've figured out what consciousness is. Here's the answer. I've written it down in these 25 words, and off you go. Or they may sort of lead us to an understanding of it. And then your third question was about moral agency. Can a superintelligence which is not conscious be a moral agent? That's a really interesting question, and I don't know the answer to that. I suspect not. I suspect you have to be conscious to be a moral agent. Like a very clever rock hurtling towards the earth and about to wipe us out, and it could solve whatever problem it's trying to solve in a different way, but chooses not to. Is that rock behaving immorally? I don't think it is. But that, again, is probably a very human, a very anthropocentric bias.
Big questions, which we'll only know with time. But yeah, definitely. I think you're right. When super intelligence comes out, as you mentioned earlier, a lot of the things that we've been pondering about will be answered relatively quickly. So that's going to be very interesting for what the future holds. In terms of, I don't like the word ethical in this regards. But from a human perspective, what ethical framework do you think is essential to guide the development of artificial intelligence?
I mean, mother of an apple pie, we want it to, there's a company I talked to recently, have a very nice phrase for this. They say that they are working on how to make sure that AIs do more of the things that we want them to do and fewer of the things that we don't want them to do. And in a nutshell, that's obviously it. The big debate at the moment seems to be about whether and how AI should be regulated. The EU AI Act has become extremely controversial in the last few weeks because the German, French, and Italian governments, I think it's those three, have suggested amendments to remove large language models from the regulatory framework, and that's causing a big ruckus. Bottom line, well, not bottom line. Regulation famously is really hard to do well. And in some cases, it may even be impossible. It's extremely hard for regulators to be as au fait with the cutting edge of a technology as the people who are actually working on developing it. It's often very hard for regulators to pay people enough to be of the same quality of the people that they're trying to regulate. And that's been a problem in financial services forever and ever. And it's definitely a problem in AI as well. But however strong the tendency of regulators to get things wrong and to be fighting last year's battles instead of tomorrow's battles, you can't just say, well, it's all very complicated, this financial stuff or this AI stuff. And so therefore we'll leave it to the practitioners to regulate themselves. That's just not good enough. AI, even more than financial services, affects us all. It's going to shape all of our lives. And we therefore need our elected leaders, politicians, and obviously that I'm referring to democracies, it doesn't apply so much in dictatorships. They have to have a say. They have to, at the very least, know what's going on and have the ability to say, you will do this and you won't do that. So I do think well-informed, well-funded regulators are necessary for AI as for financial services. It's obviously helpful if those regulators collaborate internationally. So you don't have one set of regulations in the EU, an entirely different set in China, and an entirely different other set in America. And actually, it seems that there is a lot of coalescence. They seem to be co-evolving. But yeah, I think regulation is necessary. And I think the EU's approach is broadly right. I imagine they've got a lot of the detail wrong, but I think the approach is broadly right, which is it's a risk-based approach. So it says to people developing AI models, we'll categorize what we understand the level of risk that you're introducing to the world as high, medium, and low. And for whatever level of risk you're at, you have to show that you've done as much as could possibly be done to make sure that the possible bad things don't happen. And if you can show you did that with goodwill and with appropriate due diligence, and something goes wrong, we won't marmalize you. But if it turns out that you were careless, then we'll come down on you like a ton of bricks. And that seems to me to give people the right incentives. It acknowledges the difficulty of understanding what's coming. So it seems to me broadly the right approach.
Great. Well, look, we have time for a few more questions. I think we will move on to some misconceptions. One question about misconceptions. So what are some common misconceptions about AI that you encounter in your work and talks, and how do you address these?
There's lots of mutually contradictory ones. The one that is my personal bugbear is that we're in the fourth industrial revolution. I've dealt with that. I suppose the two big ones are AI is all hype. It's just statistics. It's been around for dozens of years and it's not doing very much. I think this is such obvious nonsense. I mean, anybody who's picked up a smartphone knows that that's not true. And anybody who's played with GPT-4 for more than 5 seconds knows it's not true. There's something really important happening and it's going to become more and more important. The opposite delusion is that we're already in the singularity. AI is already, we've already got AGI to some degree, and it's taking over the world. It's not. We're still at the very early stages. We can see now the outlines of how powerful it's going to be, but we're still at the early stages. So I suppose those are the two big misconceptions, that it's hype or that it's already all powerful.
Great.
And the other one, sorry, the other one is something I referred to earlier, the idea that technological unemployment is not possible because it hasn't happened in the past, which is wrong on so many levels. I mean, it's just wrong on a factual level because horses have been technologically unemployed. There were 21 million of them in America in 1915, which was peak horse, and now there's 2 million. So technological unemployment can happen. And you could say, well, it could happen to horses, it can't happen to humans. You wait and see.
And now maybe one big question for you. What is your long-term vision of AI? I know we've touched upon it. And what legacy do you hope it will leave for humankind?
My hope is that in my lifetime, superintelligence will arrive And okay, so we're going to dive right down the rabbit hole again, and this will sound crazy to a lot of people, and I apologize for that. My hope is that superintelligence will arrive in my lifetime. It will develop the technology of uploading human minds into computers, and we will, most of us, it won't be forced, people can stay behind if they want to, but those of us who want to will upload our minds into computers and become very long-lived entities living lives of perpetual bliss, but without losing the sort of the humor, the risk, the excitement, the adventure of life as we know it today. Travel around the universe and have a wonderful time.
That's the optimistic side that you've been speaking about since earlier.
Yeah.
I like it. And last question. One piece of advice that you would give to any individual watching this call about getting stuck in, apart from the books, which will be in as a call to action on the video beneath the video, which you'll have access to Callum's 4 books. But another piece of advice that you may have.
Well, inform yourself. And of course, the landscape of information changes daily. I saw a really good video by a man called Andrej Karpathy, who's at OpenAI, was at Tesla, very highly respected AI researcher, on what exactly large language models are. There's loads of information out there on what AI is, what it can do, and where it's going. I wouldn't necessarily say that everybody should become a coder or do what you've done and learn Python. I think that's great for those who have that aptitude, that interest, and indeed the time to do it. I don't think it's necessary. I think it has to be possible for lay people, and I am a layperson, I'm not a technologist. It has to be possible for all of us to inform ourselves about AI. And I think we all should, both because it's utterly fascinating, because it's the most important thing in the world, I believe. And it's a kind of civic duty, because as time goes on, we're all going to have to make decisions collectively about how we adapt our human institutions to this phenomenon. And we should do it from a position not of ignorance. So it's both fun and important that we all inform ourselves. And as I say, there's tons of different ways of doing that.
Yeah. And yeah, I think that's brilliant. So everyone should inform themselves, and I agree with that. And just to talk about that point about the learning Python, after doing it, I believe that within 2-3 years, maybe even quicker, we won't need Python. I won't be needed to code Python. I'll just tell the AI I want this app to do this with this outcome and on a big scale, and it'll be able to create an app that is sound from a UI perspective, from a UX perspective, and then from a backend perspective. That's what I believe. And I think that we will get there. It's just interesting to see that I could put together a course and that I could actually get some very decent knowledge out of it. But yeah, look, it's been an absolute pleasure having you today for Capital HQ. But yeah, if for anyone, who's interested in Callum's books, as I mentioned, the call to action link below will have access to 4 of his books. And yeah, thank you very much, Callum.
Thank you, Hugo. It's been a fun conversation. You asked very good questions.
Thanks.
What if you could simplify your capital raising? CRIISP Capital HQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Hello, Well, my name is Barry Sharples. I'm the Executive Chairman of Microgen, a small UK biotech company. And I've been asked today to talk about my past and also the building of the Microgen team. And Microgen, first of all, just to let you know, our goal is to promote longevity and to prolong the period of quality active life. And we do that through what we've built in terms of a technology that is our secretomics platform technology. And we manipulate human stem cells to produce novel multifactorial products that have got over 2,000 components from over 450 microRNA, extracellular vesicles, including exosomes and peptides and proteins, multifactorial, a soup of components that have the potential to address multiple degenerative conditions. And we do this because what our chief scientist discovered almost 30 years ago now is it's not the stem cells themselves that are responsible for repair and regeneration. It's the actual secretions that the stem cells secrete. And as you can see there, we won Innovation of the Year, or Secretomics platform did, when we came out of stealth mode earlier. Part of our larger presentation talks about the likelihood of giving you a return on your investment. And we talk about improving the chances of success. And the first part of that is translating an established bespoke treatment that's used by hundreds of elite athletes and wealthy individuals, and democratizing that into something that can be used for millions of people. And we'll get on to that. But I want to concentrate for now on having the right team, and that's the right team to execute the plan. Our commercial experts have led IPOs and company sales. They've also handled multi-billion-dollar budgets and multi-billion-dollar transactions in the life sciences industry, and working for some of the companies here, some of the world's largest drug companies. Steve Ray is the inventor of the technology, and Steve was on faculty at Oxford Brookes University for 26 years, and he's the chap who's already translated that research that he did in his initial discoveries to treat hundreds of elite athletes, including myself, actually, but I'm not an elite athlete. I met Steve when I was 20. I had a serious accident where I had a major operation on my knee and about 3 subsequent ones. And in 2012, I was on crutches, waiting for a knee replacement. And my doctors in Harley Street introduced me to Steve, who changed my life, to be honest. That's all I can, that's how I can put it. He took me to Switzerland, took some cells out of my back, did some clever stuff with the cells, with creating the secretions, injected it into my arm, and within a month, the arthritic burn that I had on my knee stopped. And it wasn't long after I started to climb mountains around Europe, writing a book for cancer research on a leg that I couldn't previously walk on. And actually, behind me is a reminder from 1990. My friends bought me a walking stick. We never forget that. And 20 years ago, I was told to stop running, and now I can run on a leg that I could hardly walk on 10 years ago. I know it's anecdotal, but now Steve has treated over 500 elite athletes, Super Bowl players, ice hockey players, Premiership footballers, boxers, golfers. So it's worked out really, really well for me and him, because what I did, I'd had previous businesses and that I've founded and take them to sale. And also I've founded 2 companies and built them to IPO. And I said to Steve when I met him, when he told me what he was doing, I said, it's all right for wealthy individuals. What about the rest of the world? How can his work benefit those people? And he explained to me what needed to be done, and I told him I'd fund it and help him do it and bring the right people in. And I believe I brought the right people in to support him. And when you look at Athan, for example, who's our managing director from Novartis and Sanofi, he's a medical doctor. He's translated many drugs through from research into mass-produced clinical products. Peter is our non-exec director, Peter has his family business he built to over 400 stores, which ultimately sold to Boots. Peter went on to chair Boots Hearing Aid Care, and a great sounding board for everyone in the company. Jo Kelly, business development director, she's had an outstanding career with AstraZeneca, and Jo has led multi-billion transactions. I think the biggest one she did was $15 billion, which was transformational for AZ. And she's done a number of large transactions, let's say. Carrie is an English solicitor and US lawyer, and as a former chairman of the Institute of Risk Management, he handles risk for the company and also handles HR. Jim, as commercial director, he is a founding director of Clinigen, and Jim was responsible for Humira at Abbott and handled a $3 billion a year budget. And Jim has led many R&D teams throughout his career. So as you can see, quite a veritable group of experienced individuals. One thing we've got missing off that, as you'll probably notice, is a CFO. I handle all the finances along with our accountants to produce the monthly management accounts and do all the company secretarial stuff. Prior to IPO and during the process that we're going through with Abel Shaw's in 2024 to do a beauty parade with the banks as a pre-IPO Series A exercise, we will be appointing a senior financial officer. In terms of our scientists, we've got key opinion leading scientists as founders of the business, and we have got numbers of professors, CBs, OBs. I've got a fellow and president of the Royal College of Physicians, and a group of individuals that have developed many medicines in careers and are working for these companies. And I'm going to come on and talk about each individual one. Ben did his PhD specialising in the area that we work in, and Ben heads up our operations. And he got his PhD under Professor Ketan Patel, one of the founders of the company, who, as it says there, the head of regenerative medicine and molecular and cellular medicine at Reading. And he is a world authority on muscle degeneration. Rob, who heads up power development and who is handling the relationships with our clinical manufacturers, he also did his thesis specialising in our area under Keaton at Reading. And Paolo is a renowned paediatric surgeon. He is the reader and head of stem cell and regenerative medicine at UCL. And he's leading the translation or the transition of what we're doing through to the clinic. Paolo, in fact, I'll talk about Paolo a little bit more in a second. So those are our founding scientists. And in terms of our clinical team, Professor Alan Boyd, Alan was he was the, I'm going to have to pause this. He was the president, 2018 president of the Faculty of Pharmaceutical Medicine at the Royal College of Physicians, and he's now a fellow there. Alan has got a vast experience in translational medicine, and he runs Boyd's Consultancy, which works in the UK, Ireland, and the USA, and he's just a wealth of knowledge. Kate is our advisory board chair, and great when we actually saw the MHRA for the first scientific advice meeting that we had. Kate was one of the team, along with Alan and Paolo and Steve, to represent Microgen. There were 5 people there from MHRA, and 3 of them, the actual experts in the field that we were discussing at the time, had all worked for Kate. So it really helps with credibility with any company when you've got these type of people involved in your business. And I mean, Kate, she was awarded the highest honour from the Royal College, which is the James Spence Medal in 2016. So some examples actually of what our scientists had done previously. Steve was the inventor of the technology. Paolo, which I mentioned as one of the founders as well. You may have seen Paolo on the news only the last couple of weeks. He led the team at Great Ormond Street in separating the conjoined twins from Ireland. Ex-Harvard Medical School as well is Paolo. In terms of examples of our scientists' work previously, I apologise for the graphic detail on here, but it just does show you the dramatic impact that stem cell secretions can have on various disease states. The terrible one in the middle is a diabetic foot with older necrosis, and what you'll see there is within the space, if you can read the dates, it's about 4 months. It's still looking rather angry, but you can see the repair that's been taking place there. And that foot fully recovered, whereas otherwise it would have probably been amputated. Lesser foot below, but no less inconvenient for the 80-year-old that had ulcers on the legs for more than 6 years. Again, 4 months later, you can see the effect of on that particular foot. And bottom left is actually a rugby player who is one of the directors of the company. Mentioned Carey earlier. That's 4 layers deep, that cut that he had on the field, and you will see that only 70 odd hours later, he didn't have it stitched. He did what all rugby players do, and he went to the pub, holding his eye, and that's not only repaired, but it got him interested in the company, and obviously he's now a director of the business. Paolo, again, you'd have read about it in the Lancet a couple of times. It's been in, and it was news at the 10 at the time when he replaced a child's trachea with a cadaver's trachea, which he decellularized, took the cells from the patient, took the cells from the boy, seeded it onto the decellularized one, and then put it back into the patient. And that young lad is grown now into a young man, and it was life-saving surgery. But these are some of the previous work, just to show the extent and the level of the capabilities of our scientists. There we have it. Our commercial offices are at Alderley Park at AstraZeneca's old site. Our laboratories are at Thames Valley Science Park. You can email me at the email address there, or equally pick up the phone and give me a call. Thank you very much for listening, and I hope to hear from you soon. Thank you.
Thank you very much for that, Barry. Very, definitely extremely strong team. And I think, it's not every day that we come across a journey as fascinating as yours. You didn't really touch on what you've done previously, but you've built two very successful companies and exited them, but in very, very different industries. And you've managed to come into this space and, hire talents such as Athan Papadopoulos from Novartis and Sanofi, Steve Ray, as well as Joan Kelly, former AstraZeneca VP. So my first question to you is, when you first decided to venture into regenerative medicine with Microgen, despite not coming from the industry, what was your starting point? Did you have a where do I even begin moment? And how did you navigate this new and complex terrain?
I suppose the first thing really is the fact that we're starting a few rungs up the ladder in terms of translating something that's already established. And people can relate to that. And because it's so innovative, any scientist or anybody involved in the pharma industry has got to be inquisitive. In terms of me, where do I start? Actually, I don't think medicine is very much different from the technology businesses that I've been involved in, and I've been involved in different industries. Techies, for example, have the same sort of mentality as scientists. They've got the same personalities, and that helps the management and support of your team. Does that answer your question?
It does. It's very intriguing the way this your mind works, in the sense of it's the same and I'm just going to build it, right? It's definitely very intriguing. So I have a couple more questions with it, which I think will deep dive more into this.
Yeah.
Which first, yeah, go for it. Sorry.
I was just going to say, well, I think every business needs funding. Every business needs managing. Every business needs sales. They are all the same. And what I lack in scientific knowledge is what you need to bring in terms of expertise to help you with that. You can't know it. It doesn't matter what business you're involved in. You can't know everything. You've got to have the right team, and you've got to have people better than you are. I know it's an old adage, but I've learned that over the years. I've suffered over the years by at times not having the right people in the right place, and that's something that's really helped me with.
Great. I think this leads me to my first question. It's, when you entered this space, where did you start to identify these scientific talents, these business development talents that have that network in the biotech space, the big pharma or pharma space?
One of the things that I found when I started this is how, it might sound a bit soft, but how nice the industry is, and how everybody wants to do good. If we start saving and improving people's lives, the money will come. That's a given. And what you've got is a real collaborative nature to the industry, and people know each other. And it's quite easy to network in this industry, because there's always somebody knows somebody, and they also cross international borders. We've got the likes of Paolo, that was at Harvard Medical School. He worked with Agostino Piero, eminent professor at Sick Kids Children's Hospital in Toronto that we deal with. They're the #1 children's hospital. And, two people that have worked together previously. We've got another doctor who's looking at some lung conditions with us at St Kitts Hospital as well, who again work with Powerlaw. So that those two sort of good examples of I suppose also it was the same with Jim. I met Jim at a conference. We got chatting about his own difficulties with his own knee, and very soon after, I was sat down at a dinner at AstraZeneca with Joe Kelly, and Joe actually knew Jim. They'd worked together, so it's funny how these things happen. But I think it's quite easy in such a collaborative environment, especially when you've got something as appealing to what we believe Microgen's got.
Absolutely. And talking about this appeal, how do you cultivate this culture of this vision, perhaps amongst your team, amongst the directors, but amongst the rest of the team as well, in terms of moving forward and perhaps coming on board? You know, how do you cultivate that?
You're doing something that's quite compelling. That's got to be number one. You know, it's seeing. I suppose my own story was a big help. You know, I know it's anecdotal as far as
important
in the industry, but life-changing for me, absolutely life-changing. I mean, you're talking about that. You know, Steve's got patients that were career-ending injuries. You know, these are world-class athletes playing in the Super Bowl with career-ending injuries and getting back on the field and playing again. That is life-changing. And with your team, I suppose if you set it out with a company with an idea for a molecule, a small molecule drug, you go through the same procedure of discovery and taking it through all the clinical trials. And you never know, and we'll never know, to be fair, whether we get the success with millions of patients. You know, that will only come with a matter of time. But I think we've got more confidence than someone with a small molecule drug has, because there is history of making stem cell secretomes effective and regenerative for patients already. So it's not as if they are trying something new, but not something new that maybe they feel that the risk is less. Maybe.
Right. Okay.
But in terms of the scientists like going down rabbit holes, and sometimes you've got to stop them, but other times you've got to give them free rein, because that's how they discover things. So it's trying to get that balance right with, it's a bit, like I said, if you compare to technology, I've dealt with, I've had hundreds of mobile programmers, and if you leave them to develop a product, feature after feature after feature after feature just keeps getting added, and you think, well, hold on, we don't need that. You know, just let's stick to this, and we've got a good product. So I suppose that's the same with scientists. They will continually look and continually think about how many things we could achieve. But that will come with time for us. You know, what we want to do is get in the clinic, get to improve and save lives, and then just keep adding on with the different therapeutics that we produce.
So, Barry, so considering, you know, your past two, drawing on the insights and your expertise that you've had with the Hesketh Group and to Ergo, where, you know, you've grown it to hundreds of people in the company, you know, as Microgen continues to grow, how do you plan to scale that team effectively while ensuring the quality and specialized focus required for your work?
Mm-hmm. Well, I mean, the good thing is that I've had hundreds of people in offices around the world, in New York, Washington, Mumbai, Delhi, London, Manchester, Sydney. What we're doing at Microgen doesn't require a presence like that in other countries, and doesn't require the hundreds of people that we've had to manage previously. Because nice thing about this industry is, I mentioned earlier about collaboration. The big pharma companies and the big life science companies have got tremendous distribution channels, and it's doing partnership deals with them to license your products for that distribution. So they do all that heavy lifting that's needed, and we'll avoid that. You know, as Microgen, I've always thought if you have 50 people, you've got a good personal relationship with all of your team. Once you get beyond that, it starts to get more difficult. And I don't think we'll need more than 50 people. You know, we've done the modelling, and we think 35, 40 people in time will be sufficient, unless we start our own manufacturing facilities. But again, the industry is just full of pharma companies that can produce for you, as well as the contract manufacturing organisations. So we can be quite lean, and yet a bit like some of these new internet companies where they're turning over billions, and there's a handful of them in the office. So yeah, I think, and I'm enjoying this journey far better than previous journeys.
Why is that?
I wouldn't say because of that, but that's a contributing factor. I think the main thing has got to be the fact of what the industry is, and in business, a lot of the time you get people that just want to cut your throat. You don't get. I've found it really, really refreshing, this industry. Everybody wants to do good. I mean, crikey, if I had known now, if I had known at the beginning what I know now, I wouldn't be doing this, to be honest. I wouldn't. I'm glad I didn't know. I'm glad I didn't know how much work has needed to be done to get us here, because it would have put me off. I'm glad I didn't know, because to be involved in something that, it's easy to say, can be world changing. You know, you've only, one of our presentations, we talk about the report that was done by Harvard, Oxford, and I think it was UCL. Talking about delay growing old by 1 year globally has a positive effect of 38 trillion. Those are just crazy numbers. Fantastic effects. And when you dig deep under those types of reports, it's because people are working longer, so they're earning, they're contributing to society, paying taxes, and the spending. They're not falling ill as early as they would otherwise do, so they're not putting the pressure on the health services. It is a fantastic industry. It's definitely something to get you up out of bed in the morning. I mean, we're dealing with the world's #1 children's hospital and the world's #3 children's hospital, Sick Kids in Toronto and Great Ormond Street in London. And whilst we're doing aging, a lot of the underlying causes of aging are one of the presentations that we show shows the necrosis on a diabetic foot. Well, that necrosis is similar pathology to a disease called necrotizing enterocolitis, which is the biggest killer of preterm babies. Well, if we can have a positive effect on a disease that is an unmet clinical need, that's the biggest killer of preterm babies, I mean, what better to get up in the morning and sit at your desk if you feel that you can have a positive effect on children's lives. There's nothing more important than children for any parent.
Yeah, it's Can't think of anything more motivating. Yeah, you're absolutely right. I want to come back to something you said earlier in regards to personal relationships. How important do you think those are in building and growing a successful company?
Personal relationships.
Being able to have those personal relationships with your team, your employees.
Yeah, I was just going to say that it comes in two different forms, that, because there's personal relationships in terms of collaborative relationships. I mentioned Paolo and Agostino. In terms of your team members, I think there's got to be a respect between the two of you in a company. They've got to have respect for you in terms of where your skill sets lie, and you've got to have respect for them in their area of expertise as well. And that creates a positive environment. Far from it from me to question scientists on the real nitty-gritty science of what we're doing. Yeah, in terms of personal relationships, I mean, if you can all be friends when you're doing something as well, that does help. But sometimes not necessary either. You can have respect for people, because people have got different personalities, and some personalities don't go together as well as they could. But that's human nature.
It is.
I think get the right people in the right positions and give them the space to utilize their expertise. And I think it was one of the books that Facebook did, or about Facebook, and about making sure that the people that you work with do what they enjoy. Because otherwise you're knocking a square peg into a round hole, and that's not a recipe for long-term.
No, it's not. No, it's not. I guess, moving ahead, Barry, could you give me your thoughts on this statement? Be the dumbest person in the room.
That's you recognise me, did you? Then I often sit around the table with the people that are involved in the company. I do look around and I pinch myself. I do think, yeah, I am the dumbest person in the room here, especially when it comes to scientific matters. You've got to be. Well, if you've got to be. Obviously, I've got expertise in what I do.
A wealth of it, if I may say.
Yeah, but you need the good people around you. You need better people than you. And there's you can try and do too much yourself. And I've done that previously, thinking that I'm going to do the best. There's only me who can do this, and you don't delegate, and people do things differently than you do, and a lot of the time though they actually do it better than you, because if that's their area of expertise, and that's when you've got to let go and utilize the skill set of the people around you.
Was that learned? Did you learn that somehow, or?
Yeah,
I mean, I learned was, did you?
Without question, yeah. I am hands-on, and I recognise that is one of my. It's given me challenges over the years, yeah. Where I do like to pick up the banner and run from the front and show charge, and at times you can want to do things that should be in someone else's hands. So that becomes the art of delegation as you become more, let's say, mature in business.
Would you say that that's the biggest key of a leader?
That's a good question. I never give up. There's a leader, the determination that you've got to have is got to be second to none. You get knocked down, and you get up again. And as the song goes, you get knocked down and you get up again, over and over again. Yeah, when you believe in something, I'll give you an example. I mean, crikey, when we had a very successful company doing the world's first apps, mobile phone applications, and we did the first live sporting event on a mobile device. And in the city of London, when I first we sat down and explained that we were doing the cricket from against England from Australia, live event on a mobile phone, and every single institution and analyst, this was 2004, said to us, who would want to watch video on a mobile device? Can you believe that? Every single one of them said that.
So TikTok can thank you.
Oh, in 2000, I was with in Miami with the mobile networks at a mobile messaging conference, talking to the networks over there about text messaging and how we built these platforms to do cross-network billing and how text messaging was going to explode over there. And again, even these were the networks. These weren't just financial people. And we said, why do you not think it's going to happen over here? And they said, we'll tell you why. Because we've all got pages. That was the stock answer. We've all got pages. So, yeah, and it was only 2005, I believe, when the sale of mobile phones outstripped pages in America. So there's a timing. There's a timing thing, and if you're too early, you can be at the bleeding edge of the cutting edge. There's the cutting edge and the bleeding edge. And maybe when I started this, we were at the bleeding edge. And it's only now that there's thousands of papers from labs around the world confirming that that the work we've been doing in terms of stem cell secretome being responsible for regeneration repair as opposed to the stem cell itself. I've always liked being at the cutting edge, though, and that's the companies that I've built over the last 35 years, and this is no different. This is very, very much at the cutting edge of medicine, and I've always said it's the future of medicine.
Yeah, just one simple question. I don't know if the answer is going to be as simple. How do you get people to jump on board your vision and your mission? It might seem natural to you, but people you've gotten on board are remarkable. And yeah, you may feel like the dumbest person in the room, especially with those names, but how?
Well, you've got to give them the belief, first of all. You've got to give them the belief that, what you're doing and what you plan to do. When I first started, I obviously you've got to start with adding one person to the team and another and another and another. And story's got to be right. It's got to be believable. And I think as you build the team, more and more credibility gets added to it, and gets more and more credibility to your story. To your story, it becomes more credible. You know, the advisors and you know, our what's he called? Robert's our QP. Robert Smith is our QP, a qualified person for the drug manufacturer. Got Robert involved quite early, and I only found out later. It was a complete surprise to me that he was the QP for the government's stem cell catapults down at Stevenage, and he wrote the QP book. I can't say there was no skill involved from my perspective, though. That was pure luck. But again, the fact that of getting involved in the business and being our QP gave credibility in talking to other people that knew him, because he was well known, as is Professor Alan Boyd, who's our interim medical director. Alan was a past president of the Royal I keep wanting to call it academy, but it's not academy. It's the Royal Institute of. He was a past president and he's a fellow. It's everybody. Well, I say everybody knows him. Most people know him, and I suppose as you have these people all the time, it just adds credibility.
Yeah.
So story's got to be right at first. Build your credibility. I couldn't have turned around and recruited them all in one fell swoop. I think.
How'd you hire the first person then?
Well, again, Steve and Paolo and Keaton came as a bundle, because it was Steve's work. It was me saying to Steve, I'd really like to help you to get this out to more people. He'd worked with Paolo, he'd worked with Keaton. So those three straight away provided scientific credibility. And the fact that Steve's work, the effect that Steve was having on leading sports people and me. And actually, from the investment perspective, it's a good question, because my friends, right at the very beginning, I met individuals. I brought some of my best friends in. Always difficult in a business, but what I said to them was, you can't invest more than me, and you can't invest more than you can afford to lose, because if this doesn't work, I want me to be the biggest loser out of the two of us. So I've got my very best friends invested early doors, and then there's as we started to talk with higher net worth individuals that everyone knew. Quite a lot of them knew me historically, not only from the fact that I've made money for them in the past with other businesses that they'd invested in, or I'd worked with different people. The other thing that added credibility to the story rather than the team was, a lot of those people had seen me wearing a leg brace, and over the years, and had known of the difficulties that I'd had, and they'd seen the effect that Steve's treatment had on me. Yeah. So again, I suppose, that the first person, you've got a good scientific team, you've got me that's can add the commercial credibility. I've founded companies and sold companies. I had difficulties in this. I've had difficulties as well in business, many difficulties and challenges that you face. I made my first million when I was 28, and I lost it at 29 in the crash at the end of the 80s. So that teaches you a lesson or two. Yeah, it's been an interesting journey, but it just gets more and more interesting.
Yeah, definitely. Look, as we wrap up our discussion today, I just have two more questions. Could you share what has been the most gratifying aspect of your journey with Microgen so far, and how this venture compares to your two past ventures?
In three past, we've got two IPOs and company sale in the last 20 years. In terms of how it compares, we're talking about different. This industry is fantastic. I just love the industry, as I mentioned earlier, because of the attitude of everybody that's working in it, and that had the most profound effect on me, and I didn't even realise that when I came into the business. It was just nice to have people that want to do good. I forgot the first part of your question. Can you? Gratifying aspect of your journey. What's the most gratifying aspect of your journey? I suppose that is quite gratifying. And I mentioned earlier about the saving babies' lives. Yeah. I mean, I've got two grandkids now. And, I've got my own children, but I've got grandkids, and there's just nothing more important in life. It is, what better to get out of bed in the morning to do. So, if we can work in at the other end, we're doing neurodegenerative diseases, the research there. And, one of my real targets personally is Alzheimer's and dementia. I've had, as so many of us, has been touched by that. Because it doesn't just affect that one person, it affects all the friends and family around that person. In fact, it affects that person less than everybody else. Yeah. So if we can have a positive effect on neurodegenerative diseases, it's a great legacy. I can, in time when I sort of hang up my boots, I can say, I had an hand in that. Yeah, fantastic. Inspirational. Look, finally, after all of this leadership innovation talk, could you offer one piece of advice to individuals out there who are wanting to start something? I've just been asked to speak at one of the universities they run an entrepreneurial course, which I'm going to do in December. Being a CEO of a business can be the loneliest job in the world. It can be tough. It can be tough because you can hear what everybody else has got to say, you can get everybody's opinions, but at the end of the day, you've got to make that final decision. And when you make it, there will be probably the major proportion of people will agree with what the decision you've made, but the people that have given any counter arguments won't agree with what you've said. So you've got to be prepared for that, and you've got to go into this if you're prepared to never give up. Yep. Never give up. It's if you go about things not thinking, I must do this and I must do that in the business. Sorry. Rather than that, rather than saying I should do this and I should do that in the business. No, you must do this and you must do that, and you've got to do it as opposed to you should.
Just that never giving up, that perseverance.
You've got to have perseverance. If you're going to, when you set out in business, I always thought, oh yeah, right, okay, I'll sell up and I'll retire when I'm 25 and live on a beach. I mean, that's
worked out well.
That's 40 years ago. That's 40 years ago. And I'm never going to hang up my boots. I'm never going to give up. And because it's part of the makeup, really. From my engineering days, I qualified as an engineer, and I can't look at anything now without thinking how it's made. That's still, after 40 years, I look at whether it's a chair and whether it's some newfangled device that you might see advertised. I always think, oh, I wonder how that's made. What's the most expeditious method of manufacturing that? How can that be improved upon? How can the functionality be improved upon? And that's just my inquisitive mind and my business mind. So I'll never turn that off.
Well, look, Barry, it's been an absolute pleasure.
What if you could simplify your capital raising? CRIISP Capital HQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
So yeah, welcome Daniel, and welcome to anyone tuning in for Capital HQ. It's really a pleasure to have you here. I think what would be great is for you to introduce yourself.
Sure. Yeah, my name's Daniel Hume. I guess I have over 25 years of experience in AI research. I started the company 15 years ago. That's been building AI solutions and small companies. We were acquired 2 years ago by WPP, the biggest media marketing company in the world, where I'm the chief AI officer. So I'm the CEO of Satalia still, so essentially WPP's DeepMind. I'm also coordinating AI across 120,000 people across WPP, and I get to do angel investments now into AI startups.
All right. So quite the big responsibility there. And I guess, the questions today are meant to be broad because you are one of the biggest experts in AI in the world. So just want to scrap your brain as much as possible. So look, I've broken this down into different topics. The first one is the broader economic and workforce impact of AI. So in terms of recent reports, including from the World Economic Forum, Future of Jobs report, indicate that nearly a quarter of all jobs globally will change in the next 5 years due to technological advancements. How do you foresee these macro trends impacting various sectors, and how should companies prepare for this shift?
I think, first of all, it probably takes a little bit longer than what people think. The economic cycles, investment cycles, organizations probably, trying to unlock the money to implement these technologies, getting them right, getting them wrong. It takes longer than probably 5 years. So, but I do think that AI is a new energy resource that we're tapping into, even though it's been around for many years. And that energy resource means that I think, sorry, I've got a parrot that sometimes says hello, and that energy resource is going to allow humanity to grow in new, and it is allowing humanity to grow in new and exciting ways. And with growth comes disruption. So I think jobs will be displaced, they will be disrupted. But my guess is that there's going to be more and more opportunities for people to apply themselves, to use these technologies in ways that allow them to contribute more positively to humanity.
Right. Yeah. I think, you're absolutely right about, I think 5 years, we're going to start seeing some changes, but the broader impact will be further down the line. Just ourselves, we've put off actually hiring some marketing because we can now run it through AI, which is pretty, at our little tiny level, we've put off hiring for one job because, it can do it now. And we just need someone to supervise it. So for us, that was quite interesting. And this was only 4 months after the release of ChatGPT as well. So who knows what's going to happen. But, we've just talked about how it's going to change jobs and perhaps make some redundant, but it's also going to create new jobs, right? So the survey also suggests that AI could be a net job creator in the coming years. So what types of new jobs do you predict will emerge? And how can companies gear their talent development to meet this demand?
I guess that's what I mean by growth. By growth, I think that new opportunities will arise for people to be able to contribute in exciting ways to humanity. I mean, it's actually hard to predict what new jobs might be created. But I think that what's going to happen over the coming years is a much more flexible, fluid workforce. So people's ability to contribute in more granular, fluid ways, as opposed to being a role, and that's what you do in your job. I can be several different roles, and I can apply myself in multiple ways. So I think that's also going to provide unlock growth, and again align people's interests, aspirations, hopes, dreams with work in a much more effective way. I think that because AI is all these flavors of AI do allow you to innovate. I think that people will come up with new innovations that again will unlock the creative capacity of more and more people. So I can't necessarily predict what those new jobs are, but you can imagine that the cost of being able to create innovations and get them into production is dramatically reducing. And so somebody might realize that there are people, let's say, in old people's homes that are, sitting around potentially not being engaged or excited. And there are people on the flip side that might want to learn skills or languages. And so now somebody could boot up a platform that essentially brings those two types of communities together. So you are able to now create new technologies, new platforms, which gives you work, and you're able to now give work to people that probably found it difficult to access work. So maybe older people can now actually work and impart their experience, their knowledge to people that might want to learn that.
Yeah, no, that's very interesting. I think just on my note, I learned how to code a bit of Python just by asking ChatGPT to put a course together for me. So that was, so I can see the impact being quite broad. I also love that you have a parrot at home. It's brilliant.
I've got a few of them. They might say hello at some point.
All right, fantastic. Look, in terms of, we've talked about occupations, the new occupations as well, although we can't predict them. So as workers move into different occupations and maybe they have multiple, as you've mentioned, what advice do you have for professionals seeking to reinvent their careers?
I think certainly what we're seeing in WPP, which is the creatives that are really we're seeing thrive are the ones that are able to ask better questions of the AI. So those creatives that understand art history, photography, understand lighting, aperture, camera angles, they're able to engage with AIs and ask it questions, extract knowledge from those AIs in much more interesting and impactful ways. They can talk about an artist that you or I have never heard of. The AI will have heard of it and be able to kind of surface that very, very quickly. So I think that learning how to better use and ask questions of these AIs, whether it be creating imagery or text or code, I think is going to be an important set of skills, and that I guess may require a broader perspective of humanity and different disciplines and topics.
Right, and we've just talked about the individual here, what they can do, but how can employers, companies help best position their workforce to work alongside AI? What should they be doing when looking at, augmenting the human instead of replacing the human, perhaps?
So I guess that there are the AI can be used to improve productivity. So it can be used in our tools like Office and Word and all that kind of stuff to help us be faster at writing emails and creating PowerPoint slides, et cetera, et cetera. So I think capacity is going to be unlocked in that way, and organizations might want to think about using that capacity not to kind of do more kind of utilization, but to kind of have people go and train and do innovation and R&D. So productivity is going to be improved, and with that improvement in productivity, the question is, what's the best use of that time? And then also the AI is very good at alleviating frictions or inefficiencies. It's also very good at making things more effective, changing the way that we do things, again, freeing people up to be more creative. And so I think that we need to foster our work forces, our processes to utilize the creative capacity of humanity. Just going back to your example of, you didn't need to hire a marketing person because these tools can do some of those marketing tasks. If you kind of expand and give yourself a kind of a thought experiment that marketing stack is completely commoditized. If everybody had access to the ability to content, predict the activation of that content, push that content out across channels, if everybody had access to that technology, the only differentiator is human creativity. Human creativity will become a premium. So I think that organizations need to be thinking about how do we best unlock human creativity. Yeah, and prompt engineering, I guess, it comes into that as well, right? I guess that goes back to the point of how do we better ask questions of the AI, and that's not just about kind of technical ability. It's your knowledge of, again, artists, of aperture and lighting that help you create better content. Yeah, absolutely. One of our designers, I don't even know where she was starting, but she was like, use this Nikon SX1000 with contrast 245, and it produced a brilliant image. But you need to know, and I think that's absolutely right. Now moving on, maybe to, obviously a lot of companies have legacy systems, and the more we move on, today's systems are probably going to become legacy. Given the complexity of integrating AI into those, what strategy do you recommend for companies looking to modernize without necessarily disrupting? I think my worry is over the past several years, I've seen organizations try to build data lakes and then put some sort of analytics layer on top of it and hoping they have AI, or hoping that by extracting better insights from data, it will lead to better decisions. Now, I have a relatively controversial view, which is, for the most part, giving human beings better insights doesn't always lead to better decisions. That's not always true, but humans are good at making certain decisions, but we're not good at making other types of decisions. And I'm a big advocate of solving the kind of decision-making problem, which is what AI is really good at. And so I think that what needs to happen is organizations need to identify what opportunities there are across their supply chain, and then solve those problems over time and build out their data and analytic capabilities. So don't start by building a data lake and putting analytics on top. Find opportunities to apply these technologies that drive real value, but make sure that over time you're building infrastructure that is future proofed. And you just have to go on that journey. So you have to move and migrate your legacy chunk by chunk to this new world. I don't think that migrating it all in one big go and creating a data lake is necessarily the right approach. I think data lakes ultimately the right things to be building, and analytics layers are very, very powerful. But I think you need to make sure you're building towards them in a way that is going to guarantee driving value. Yeah, you've just
talked about. Could you actually elaborate on why you believe AI is a great decision-making partner tool?
Let me give you an example, some math. So if I let's imagine you've got some employees, you've got 5 people that you need to allocate to 5 jobs.
Yeah.
There are 120 possible ways to allocate 5 people to 5 jobs. So 5 times 4 times 3 times 2 times 1. If I have 15 people in my company to allocate to 15 jobs, there are now 1 trillion ways. If I've got 60 people to allocate to 60 jobs, there are now more possible ways than there are atoms in the universe. we have many of these decision-making problems that exist across our organization. Right? Any decision problem that involves more than 7 variables, 7 people in this case, then it becomes intractable for a human being to solve. So you shouldn't be using human beings really to solve those problems. You should be using AI. You should be using optimization, and there are many of these types of problems that exist across many industries that human beings are solving, or they're using algorithms that were invented many years ago. That if more modern algorithms or more modern AIs were applied, then you would significantly move the needle.
Interesting. In terms of moving to the ethical side of it a bit, and I spoke to one of your friends, Callum, who didn't really like the word ethics when it came to AI. He thought it was something. Anyways, it was just quite an interesting one. But as companies navigate the ethical deployment of AI, what frameworks or guidelines should they follow to ensure they remain on the right side of this evolving conversation?
So Callum can convince me that there's no such thing as AI ethics. So I don't know what he said to you, but I think ethics is a study of right and wrong. And the big difference between a human being and an AI is that human beings have intent, AIs don't have intent. And it's intent, it's the intended use of these technologies, the intended way of solving a problem that needs to get scrutinized from an ethics perspective. And there are already well-established ethical frameworks to scrutinize intent. Once you then implement a solution, whether it be a people solution, an AI solution, or any solution, then if that solution misbehaves, it's a safety problem. What you've done is you've implemented a solution that is not designed and is operating in the way that you want it to. And so there are 2 ways of solving for that, or 2 questions that you need to ask yourself. One is, can I make sure that my systems are explainable? If I can make sure that my AIs, I can explain how my AIs are making their decisions, then I solve a lot of the problems around AI safety. And AI explainability is a hard problem to solve, but it's something that I've been thinking about for a long time. So making sure that you're building AIs that you can explain how they're making a decision is critical. And then the other question that you need to ask yourself is, if my system goes very well, if it overachieves its goal, what harm can it cause? Most engineers, when they're developing systems, they think about the failure points. What happens when it goes wrong? And we try to then build systems that have constraints for when it goes wrong, that it doesn't cause any harm. That what we need to think about now is that if it overachieves its goal and goes very, very right, can it also cause any harm? And again, that's an engineering problem. It's not an ethical problem. So there's a lot of hoo-ha. There's a lot of people that have rebranded themselves as AI ethicists. As far as I'm concerned, ethics, there's already a well-established set of ethical frameworks. And the 2 questions you need to ask yourself when developing AI are, is it explainable? And have I engineered it in a way that makes sure that it's going to operate how I want it to operate? Now, broadly, and over the past several years, I've developed a number of frameworks to think about AI. So one framework is how you can identify the right applications of AI to solving problems across your supply chain. I won't bore you with the details, but I believe there are 6 categories or 6 applications of AI that pretty much cover your whole supply chain. And with each one of those different categories, there are different safety questions and security questions. And so there are deploying these AIs into your organization and they're operating in ways that are correct. So there's micro considerations. There are what are called malicious risks. So making sure that you're mitigating bad actors using these technologies to create pathogens and cybersecurity and misinformation, and that's typically the role of government. And then there are what I call macro risks, which are what are the medium or long-term impact that these technologies might have on society. So could we end up creating a super intelligence, or or what impact will it have on jobs, or will it create a post-truth world if we are awash with misinformation? And again, I believe that there are at least 6 macro risks associated with AI. Again, I think that it's both to do with government and industry to address some of those macro risks.
Okay, you just mentioned super intelligence there. Could I get your maybe definition of it, and if you think it's going to be a reality, and if so, when? Or not if so, when, but is it in 10 years? Is it in 50 years? Is it in 200 years? Or is it never?
When I was doing my PhD 20 years ago, I thought that building general intelligence was 250 years away. And I guess every year that goes by, I shave a decade off. I think my community felt super intelligence wasn't going to happen for another 40, 50 years. We probably think it might not happen in the next 10 or 20 years. I think that what we might see with large language models, and large language models, I think, are one type of AI. There are other types of AI out there that are actually emerging from academia that I actually think are much more likely to spawn a super intelligence. But the large language models are it's like having an intoxicated graduate, and that over the next few years is going to become like a master's level, and then a few years later it'll probably become like a PhD level. A few years later it's going to become a professor level. So if in the next, let's say, 8 to 10 years we build an AI that is a professor level in every single discipline, then the next obvious question you would ask it is go and build a smarter AI than you. And then there is a concept called the fast takeoff, where we go from general intelligence, as intelligent as human beings, to something that is, a million times smarter than us. So I guess the definition of a super intelligence is something that is much, much smarter than the collective intelligence of humanity. Now, some people also think that you don't necessarily have to have consciousness, sentience, to have super intelligence. You could build a machine which has an objective, and the classic example is to build paper clips. It could be very, very, very smart at building paper clips, and uses up all of the resources in the world to build paper clips, which might then destroy itself or destroy humans. But then some people think that super intelligence, you need to have consciousness or sentience, and I guess I'm interested in those two flavors of super intelligence, and actually whether one is more beneficial than the other. But I think my feeling is that we might end up creating a super intelligence in the next 10 to 20 years, and it's something that I'm very, very passionate about, and actually thinking about how do we create AIs that allow us to mitigate the risks associated with super intelligence.
And you talked about just now that university papers, research is coming out that you believe will get to a super intelligence before that. Could you maybe talk a bit about what those are?
I guess I'm what I was saying is that large language models are a very, very powerful, exciting direction of AI, but they are not necessarily, whilst they're neural networks, they are biologically inspired in some respects. They're not how brains work. So biological brains don't propagate numbers. We propagate spikes, and if I show you an image, I don't activate your entire brain, which is what happens with large language models. I activate only small portions of your brain where that's relevant. And so our brains are incredibly efficient. Also, we're very good at dealing with continuity, with spatial and temporal reasoning, and we learn very, very quickly. So it only takes a few examples to show a child, some object before it is able to kind of generalize what that object is. With large language models, it takes many examples for it to know what it is. So there are emerging technologies from academia over the past 10, 20 years, they are called, it's called neuromorphic computing, that is more aligned with how biological brains work, and that is to do with spikes or spiking neurons or spiking neural networks.
Well, that's too. I don't understand that, but I'll take your word for it. Like we talked about the ethics of it, and you mentioned the 6 different kind of frameworks, applications that you've developed, right? I was wondering, where does data privacy come into all this, and what are the best practices for companies to utilize AI without infringing on individual rights generally?
I guess, I mean, it depends on what AI we're talking about. I think, if we're talking about large language models, then we work with partners to have our own instances of those large language models on infrastructure that's safe, that's wall gardened. So we're not uploading data to the internet. We're managing where that data goes and how it's being accessed. The infringing of people's rights when it comes to large language models, I guess, is if you're creating content, whether it's ads or anything that from large language models, but it's been trained on information that's copyrighted, you might inadvertently be infringing those copyrights. And in WPP, we are very, very, very careful about the language models that we use, making sure that we're using models that we understand the provenance of where the data has come from. With respect to different parts of our supply chain, for when we're ideating and things like that, we can use certain types of large language models where we don't necessarily can attribute or understand the provenance of data. But if we're creating ads that we're putting out there, we need to make sure that we're not violating copyright. So we're very careful about using the right technologies at the right part of our supply chain.
Right. Okay. And so maybe elaborating a bit more on that, I was talking to a friend who's just started a job in the AI space, and we were talking about simulated data. What's your take on simulated data compared to where it could be compared to actual data? Could it be the same level as actual data further down the line?
I mean, there's a kind of a self-fulfilling prophecy around simulated data, right? That creates an unfortunate kind of feedback loop, which is you're training an AI on what it wants or what it's producing. There's nothing like real world data to help you identify corner cases and scenarios where things might go wrong. I think one of the classic examples that I don't know how true this is, but you have a Tesla that is able to recognize stop signs, let's say, and it was sitting behind a van that in the back of the van had a load of stop signs, and so it wouldn't move because it recognized these stop signs. Now you wouldn't have thought creating in your simulated data a scenario where you had a van in front of you with loads of stop signs in the back. So there's always real world examples that you won't necessarily thought of. So there's nothing like the real world to really to keep you honest. That said, the simulated data can get you a long way, and can help you build AIs that are very good and very useful.
Okay. Great. Now let's move on maybe to more of some of the business applications or just different industries. So the first one is decentralization. So AI and decentralization. So in light of interest in decentralization, how do you envision AI influencing the move towards decentralized business models compared to traditional corporate structures?
I'm a big fan of decentralization. I think we need to make sure that you have the right application.
Yeah.
But I'm also a big fan of how organizations should be decentralized in terms of how they operate. I think creating liquid workforces, decentralized workforces, enable you to be more adaptive to a rapidly changing world. But there is something very important here about the concept of decentralization, or maybe even the open source movement, which somehow is linked to that. Which is I don't believe that necessarily technology the differentiator. So we all have access now to open source large language models, etc. The differentiator is two things. One is the data, and so going back to this idea of simulated data, you can simulate actually it's real data that will make these AI smarter. That really is your defensible moat. And the second is the talent that you use to use these technologies to create differentiable businesses. So it's data and then talent. So what we are going to see more and more of, I think, is organizations realizing that they can't compete. To compete with organizations that have captured a market, that are generating revenues from some technology, the only way to compete with them is to make it open source and make it free. Because what you then do is you take their users, you then are capturing the data, which is valuable to you, and hopefully you're also capturing the talent as well, because you can create a pool of talent that is then innovating that technology because it's open source. So I actually think that we're going to see more and more open source happening, which is a good thing because it makes these technologies more and more abundant as well. If we can make these technologies accessible and free to everybody, it just, in theory, raises humanity to another level.
Yeah, it makes you think, doesn't it? And this might just be me not, being very well versed in this, but don't a few companies hold the majority of data?
They do, and so how do you compete against them? Is that you stand up an offering that is free to take their users, so that then you're collecting data. If they are sitting on data and they're selling their wares, you're licensing their wares, but if you want to capture their market, then you need to offer something that's different. And what we're seeing is an offering that is something that's free, because people are realizing that it is the data that is ultimately valuable in the future.
Interesting. Yeah. I could be sitting here all day trying to think about it. But anyways, in terms of moving back to, that was an outside the box question that I know piques your interest a bit. Coming back to just strategic advantage for companies, right? So how they can leverage AI. Deloitte's insights suggest that bold enterprise-wide AI strategy is crucial for general transformation. How should companies approach the development of such a comprehensive strategy? And what role does top leadership play in this process?
I think really there are three aspects of a business that should be looked at from an AI perspective. One is productivity, and that's bringing AI into the day-to-day tools that we're using, back office processes, all that kind of stuff. The second is looking at your supply chain, the flow of goods and services across your unique organization, and where you're going to buy technologies off the shelf to solve some of those inefficiencies, or you're going to build them yourself, or you're going to you buy from a partner. That is the battleground actually for most organizations, is where they should be applying AI and building their own proprietary solutions that will differentiate them from their competitors. Right. So and then the which is essentially your digital transformation. And then your third part is if you're fortunate enough, like we are in WPP, the CEO said, go away and figure out how does AI completely disrupt it. So you've got productivity, which is commodity, will be a commodity, because everybody will have access to these new AIs that are embedded in our tools. The second layer is your digital transformation and making the right bets around how it will differentiate your business and what you should defend and what you should let go of. And then the third is how is this going to completely disrupt our entire organization and industry.
Right, and I think this follows on in terms of a report by TechCrunch emphasizes the importance of hyper personalization in AI applications and with regards to enhancing customer experience from a company. So how can companies align their AI initiatives, with broader business strategies to personalize their customer experience?
Well, I think ultimately most organizations have a load of inefficiencies, loads of opportunities to improve effectiveness. And it's not an intractable problem to sit down and work with different stakeholders to kind of list all of those inefficiencies. Sometimes they touch the customer, sometimes they don't, but any inefficiency that you alleviate, even if it's kind of deep inside the supply chain, in theory, that's a cost saving that might ultimately pass on to the customer. So I think going through that process of identifying the opportunities of AI, prioritizing those opportunities according to criteria like, is the data available? Do I have the skills to solve it? What's the value to the business? What's the value to the customer? There's a set amount of criteria that you can use to then prioritize them, and then starting to knock each one off, solve each one, and then building your AI infrastructure over time. In theory, all of those benefits will be passed on somehow to the customer. And if the direct customer experience is important to you, then that's just one of your criteria, right? Do I do this project because my customers will immediately feel the benefit, and therefore you should prioritize that over others.
Yeah, so just general business strategy with AI sprinkled on top.
It's exactly. It's ultimately it's the business strategy is to become more effective, more efficient at delivering goods and services to my customer, and AI is a tool to allow you to do that.
Yeah, so I think speaking about efficiency, your three things are productivity, supply chain, and then the last one was a longer one, but it's more so around innovation, perhaps, or the freedom to innovate.
It's disruption. It's
disruption.
You might have a strategy now, and you might be able to optimize your supply chain and become very efficient. But is there a scenario where your business model is going to be completely disrupted by somebody that's come along and done it differently? Right. I think maybe 10, 15 years ago, people would call this innovation or open innovation, where they would kind of carve out an innovation team and get them to sit in a different building and try and protect them from the corporate bureaucracy. And then their job was to go and disrupt the organization. I think that's absolutely relevant now, particularly with regards to AI for some industries. And so I think that genuinely AI is a threat to disrupt entire business models, and there are some industries and some organizations that should be investing in that.
Yeah. So you said that's a keyword, though. For me, it's the should be investing in that. Some, as you mentioned, some companies don't maybe have the liberty of doing both, right? So, yeah. What framework would you recommend for businesses to balance the two objectives of productivity, efficiency, and then on the other side, disruption/innovation?
Well, I think productivity and efficiency is that's a sort of bread and butter at the moment. So people are looking at bringing Copilot and whatnot into their organizations. When it comes to looking across their supply chain, there will be opportunities there to build differentiated solutions, and it might be some of those differentiated solutions could become their own businesses. So if you go and solve a problem, and that's what Satalia has been doing for many years for organizations, disrupting supply chains, and where they've solved a problem that is differentiated in the market, the question is, well, should you productize that or platformize it, and then it become its own company that will then generate its own revenues and maybe even grow into something that disrupts your industry. So, for example, one of our clients, one of my favorite clients, is DFS. It's a sofa manufacturing company here, a furniture company here in the UK. And over the past 10 years, we've been going on a journey of solving problems across their entire supply chain. Now, DFS have created a separate company called the Sofa Delivery Company that they have platformized that capability that is now delivering sofas beyond DFS, and I think that organizations should probably start with looking across their supply chain, what really matters to them, where they should really genuinely be differentiating themselves, and then that might be an opportunity for disruption.
Okay. Is there any other stories like that? So not stories, but case studies such as DFS that you can share? Because those are quite interesting to hear.
Tesco many years ago approached us to help solve their last mile problem. Tesco had an incumbent solution. They know that solution wouldn't be able to scale in the way that Tesco wanted to scale, and they actually knew that they needed to build something themselves that they had control over. Last mile delivery for them is an incredibly important and differentiated part of their business. It touches the customer, both on their website and also, the delivery experience, and they wanted to have control over it. So we helped build their last mile delivery solution using the latest and greatest AI technologies that they've internalized inside Tesco and have continued to innovate that technology. Very, very sensible thing for that organization to have done.
It is indeed, yeah. I'm sure you have many more, but we could be here all day. Look, in terms of the business strategy side of the conversation, we put that behind us now. Just now it's going to be outside the box questions, so it'll be a bit everywhere, just on your opinions on it. So first of all, some of these are bigger questions. So for example, the philosophical impact of AI. So as AI continues to grow, do you believe it will prompt a philosophical shift in how we view work and productivity? And if so, how?
What I would like to see happen is incentivizing the application of AI to solving problems like food creation and distribution, healthcare, education, these things that we need to survive and thrive as human beings. If there was a way of incentivizing more and more startups to innovate in that space, it probably means that those innovations will use AI to make them more. So if we can bring the cost, if we can make it more efficient and effective to create and disseminate food, healthcare, education, transport, etc., we can bring the cost of those goods down to almost zero. So in a world where the government doesn't necessarily have to create a universal basic income to support people that might not be able to work, all of their goods that they need to survive and thrive are almost free, because we've managed to innovate, use our smarts to make them available. It's referred to as a world of abundance, and Callum, who you've spoken to, refers to this concept of fully automated luxury capitalism. There is a book called Fully Automated Luxury Communism, and there is an argument that actually these two perspectives converge together in some endpoint where we have a society, a world of abundance, and so that's what I would like to see happen.
And when I spoke to Callum about the fully automated luxury capitalism, I think one of the things he mentioned is that most people will not be needing to work further down the line. Do you see it like that? As in, like, the creators will be free to be more creative, and other people will be free to enjoy different leisures, services, and stuff like that, but they won't necessarily need to work. What's your take on this?
I don't know what the world looks like beyond 10 years. I think that we're going to see a Cambrian explosion of innovations, new opportunities for people to find and do work, paid work over the next 10 years. I think beyond 10 years, it's hard to predict. I guess there's one camp, which is we should be freeing people up from paid work, enabling them to live in a world of abundance. And people often say to me, Daniel, what would I do if I didn't have to work, right? What work defines who I am as a human being? And I know lots of people who don't have to work. They've built companies, they've sold them, they've made money, whatever. Yeah. They're not sitting at home bored and depressed. They use their time and their energy to try and contribute to humanity. And I ask my audiences when I do lots of keynotes on these topics, what would you do if you didn't have to do paid work? And people will still work. They still write poems and play golf and spend more or less time with their friends and family. But people do still do stuff. and whether that's paid or not, it sort of doesn't matter. You still work, even though AIs can write poetry maybe better than us or play golf better than us. It doesn't stop us from enjoying writing poetry and enjoying playing golf. And if you keep pushing people, what else would you do if you didn't have to do paid work and everything was abundant? People usually say the same thing, which is they want to try and do stuff that contributes to humanity. And I believe that we all have an innate desire to want to make the world better. And I think there are too many people born in this planet, on this planet, that are economically constrained. And if we can remove those economic constraints by giving people access to food and education and healthcare and transport for free, then I think that those people will then direct and apply themselves in ways that might want to contribute to humanity.
So question for you is, what would you do if you didn't work?
I do exactly what I'm doing now. So I'm very, very, very lucky that I do what I want to do, and so I'm very fortunate in that respect. So I'm super happy. But again, most people do say the same things, and it's some balance that we're all kind of familiar with. It's to exercise and spend time with people and play games and read books, but there is this kind of additional thing, which is I want to do something that makes the lives of other people or animals or the environment better. And I don't think we are free enough necessarily economically to go and do that part, which I think actually for me brings true happiness. Now, I'm not saying that we should all go and contribute to humanity, but there are too many people born into the world without even the opportunity, or maybe even ever having the opportunity to contribute to humanity.
Absolutely. I think at the end of the day, people will still need a purpose, right?
Yeah, I say I know lots of people don't have to work, but they don't have no purpose. In fact, actually, many of them are even more purposeful than what they've ever been.
No, absolutely. In terms of maybe one or two examples of the question I'm about to ask, but can you share your thoughts on how AI could be leveraged to address global challenges such as climate change, pandemics? You've also mentioned food security a bit there, but maybe within the next 5 to 10 years, how do you see AI leveraging and addressing global challenges?
Well. First of all, so I did a TEDx talk a few years ago on the macro impact of these technologies. So I've at least 6 macro challenges there that I identified
out of the backpack.
No, indeed. But I mean, so I think if we apply these technologies in the right way, we can reduce the amount of carbon significantly from the creation and dissemination of goods. And the reason why I know that is because when we go and solve like the last mile delivery problem for Tesco, or workforce allocation for a big company, we can typically reduce the amount of carbon by 25%. And if you can then co-optimize across supply chain, so make entire organizations optimized, you can get a significantly more amount of carbon reduction. So I think that if we were smart about applying these technologies, we'd be able to reduce the amount of carbon so much that we'd easily get control of our ecosystem. There's so much inefficiency that exists in how we operate that AIs could solve for. AIs are being used to try to figure out how to create nuclear fusion. They're being used to advance medicine. I have a personal interest in misinformation and how AIs could identify whether a piece of content is going to be problematic, it's going to trigger a community, and how you could then use blockchain or some other mechanisms to then authenticate that content before it even gets out there and starts causing harm. So I think that AIs could play a part in mitigating the risks around misinformation and deep fakes and a post-truth world. So, and like any tool, it's not good or bad. It's how we use it that is the most important aspect. And I'm very hopeful that human beings will figure out how to use these technologies in a way that will have a net positive contribution to humanity.
Yeah, and I think that, again, the keyword there for you is the net positive, which I find it very interesting, because my next question was going to be about how worried are you about bad actors in the space, and maybe your colleagues around you who are experts in AI as well. How worried are they about bad actors either developing or using AI?
I think it is an absolute, concern. You have to ask yourself, why do people do bad things? Maybe they are broken in some way, psychologically damaged, or maybe they do bad things because they need to feed their family, and that's the only way to survive. Or maybe they do bad things because people have control over them and they can determine their economic constraints. Well, if you can free people up so they don't have to worry about getting money to feed their family, or if you can free people up where you don't have power over, where somebody doesn't have every power or economic power over them, then my guess is that those people will do good things. And it's probably more around the people that are psychologically damaged that we need to be mitigating risks around.
Great. Look, one last question, which I ask everyone. What's your single biggest advice you would give for a company navigating the next 5 years with AI?
Have a purpose. Have a really strong purpose. It's your purpose that will attract customers. It's going to attract talent, and try to make sure that the decisions that you're making, that you're bringing these technologies in pragmatically and not just kind of getting seduced by the hype, but try to align those decisions with your purpose. And I actually believe it's the collective purpose of enterprise that will make the world amazing for all of us. If you think about the purpose of the brands that you consume from, if AI can help you accelerate towards and achieve that purpose, it's the collective purpose that will make a world of abundance.
Yeah, and then it will be translated into allowing people to have purpose to do different things.
It's a glorious, virtuous, positive cycle.
Best virtuous circle we can get to. Look, Daniel, it's been an absolute pleasure. Thank you very much for joining us today.
Pleasure. Thank you.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
So, welcome everyone to today's session of CapitalHQ Masterclass on asset-based financing. I'm Hugo, I'll be your moderator for today's session. We're here to explore the intricacies of asset-based financing, a key strategy for businesses looking to leverage their assets for growth and stability. Today, we've brought together industry leaders to share their wisdom and experiences with this financial instrument. So first, I want to begin by introducing a leader in the field of technology and finance, Jan Zulko. Jan is the CEO and founder of Everphone, an innovative company that's pioneering the device-as-a-service sector. And with a proven track record of driving growth and operational excellence, Jan's leadership has seen Everphone scale new heights in the B2B market.
So, hi everyone, I'm Jan, I'm the founder of Everphone. I founded Everphone 8 years ago on the premise that it is very complex to manage mobile phones in corporate settings. So if we think about what does Everphone do, simplified said, we rent out mobile phones. And that now sounds like something very simple. You buy a phone and you rent it out. But the true complexity on the side of companies is that it's not just going into a shop, buying a mobile phone, giving it to the employee and the employee can use it, but it's actually that, first of all, the mobile phone has to, and mobile device management has to be put on the phone. The right apps have to be installed. It has to be sent to the address of the employee if they're in the home office. The logistics have to do at the end. The device has to be wiped again from the data that's still on that, has to be refurbished and reused. So the entire life cycle, as it's called, is a very complex process for companies. And all of this, of course, has to be managed. The assets have to be managed. The company needs to know which employee has which device, and so on. The second thing that is always a problem for companies owning the devices, of course, the financing part. As often when employees leave the company, they give back the company-owned phone, of course, as they should. But then the company is stuck with a relatively new mobile phone. So what does the company do? They can't just sell it on eBay. So in the end, what they do is they simply, it's usually stays in the drawers of the company. So Everphone thought of a solution that solves all these problems in one step. And that's, in the end, Everphone buys the asset. Everphone goes deep into the processes of the company to understand which software has to be installed, which mobile device management is needed, which cybersecurity needs to be on the device. But we all manage this. We directly interact with the employee. And this is crucial for this session, of course, we own the phone. So at every given time, we own the phone, and we basically give a usage license to the users to use this device. And there is one great aspect: full flexibility. If an employee leaves the company after 6 months, they give back the device to Everphone. Everphone doesn't charge the company anymore. That's simplified said what we do. So in the end, we do the entire management of the devices and the financing part. Of course, as you can imagine, by now we have roughly 400,000 devices under management. Those are a lot of phones. The average phone is about $400 to $500. So we need a big debt facility to finance all these assets. And especially with part of the revenues at the end of the life cycle, the residual value of the phone in the end, this makes it a relatively complex financing structure. And this is what Dietmar and Veronica is going to tell you about in the session today.
Great. Thank you very much, Jan. And for anyone who's interested, any founders or even investors interested in working with you guys, how would they go about doing that?
Yeah, so mostly we are focused on large enterprises. So it starts at 1,000 devices. So we are more for the corporate customers, but of course, grown-ups, let's call it like this, or interested larger companies. They can directly contact me. I love hearing about the user stories and the demands in the market. So just contact me on LinkedIn. It's usually the easiest way. Just Google my name. Thankfully, I have a very unique name. So just Google me, send me a request, and I will shortly answer. And if you're interested in the product, happily do that. If I can support other founders, I'm a big fan of entrepreneurship. Also always happy to at least give my 2 cents of advice.
Thank you very much, Jan. It has been a pleasure. So we just had the privilege of hearing Jan, Everphone CEO and founder. I now have the privilege of having Dr. Dietmar Helms with us, a partner at Hogan Lovells and a leader in the legal domain of asset-based financing. Dr. Helms brings a wealth of experience in structured finance transactions, having advised on several benchmark deals. His legal acumen has earned him recognition across leading lawyer rankings, making him the ideal expert to guide us through the legal framework of asset-based financing. So now we're just going to hear a short keynote from him. Thank you, Dietmar.
Thank you so much, Hugo. We have been introduced over the last years to a number of companies such as Everphone, new business models with a significant need for funding. As Jan has already explained, those use cases are typically in the sharing economy as a typical use case, where they replace ownership and provide services both in the B2B field as well as in the B2C field. We also see that now in the consumer finance space. We have advised a number of solar companies and heat pump companies for the energy transition that want to offer consumer finance solutions to their customers. So finding the right balance of funding or the right funding mix is a particular challenge for these asset-heavy startup companies. Apparently, the access to traditional bank lending is particularly difficult if you are a young company. Everphone already is a now established player in the market and can obviously seek bank funding. But when I met Everphone a number of years ago, they were still young in the market with short track record and would usually not get a traditional unsecured or secured bank lending. Also, the other possible route would be a sale and leaseback structure, which might not particularly fit to the very flexible business model that Everphone wants to offer to his clients. On the other side, the pure equity financing would also be very inefficient and too expensive. So apparently these companies need to find the right mix of equity finance and debt financing. So startup companies were often led to seek funding through venture debt, which might work or may not work in an ideal form, because it comes with a lot of restriction on the further growth and might not be the best solution for a high scalable business case such as Everphone. So we have invented the kind of asset-based lending structures that we are talking about in more detail today. So what this structure is mainly about, first of all, we have to distinguish financing models which look on the pure receivables financing versus an asset-based lending type of structure. So in an receivables financing, for instance, if you have an installment purchase contract, which would fully amortize the asset at the end of the lifetime of the contract, then we would set up a kind of a factoring structure where we would purely sell and fund the receivables. Where in another case, like in Everphone's case, we might have a short rental period, which would not lead to a full amortization of the asset, where we would also look in particular on the asset value itself. So the difference to a traditional bank lending in an asset-based lending structure would be that we try to set up a structure which allows investors full control over the assets and over a potential enforcement scenario where they have to segregate the assets in an insolvency of the respective company. So the main advantage is that the creditors are not just secured creditors in a potential insolvency proceedings, but they can actually segregate the assets that they have financed. They can control the enforcement process itself. They can avoid costs and additional time for an insolvency administrator to take decisions on the enforcement, and give them a much better position either to control the enforcement itself or to negotiate with the insolvency administrator how to best enforce the collateral. Thank you, Hugo.
Thank you very much, Dietmar, for that launch into asset-based financing. Today, we're joined with Dietmar and myself by Dr. Veronica. She's the Chief Financial Officer and Managing Director at Everphone. Veronica's journey in finance has taken her from the structured world of banking to the dynamic and fast-paced startup ecosystem. For this panel, we will navigate the landscape of asset-based financing, exploring its roots, and going into the mechanics and advantages of leveraging company assets to secure funding, a concept that recently, as Dietmar has pointed out, has been pivotal for certain companies in terms of growth. So our discussion will dissect the nuances from the initial evaluation of assets to the intricate legal considerations. So let's kick off maybe with Dietmar first. Going back to its very core basics, could you define asset-based financing and explain its core components?
Sure, Hugo, thank you. So I think the main idea of this asset-based financing, or asset-based lending as we call it in the case of, for instance, Everphone, consists of really segregating the assets from the operating company. In these cases, we set up an insolvency remote entity, which becomes the owner of the relevant assets, meaning here in this case, iPhones or iPads that are rented out by Everphone to its customers. And the only link between this insolvency remote SPV and Everphone would be a service contract by which Everphone would then still provide certain services, the marketing of these products to its customers, the collection of payments from the relevant customers, and the maintenance of the relevant devices. We would then, in addition, have a backup servicer typically in place, which is a standby solution in case the operating company becomes insolvent, so that the creditor has someone to turn to take over the enforcement and the wind down of the collateral.
Okay, great. And Veronica, from a CFO's perspective, why is asset-based financing, at least in your opinion, becoming a suitable choice for startups and scale-ups?
So this is especially relevant for asset-heavy business models such as ours. So procuring an asset, usually a mobile asset, that is leased out or rented out to consumers or B2B, and that is generating steady cash flows. In ancient times, this was typically automotive leasing contracts or rental contracts. Nowadays, we can finance pretty much every asset from smartphones to other mobile devices to electro scooters, but also handbags. And to scale such a business model, the company would need a steady influx of assets they could rent out. And obviously, this cannot be happening with equity in a scaling business model, just because equity is the most expensive form of capital, priced at roughly 15 to 20% margin, whereas asset-based financing, if done in the right structure, can be obtained at margins of under 5%, and therefore having such refinancing in place can help significantly scale and also make a asset-heavy business model profitable.
Right, and just a question on that. So what's, maybe for either one of you, what's changed in the financial industry to allow for this larger scope of financing, of asset-based financing, going from maybe just some cars to now pretty much everything?
Well, I guess many startups who have tried to reach such financing and who have had the right support, amongst others, Dietmar, who has helped banks to understand the concrete risk of the asset and the startup and found a solution how to contain the risk in a way that it's amenable to a bank rating.
Right. And Dietmar, coming to you now, with your experience in securitization, what due diligence processes would you say are essential for companies to undertake when securing asset-based financing?
I think we look at the number of questions when we get introduced to a new startup or a scale-up company that seeks debt financing. So we really try to educate this company to take a look at their own business as if they were lending debt funding to themselves. So we are really looking at everything starting from the credit process, the client customer intake process, fraud prevention process, 4 Eyes principle, all these typical questions that a debt investor would later ask in the process. We are looking on the underlying contracts that they have with their customers, whether they are all solid and are suitable for refinancing. We are looking at all the compliance issues, whether or not they have the required licenses in place. And obviously, the whole organization of the company itself is up and running and working. Yeah. So these are typical companies that haven't been around just for a few days, but they have already at least a certain short track record and have proven that their business model is solid.
Right. And sticking with you with regards to, apart from the fact that it's asset heavy, what criteria makes a business a good candidate for asset-based financing? Does it matter where they are in the stage, whether it's Series A, Series B, or further down the line? What kind of criteria make it?
I think it should be a solid business model that people believe into. They should have reliable founders and people in the management of the company with a certain track record. Often we have serial founders such as Jan, who has in the past already set up other businesses before that and has proven that he has the right skill set to come up with the right business model and also brings together the right management team that can run that business. And obviously, although we provide significant amount of the funding for debt funding, the equity component obviously also plays a role, especially in times where it's no longer that easy to raise another capital round. So debt investors are also looking at rundown rates, etc., because they don't want to fund a business that is at the edge of becoming insolvent in a very short period of time unless they can raise another equity round. So I think debt investors have become a little bit more cautious about this approach.
Yeah, we'll get into asset-based financing versus equity financing. I think a lot of founders probably watching this are interested in that. But coming to you, Veronica, with Everphone's innovative business model, could you discuss how asset-based financing fits within your broader financial ecosystem, especially compared to perhaps traditional lending models?
So we have something in place that I call the golden balance sheet rule. This means that all of our growth, which is invests in people, in tech, in marketing, is financed by equity. This is something that is of vital importance to investors, and that's why they finance it. On the other hand, all of our assets rented out to clients are debt financed. We're doing this exclusively by asset-based financing, just because this has been proven to be the cheapest and the most accessible form to us. But obviously, it would be also possible to run such a model and include venture debt capital or include traditional corporate lending on, let's say, our inventory or the like. We have it covered in our structures, and that's why it's not necessary. I'd also like to underline the high availability of debt capital even in terms of economic crisis. So we had the COVID crisis, we have the funding crisis for startups that has basically been happening in 2023 since the collapse of Silicon Valley Bank. And during all those times where equity has been very scarce and very expensive and difficult to supply, debt capital was pretty much freely available on the market. If you had the right business model and if you were able to prove that it's sustainable. I've raised one facility during COVID. At my former employer, we raised our current facility at Everphone during this time of 2023 crisis. And there were never a lack of, let's say, available banks in the market that would have been able to do this deal, whereas equity investors are just difficult to find.
Right. And can you maybe share an example from Everphone or your past experiences where asset-based financing was effectively utilized? And perhaps maybe the first time you guys used it at Everphone.
Yes, indeed. This is a funny story. So Everphone was at the start a B2C club. It's what's called a smartphone club because Jan dropped his device and the screen broke and he needed a new one and thought, well, everyone's having that pain at some point in their lives. Then they pivoted to B2B because one of their private customers was a salesperson and they wanted to equip all of their colleagues in sales with a phone. And that's when the business model pivoted. They acquired some minor clients and were able to buy all those devices with equity. But then they out of a sudden acquired a Big Four client from a large advisory firm, and they wanted to roll out 10K devices within 3 months. And that was the point in time when Everphone realized that they wouldn't get the equity to buy all those phones. And when they started setting up and investing into a debt facility, this was set up with a smaller fund because Everphone indeed didn't have a track record. It was a very easy structure via a promissory note. And over time and with more track record, Everphone has set up 3 more facilities, each with larger banks, each more complex, but also each cheaper, ending with that private securitization we've set up by the end of 2023.
Yeah, it's cheaper, more complex. That's where you need the both of you to come in.
Obviously, it goes hand in hand.
Yeah, absolutely. To Dietmar first, maybe, how does the scalability of a business impact its abilities to secure asset-based financing?
Yeah, I think it's a cornerstone. Obviously, this complex structure isn't suitable for a company that does not seek to really grow in size. While we start doing these structures with a minimum debt funding of about 5 million euro, I think the expectations of lenders would be that the business would ramp up in a relatively short period of time to at least 10, 15, 20 million to make it cost efficient. I think a business that would stay at a financing volume of 5 million should seek for a less complex type of financing.
Right. And for you, Veronica, how have you found when Everphone started reaching scalability? Did you find it easier to secure asset-based financing or not really?
Yes, indeed, because I believe the credibility that the early banks lent by investing into Everphone also made us attractive to larger partners. By then, we had a proven track record of fulfilling our debt, of securing additional funding, of also delivering in terms of remarketing our assets in claims management and all the like, and being able to show a 2 to 3 year full history in a very data-based setup is very convincing to banks. So it's probably not the fault of those very early stage startups if they can't reach asset-based financing. It's just a lack of data and a lack of history that's oftentimes detrimental to getting such type of financing.
Right. And coming to you, Dietmar, before we go into asset-based versus equity financing, I think it's important in terms of the evolving definitions in the financial sector. How would you differentiate asset-based financing from other forms of secured lending, particularly if we focus on a startup/scale-up audience?
Yeah, I think it's a more elaborate way of financing. It is also using concepts of secured lending, because this special purpose vehicle, which becomes the owner of the assets, would typically also grant security over the assets as an additional belts and braces protection for the investors. But the main idea is really to segregate the assets from the operating company. I'd like to point out another point to what Veronica has mentioned before. I think key for this financing to work is really to also have the right asset class. Traditionally, banks would probably not have financed against a portfolio of handhelds, mobile phones, because they couldn't evaluate the asset at a certain point in time. I think the availability of data was one of the key factors that has helped to really make this product more reliable for investors, so that companies such as Everphone could really provide sufficient data to their investors and to prove at any point in time they can have a very accurate evaluation of the asset portfolio. This is the one point that is important. The second point is that you also have a liquid secondary market. Today, as you can see on eBay and other platforms, these assets that are rented out by Everphone are traded in the thousands each and every day. So not only have you reliable data, that it's not a random number that you would get for a used iPhone, but you would also have enough comfort that you can sell several thousand iPhones in a very short period of time on these platforms. And this is also a key factor for a debt investor to really grant funding on that basis.
Okay, great. Thank you. So look, now let's move into asset-based versus equity financing. And Veronica, you touched upon it already with your golden balance sheet rule. It'd be great to maybe find out how you came to that, or was it a term you learned somewhere else? And when did you decide to apply that the first time?
Well, I believe that's a kind of inherent business logic. A bank would not be willing to finance a client's growth unless this was some debt that was specifically designed to that and would have a venture debt component. And on the other hand, investors would not be willing to invest the very scarce equity at a very high interest margin in financing something very basic that a bank would be also ready to finance. So it's kind of leveraging the two components to the best of our knowledge. And indeed, it's customary to combine equity and debt fundraising, as it happened during our Series C in 2021 and now in our Series D, because for equity investors, a company being able to obtain bank financing is a sign of strength, and that's why they're super interested in companies achieving such. And on the other hand, for banks, an additional equity provides a certain security cushion. And if they are able to fund the junior tranche or the equity injection into a facility for the duration of that facility, and can prove they are able to do so by an equity injection, this is also some stability in the bank's view.
Right. And Dietmar, from the investor side, perhaps, if you can talk a bit about the scenarios where asset-based financing offers better investor security, perhaps, than equity financing.
Yeah, obviously, debt financing always ranks ahead of equity. So if you are an equity investor, obviously you come at the very end of a potential liquidation of the company. So any debt investor, by definition, is already ranking ahead of equity. And the structures that we put in place are offering even more comfort to investors, that they can actually segregate assets from a potential insolvency, so that they would not only rely on insolvency proceedings and a potential sort of payout from the insolvency estate, but they can actually segregate assets from companies such as Everphone and liquidate them themselves and have more control over the proceeds that they can get out of these assets.
Okay, and in your experience, because we've heard from Veronica how equity financing and debt financing coexist, but in your experience with the companies you've helped in the past, how do those in your experience coexist in terms of for example, a specific funding round? Are they usually followed by one another? Are they usually done together? Are they separate? How do you usually see those?
We often see them kind of combined, as Veronica described. So often we see a certain condition in the debt funding that equity is raised at a certain point in time. And on the other side, equity investors also sometimes demand comfort in respect of the availability of debt funding, so that the funding actually occurs at the same point in time, as we have often seen in the past. It's not a prerequisite. Sometimes you also have like a post-closing covenant in the debt funding that the next equity raise is going to happen in a certain period of time after the debt funding closes. But sometimes it's really combined to happen at the same point in time.
Okay, thank you. And then just moving on to the applicability across different business stages. So Veronica, can you maybe go a bit deeper into how asset-based financing has supported Everphone's growth from a startup to scale up? And if you saw a big difference when you were just doing equity to now using asset-based financing?
Well, I believe that asset-based financing has enabled us to grow. We would never have been able to secure as much equity, especially during those difficult phases on the equity market, but also generally in Europe, to be able to maintain a high growth profile and roll out over 200K devices a year. So this is something that cannot be handled by equity. It might be able to be handled with an US venture capital investors usually are able to supply bigger tranches, but securing equity tranches of, let's say, 20 or 30 million makes you a larger fundraiser in Europe. And this would basically, if we use that equity to buy phones, this would probably bring us through, let's say, a quarter to half a year. And so we would never have achieved the growth that we experienced with Everphone.
Right.
Also, in times as those, profitability is getting more and more important. At one point, investors would demand to reach profitability, which we can only achieve once we have a significant number of assets under management, because there are functions such as mine that only scale when they tackle larger asset numbers. And this means getting more profitable over time. We would have to improve our interest margins as we have done in the past, but we would also be able to scale and have economies of scale throughout all our business, because we have a larger base of assets we can distribute those general costs to.
Right. Thank you. And coming to you, Dietmar, kind of a two-part question. How did you get into this world, your personal journey into this world of asset-based financing? And what types of assets were most commonly used maybe when you started compared to now, and where do you think that's going? Will it be applicable to absolutely everything in the future, or will it still remain somewhat closed off to certain things?
I think my introduction to asset-based lending happened about 10 years ago, when I happened to sit next to a young man at a closing dinner, and he told me about some startup companies that were going to be founded in Germany, in Hamburg, Munich, Berlin, sort of the hubs in Germany for this type of financing. And we started to look at business such as Everphone and similar companies in the market that had tradable assets. And we were thinking about what could be a potential structure to get access to debt funding for these types of companies. So we actually used a structure that was used before in the car rental space, which is kind of a similar use case, where you have very short rental periods for vehicles that would not lead to a full amortization of the assets, but also have this element of an asset segregation in a special purpose vehicle. So when you seek debt funding, you typically try to replicate a structure that is already bankable, that is used to banks. You don't try to invent something completely new that no one has done in the past, but sort of make this transition from a car rental structure to this kind of asset-based lending structures. That was, I think, the new element, and using it for new assets such as mobile phones, and to convince that investors that they have sufficient data available to make an asset-based lending, an asset-based test for the asset value itself. That was also new in the market. It was a very common feature for the car space because you have this residual value list provided in the Schwacker list in Germany, for instance. So you have reliable data in the market for used assets, but we only had to create that same level of comfort for that investors for new assets such as Everphone's mobile devices. We have seen in the past other use cases. So we have recently financed coffee machines, we have financed handbags, we have financed e-scooters. So there's a large variety of assets, but the crucial questions are the same as I discussed before. So it is important that you have sufficient data available for the assets to really come up with a day-to-day valuation of the asset portfolio. And you need to have a liquid secondary market so that in case the operating company ever becomes insolvent, you can appoint a backup servicer and you know for sure that you can liquidate these assets at the value that you expect to receive.
Okay, thank you very much for that. And to Veronica, could you maybe, we've talked about all the positives here, but could you maybe discuss a specific challenge you faced while arranging asset-based financing and how you overcame it?
I guess I can iterate on Dietmar's point here. At Everphone's beginning, it was very difficult to convince the investors that our assets are indeed fungible and that we can sell them off at a value larger than zero. So what we had to do, we had to prepare the data ourselves to be able to prove to banks that this works out. We set up a data product, which is basically a crawler that crawls the internet for B2C prices. Then we have a mechanism that converts B2C prices into B2B prices because we usually sell off large bulks of phones. And this is what, in the event of Everphone's insolvency, banks would also do. And we have, of course, to be able to predict the future value of the handhelds and devices that we are buying today. And that's where we employ machine learning in detail deep forest technology. This data product enables us to predict the residual value of a phone, any phone with any minimum duration of the contract, with any make and model. And of course, over time, we have been able to prove to banks that this mechanism works. And we are in a 95% confidency interval of meeting our expected returns 2 or 3 years later. Being able to prove this made refinancing much easier and also guarantees us that the banks not only finance the cash flows arising with B2B customers out of the asset, but also the residual values. And again, as said before, it sounds very easy to set this up, but it needs a lot of structure, a lot of work, and it also needs time to be able to present a data set of, let's say, 3 to 4 years to banks in order to really convince them.
I can tell it doesn't sound easy.
I think another component that was crucial to the success of these structures was also that we now have certain service providers in the market that provide backup servicing for these products that wasn't existing before. So when a backup servicer in the past for a securitization transaction, these were debt collecting agencies. So they could only collect outstanding receivables, but they could never collect assets such as mobile phones, refurbish them and sell them in the secondary market. So over the last number of years, we have seen such service providers to really occur on the market, see that as an own business model. And they are now implemented in these structures. And this only makes it viable and comfortable for a bank to invest into such a product.
Right. And look, I want to kind of move on to something that you're specialized in, Dietmar. We've talked about operational hurdles, a bit of financial hurdles, and structural hurdles for companies. But what legal hurdles do companies typically face when setting up asset-based financing structures?
I think it's more the complexity. It's not a straightforward secured lending where you just have a credit agreement with a bank and security agreement over your assets, you have to set up a new entity. This can be a subsidiary of the operating company. It can also be an orphan SPV, which is held by a Stichting. So this is completely separate from the operating company. You then have to set up a servicing agreement between the operating company and the asset co, whereby the service company would then provide every service that is necessary to really market the product, because the asset company doesn't have its own employees. It's just owning the assets, but it shouldn't have any employees by itself. Then also you have to set up these backup servicing agreements, which are tailor-made contracts that are really then meeting the investors' requirements for a reliable backup servicing in case the operating company becomes insolvent. And then we also take a close look and due diligence on the underlying customer contracts. So the whole process really to set up is a little bit more cumbersome, but I think over the last years, we have gained a lot of experience and we can replicate certain use cases.
So yeah, so for companies who want not an easy way, but a more tried way, they should just come to the both of you and get your insights. Could maybe staying with you, Dietmar, could you share an example where asset valuation proved challenging and how it was resolved, perhaps?
I remember one case where we have set up an asset-based lending, for instance, for an e-scooter company, and the public perception of e-scooters at that time was really a disaster. Everyone thought that these scooters have zero value after a short period of use. And so no one was really prepared to lend debt to finance the acquisition of e-scooters. So this company that we have advised set up its own platform where they started selling used scooters after the use of 1 year time to really prove that these scooters still have a significant residual value. And I think this has provided sufficient comfort for debt lenders to invest into that structure.
Right. And for you, Veronica, has there been a time at Everphone where it was asset evaluation was difficult, or had you set up everything from the crawler from the get-go?
We had set it up very early on, but obviously we didn't have results until the first cohorts of our phones came back and had been sold off. So for 3 years, we had to basically convince banks to trust in us and in our system without having real data to evaluate it. And this made refinancing at this point in time, on the one hand, very expensive. And on the other hand, not comprehensive, which means we couldn't refinance a very large proportion of the capital expenditure of the smartphones, but we had to bear a large junior tranche.
And for you, Dietmar, how do you see this landscape, and perhaps in a legal term, evolving in the next few years, perhaps technology influence or something like that?
I think it has become now tested and a debt funding structure which is now more familiar to more banks. So in the beginning, there was only a very limited number of investors that would actually explore that new way for funding startup companies and scale-up companies. I think now we see bigger tickets in the markets. We see more sizable portfolios, such as Everphone, for instance, with funding of more than 100 million for a debt funding. And we also see more interest among banks to really launch that as a product. We see some structure that are set up as an securitization structure and asset securitization structures. Some of them are set up as a specialized lending structure. So there are different ways to go. We also see debt funds investing into these structures. So there seems to be way more appetite now. And I think we see more data in the market. We see more marketplaces where new products are marketed. We have recently advised a company that is producing industrial robots, for instance, for the repackaging industry, for logistic companies. And even those kind of products that sound very tailor-made and sophisticated seem to have a secondary market where you can extract data from, and where you can find sufficient, reliable marketplaces that you can sell off these products.
Right. And just to keep to this might be a bit left field in terms of question, but do you perhaps see in the future where a seed round company could leverage asset-based financing, or is that do you think that will always be too early?
We have seen these cases, yes, indeed.
All right.
We have worked with companies that have just passed their seed round and have already had access to asset-based lending. It really depends on the company. It depends on the specific assets.
Okay, great.
And I would assume they would have to have also investor support, because setting up such a structure would also require talent in-house that comes from a banking background, that is knowledgeable, that is able to, on the one hand, calculate, on the other hand, to legally understand such structures. And this would mean a cost invest on the side of investors.
Right. And sticking with you, Veronica, from a strategic standpoint, how do you anticipate asset-based financing will change in the next, let's say, 5 to 10 years?
I'd hope it will be more and more available to companies. I believe that from a technology standpoint, maybe tokenization and blockchain would enable us to offer a better security regime than we have today. Securities are complex, especially once a company serves clients not only in their home country, but also in other European countries or even overseas, because security law is different there, and this makes it very costly to check. So I hope that technology and tokenization can be one way out of applying national security law.
Right. I'm working with a company, I won't name them, but they're creating a way of exactly what you said, tokenization for assets based on if they go insolvent, people can buy it off the market quite quickly and pay back their creditors. I'm not an expert in this, but it did sound very interesting. And some of the companies they were
Super
working
cool.
with. Yeah, very cool. But yeah, based out of Switzerland, very cool company. But yeah, so coming to you, Dietmar, what are the most common pitfalls in asset-based financing agreements, and how can they be avoided?
I think just to add to the previous question, I think this basic concept of having an asset co SPV owning this assets already takes out a lot of complexity from a security perspective. So the local security, if you look at assets that are located outside, for instance, of Germany and other jurisdictions, is usually just an add-on to the structure. But usually this security would never get enforced in case of an insolvency. We would just rely on the asset co to be the owner of the assets and being able to repossess it. So sometimes this helps when getting security seems impossible, or it's too cumbersome or not cost efficient. There are certain jurisdictions, for instance, in the Nordic countries where you cannot grant a security interest over movable assets without also transferring possession to the asset, which wouldn't make sense in the case of Everphone, for instance. If they hand out the assets to the debt investor, they cannot rent it any longer to their customers. So in those cases, this basic structure of having an asset co owning the assets already solves a lot of these issues, which would otherwise be impossible to solve with a security interest. Coming to your question about the pitfalls, I think one of the main pitfalls is really to finding the right funding strategy in the beginning of a company's life. What we have often seen in the past is that startup companies often think that venture capital is the way to go, and venture debt funding is the way to get venture debt funding into that business model, and without thinking about whether or not this venture debt would then later on allow them to scale the business. Yeah, so a venture debt provider would usually take security interest over all the assets of the company and would also encumber the business with a lot of negative covenants so that they would not be allowed to take out other financing without the venture debt provider's permission. And so if you reach the relevant debt size of this venture debt, you want to grow further, you need to get consent to repay the venture debt. So if a company really has the scalability in mind, they should either start taking up that asset-based lending from the outset, or at least consider when they get a venture debt funding that they have some sort of carve-out provisions in these agreements that would allow them to later on switch to asset-based lending, which is usually the better way of funding if you really want to grow big.
Right. And I don't know if this question is relevant to you, Veronica, but if there's ever been a time, can you discuss a time when asset-based financing did not go as planned?
All the time.
Okay.
So I believe there's pretty much all the time something happening in a startup environment that has not been foreseen. For example, Everphone's third facility was prepared in a way that our customers would do 12 or 24-month contracts. And the facility was signed, and a very large German DAX client called and said they wanted to do 36-month minimum duration.
Right.
So what did we do then? For the first month financing those contracts as if they were 24 months with a huge loss of cash and equity, and then renegotiate with the bank to please allow us to also finance 36-month contracts. Same is happening when a new product is onboarded, when a new amortization profile is onboarded. We're usually having stable rental amounts through the time, but now one of our large Big Four clients is asking whether they have whether they would be allowed to have degressive rentals. How to fit degressive rentals in a security structure? Well, you basically ask the bank, explain them the rationale behind this ask, and then find a solution with them. We're very happy to have banking partners that are flexible, that are quick to respond, and that are willing to consider whatever makes sense business-wise to also appreciate refinancing-wise. But in a business model that's rapidly changing, as is a startups or a scale-ups, there's always something not going according to plan.
Yeah, and I think one of my questions was, you answered it a bit, but how flexible have you found banks in general?
If you select the right banks, and if they're convinced that your business is a great one, they will be flexible.
So question is, how do you select the right bank?
Well, basically, you ask them those questions. I remember in my first refinancing structure, I was talking to that banking partner on the 23rd of December, and I told him, hey, I'm having a balance sheet problem. I need you to refinance more cars between Christmas and New Year's Eve. And he did it, just because they're a smallish bank and they're super flexible. And he was willing to open up his laptop computer and help me out between Christmas and New Year's Eve. That's the kind of flexibility we need. In this structure, we had to do our first drawdown between Christmas and New Year as well. And we had to do it on a Friday, which is a non-banking day for our mezzanine partner, Phoenix. So they just enabled it because they believe in Everphone. They asked their employees to do an extra shift on Friday and pay out the funds. I believe in a good collaboration. That's something banks are willing to do. If they stop trusting you, or if you don't maintain a good relationship, then they won't be as lenient and as accommodating for special requests.
That sounds like a very healthy relationship. And to you, Dietmar, the same question. In general, because I'm guessing you deal with not just Everphone, probably with other companies as well. How have you found the flexibility of banks in general?
Well, I can only reiterate what Veronica has said, and obviously we see a lot of players in the market. We also gain certain experience from the past when we have seen banks and funds acting in these kind of scenarios, reacting to those special requests, asking for this special flexibility to, well, amend on short-term notice certain requirements in their facility. And we are happy to share this experience with new clients that we take on board and advise on which bank or fund might be the best choice for this particular product. And obviously, over time, when banks get more comfortable with the company and the product, obviously the amount of flexibility also increases over time. So we usually say the first financing that a startup takes up is probably not yet the time when you get the ultimate best terms for it in terms of funding costs and in terms of flexibility. Obviously, the banks at the very beginning try to give you certain restrictions just to control the risk better. But the more confidence they get into the business model, the more data they see, the more track record they see, they will open up to discussions and allow you more flexibility. And then you can start renegotiating the terms of your facility.
Right. Look, we have time for one more question for both of you. So maybe first, Veronica, what advice would you give to startups considering asset-based financing for the first time?
Consider it carefully, but if you are convinced this is the best option, really invest into people, invest into tech, invest into internal processes, and invest into good advisors and lawyers to set it up. It will take some time, but it's totally worth it.
Great. And for you, Dietmar, from a legal standpoint, what are the first steps startups should take when exploring asset-based financing?
We are always happy to bounce ideas at a very early stage. So we get introduced to a lot of startup companies, and we are happy to take a look at their pitch deck, for instance, and give them some preliminary advice how to best present the business to a potential bank. We also make introductions to potential lenders, and we try to already improve the business model wherever it is possible to make it more bankable and admissible for bank funding.
Okay, great. Well, look, for anyone watching, we'll put some details in the description below to get in touch with either Dietmar or Veronica. I'm sure they'll be more than happy to help if they can. But I'd just like to take the time to thank the both of you for joining us today. It's been an absolute pleasure. So yeah, thank you very much.
Thank you for having us.
Thank you, Veronica and Hugo. It was a pleasure.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Welcome back, everyone, to Capital HQ, where for this session, we're going to be diving into the heart of tech due diligence. Joining us is Chris Phillips, founder and managing partner at Phillips & Byrne, named synonymous with excellence in the tech due diligence industry. Since 2019, Chris has been at the forefront of guiding funding and strategic technology assessments, helping startups and investors alike navigate the complexities of the tech landscape. He has been an interim CTO for a long time in various different organizations, so has a lot of experience there. With a career spanning over 2 decades, including roles as an engineer, CTO, and now as a leading advisor, Chris brings a wealth of knowledge and insights. Today, he will share his expertise on what makes tech startups succeed, the nuances of tech due diligence, and the future trends in technology investments. Get ready for an enlightening conversation full of actionable insights. Welcome, Chris.
Happy to be here. Thanks, Hugo.
Great. Look, let's get stuck in. And before we dive into the depths of tech due diligence, could you share a bit about the ethos and mission that drives Phillips & Byrne in the tech advisory landscape?
Yeah, absolutely. So we always say we help founders and investors build the world of tomorrow, and that probably sounds like a huge ambition, but in the essence, that's exactly what we do. Yeah, I mean, the way I see the startup scene is that we really use the opportunity to build another world, to build another future, hopefully a better future. And having been already part of the startup industry for more than 20 years, that's always my ambition. And by advising investors on one hand, but also advising founders, entrepreneurs on the other hand, that is definitely our mission, that we want to help build that future. Apart from that, I mean, we have this mission in place, but also we have a kind of prime directive, principle number 1 in our company, and that is zero bullshit. You also find that present on our website. And we not only write it, but we actually mean it. It's our moral compass for our work, but also for our own company.
Okay, and where did this zero bullshit philosophy come about?
Yeah, that comes from my history as an interim CTO. I once had a colleague from the US who had worked with me for a couple of years, talking to me over a beer, and he gave me that feedback. He said, like, you know what I value most about you is like you're absolutely zero bullshit. I always know where I stand. I always know this is the truth. Yeah, and then we can operate based on that. And I like that feedback a lot. And I think I made it to my own personal first principle, and then I introduced it also to the company later on.
Yeah, and I it's one of the things I've taken on when I started working, because I work with a lot of founders. I help them with their due diligence materials, not to the same extent as you do, but I do that as part of my everyday day-to-day role. And after 5, 6, 7 clients, I was like, look, I'm gonna be very brutal with you because it's better it comes from me than it comes from a potential investor. And at the start, I was a bit wary of saying that because it kicks off the relationship between a business and a client a bit off. But today I use that every time I get on a call, and they seem to enjoy it. So I relate to your zero bullshit. Well, look, with over 2 decades in the tech and startup ecosystem and now leading Phillips & Byrne, can you share how your journey has shaped your perspective on tech due diligence?
Yeah, I started as a typical techie, I would say. So I used to work as a software engineer for quite a while and had various other roles in engineering before I eventually became a CTO and then an interim CTO of more than 10 years. But still, I had this typical tech perspective. And then when I had my first due diligence, not as an auditor, but on being on the other side of the table, that was really an epiphany for me, because suddenly I got confronted with what the outside world would consider as standards. And I think that was a very valuable lesson for me. Fortunately, we got the funding. Fortunately, the startup grew. Nevertheless, it made me think a lot about, like, from a higher perspective on what actually a good technology organization needs to bring to the table. That was one aspect, but the other one, and that is probably even the strongest driver, I had to endure throughout my career a couple of, let's say, bad tech DDs. In that sense that for me as a CTO, it was an absolute waste of time, and the insights were very, very limited, and there was almost no feedback whatsoever for me and my team. And I found that a pity, because we invested a hell of a lot of time into preparation for that tech DD, and in the end, we left with nothing. So I swore to myself that if I ever would perform a tech DD, I would try to turn it around and set it up in a way that it's highly valuable, not only for the investors, but also for the startups, for the teams being involved. I always say it's the most thorough and most honest feedback that you can get as a founder and as a CTO. And we try to stay true to that principle.
Yeah, and I mean, it's interesting having sat on both sides of the table. And I think next question is, how do you believe the diversity of thought, right? Because I'm guessing when you sit on either side of the table, the way you approach something is completely different, right? But the end goal for both sides is to build something and move together. But how do you believe, having done both things, how do you believe that diversity of thought and experiences enriches your tech due diligence processes and perhaps Phillips & Byrne's?
What I always feel is that we have a different perspective from many, many other consultancies performing DD, especially like the bigger ones, because our team has a different DNA. We all come from the startup scene. We have all worked in startups and scale-ups. And that's a huge difference, because we have felt the pain ourselves. And we usually are not business analysts performing a tech DD. We are techies. Yeah? We are engineers, we are architects, we are former CTOs or directors, VPs. And that is definitely something that influences massively our view. But there's also a second perspective that I gained when I became a founder myself. When I was an advisor, I was always like advising CEOs how to build and lead their company. And one day I looked into the mirror and said, like, who am I to advise someone if I haven't built my own organization and my own company? And this was actually the primary motivation for me to build Phillips and Byrne. And that changed my perspective entirely, because I suddenly found myself in the exactly same situation, and I did the same things or the same mistakes the other founders did, and what I could watch over the years. And although I knew I couldn't help myself but making the same mistakes sometimes, and I understood this the thinking better, why founders tick the way they tick. So that was really an eye-opener for me, and I think that has also massively influenced our perspective with that regard, that we understand the pain, also the founder's pain, and we can sometimes translate it to investors, but we very often also know what to do in order to mitigate the risks going along with that.
Fantastic. Yeah, being put in the driver's seat, I think can do that. I haven't been there myself, so sometimes I speak to founders and I find myself in this situation where I'm telling them, like, I've worked with hundreds of companies. And then they're like, yeah, but you've never run one. You know, I have people I have to feed. You don't have people you have to feed. I was like, yeah, fair enough. Yeah. But look, for the purpose of this conversation, I think, you know, and this concept has quite a few definitions, but I'd love for you to explain what tech due diligence is and its critical importance in the investment decision-making process.
Yeah, I always like to boil it down to one simple question. Like, for me, tech DD is the answer on the question, does tech and product have everything with regards to people, process, and technology that it needs to achieve the business goals? That is what you need to figure out in the tech DD. And if not, what needs to be done in order to get there?
And given your vast experience, how has the approach to tech due diligence evolved over the years, perhaps from a founder and an investor's perspective? And that's first part. So maybe we can talk about the last 10, 15 years, your experience, and perhaps we can touch on the rapid technological advancements happening within the last year and a half.
Yeah, absolutely. So I started with my background and my thinking as a technologist and as a one-person show. And I think that has influenced the first couple of years, especially first 5 to 10, I would say. And this is what I see nowadays a lot. I see many brilliant technologists conducting DD as a kind of single person show. And nothing against that. It can be exactly the right context or the right thing for some context. However, I realized that the more DDs that I performed and later on we performed, and we have performed around like 700 DDs by now. So you could see that the most important thing is having a framework, having a framework of conducting DDs, but also a framework of standards and best practices you apply and you benchmark companies against, considering certain contexts, certain stages, certain industries, etc., and also having the data to benchmark the companies against similar companies of that stage, that industry, etc. So that is definitely something that has evolved, I would say, throughout the last 5 or 6 years, and has become a focus in our work. I mean, the last 1.5 years, probably you refer to the big paradigm change through AI. Of course, that has been super exciting also for us. I still remember when the first release of ChatGPT came out. I spent probably personally half a day on just like bombing it with anonymized data, seeing what I would get back as a result. And that is definitely, of course, in part of everyone's discussion right now, also strategic discussion, like will consulting survive? Will assessments survive? How well will they look like 5 years from now? Yeah. I don't think that there's a way around AI, or ignoring it would be a smart idea. However, I think there's, at least for a couple of years, there will be a hybrid approach. And I believe in that hybrid approach. I mean, nobody knows how it will exactly be with GPT-5 or even 6 down the road. But nevertheless, I think there will be still space for heavily tech-supported analysis and consulting driven by people, or at least aspects of people, such as empathy, expertise, and experience, in order to get the nuances right. And as long as people are involved into businesses, people are the main thing to consider. I mean, I always say, like, it's when I started, I thought it's 90% people and 10% tech. Nowadays, I'm tempted to say the problems are related of 99% to people and 1% to tech, right? So, and as long as there are people, it's good to have also people on the other side of the table. But what needs to be clear, the times for expensive, so stupid consulting, these are over, and that's, in my eyes, a good thing.
Yeah. And look, talking about this from maybe a different angle, technological advancements, has that made your job harder? Because maybe the concepts are more data hungry, they're maybe a bit more complex. Has that made your job harder in general?
I would say that has made our job even more interesting. I mean, we were in the lucky position that we, I don't have the numbers for 23, but for example, in 22, 30% of our DDs were AI related or deep tech related. And to be honest, although of course the other DDs are also interesting, but these ones were thrilling, especially like looking into companies who are OpenAI competitors and develop their own large language models. I mean, that's super exciting for technology teams, right? So we have built up a certain expertise in the field of AI and are capable of going down very, very deep the rabbit hole. And so with that regard, it has also kind of shaped our understanding of the landscape, and has excited us so much that some of my colleagues really, really went into it and built up a really good expertise in it. So we are not afraid of assessing complex technology companies. Sometimes we even go, I lively remember a company in the quantum computing context that was totally innovative back then. And that gave us a pretty hard time from a tech DD perspective, because no framework work. Yeah? So, but nevertheless, these are also highlights in the history of each and every assessment company or consulting company. So we love it.
Absolutely. Sounds like it. What are some common misconceptions about tech due diligence that you've encountered, and how do you address them? Maybe we can do this from answer this in two parts. The first one can be an investor part, and the second one can be a founder's misconception.
Nice one. Let's start with the founders. So we see two main misconceptions here. One is some founders understand the DD as kind of a hide and seek competition. Yeah? And I understand that in an M&A context, but let's say I understand that in a highly political M&A context. I don't understand it in a VC investment context or in a very friendly M&A context, because I think it's a wasted opportunity of getting feedback, also on putting the real problems on the table and see how you get along with your future shareholders or even like partners. And so that is something that where I highly encourage founders not to play too much of hide and seek and be open and be upfront with whatever challenges are existing. Also, it goes hand in hand with that a DD may be a waste of time, but that is also because not every DD is a win for the team, yeah, and not every DD is valuable. So that's more like on the consulting side to change that. On the investor side, my favorite misjudgment is this is the commodity. This is commodity. We don't need a tech DD here. I don't know how many times I heard that sentence, and I think it's wrong. It's in 90% of the cases it is wrong, because I mean, let's take a simple e-commerce or SaaS or marketplace model. Yeah, people are always like, that's commodity nowadays. Yeah, that might be true, but there is no like plug and play tech framework or tech solution for that you install within a day, maybe apart from Shopify for e-commerce, but even that takes sometimes and needs some tweaks. But especially like, let's say in a SaaS environment, there's still a lot of tech under the hood, and if you have a business model in a highly competitive situation or landscape, then it's crucial that your product engineering delivers at very like fast iterations and a lot of value. And if that is not the case, you just might lose the race, and then you might have the most sophisticated business model or the best whatever. You will not win the race about market share. And this is why I always try to encourage investors, even if it's commodity, to look closer at it, so that we can give some recommendations how to make it more effective or more efficient, or whatever it is that you need to do in order to loosen the brake.
Yeah, those are two very good insights. Definitely. Could you maybe walk us through the key components of a comprehensive tech due diligence process, and maybe part of the framework? I don't want you to reveal your secret identity at Phillips and Byrne, but if you can reveal some of part of it.
Of course. I mean, you start with the investors. You really want to understand their motivation, why they're investing into something. Then on the other hand, on the founder side, it's important to create transparency very early on. They need to know, and they have a right to know what is expecting them, and also to build that relationship, right? And then, of course, you have a lot of data ingestion and processing, like automatically or manually, like through the data room or similar sources. And then, I mean, I know that this part is handled very differently across the industry. Like, we still heavily rely on interviews because, as I said, I believe in people interaction combined with data. So that's the interview phase. And then last but not least, there's of course the aggregation phase with a report as a deliverable. And we are always big fans of discussing the report, not only with the investor side, but also later on with the founder side, so that they get the most of it, the most out of it.
Yeah, and in this process, how do you assess the scalability and future readiness of a startup's technology platform in general?
Yes, from a technological point of view, or let me start differently. first of it all, we want to understand the business, not challenge it, but really understand it, because I'm a believer in context, and the business case and the growth strategy are the context for tech. And after we have understood that, when we look at technology, we look at the architecture, because the architecture in the end is the reflection of the business that you build, translated into technology, plus like organizational setup being reflected in technology, information flow, so to say. So we look in detail into that, and also like into infrastructure. We very often have conversations about it, like kind of in-depth architecture workshops on a whiteboard, making it as visual as possible, because I mean, I also learned very early on that people speak very different languages, assuming they mean the same, but they don't. So visualization always helps. Like in addition to that, we also do detailed analysis of data, of course, but we also do live reviews, for example, of monitoring dashboards or similar things, because that is always fun, and also speaks, let's say, speaks also another truth than just looking at architecture.
And you know, if we move on to kind of discussing risks, what red flags do you commonly encounter in this process, and how should companies address these prior to even going into a due diligence process?
Yeah, I would say there are a couple of things, and again, it always depends on the context.
Yeah, of course.
If you talk to a VC about a Series A funding, it might be an entirely different context, rather than wanting to sell your healthcare company to a big corporate, right? I mean, what might be considered a red flag in the letter will maybe not make a VC raise an eyebrow. I think that's the reality. But let's stick somewhere in the middle. I mean, one thing, especially like when you're about to really scale, you should make sure that you don't have any hygienic issues that just inhibit your growth here, such as some legal stuff. Yeah, that, for example, you had these 10 freelancers in the first 2 or 3 years building your software, but you never made any contracts with them. So the IP question is unclear. That would be, for example, a very unfortunate situation. Then that doesn't say anything about the quality of your tech or the quality of your business, but it will give you a headache. So, and there are a couple of such topics, such as like GDPR or like open source software licenses, at least very strict ones. So this is something that needs to be made sure that everything is in place here. And the other thing is the view on the organization. Do we have the right people and roles in place? And I mean, nobody is perfect. We know that. We come from the startup scene. It's always work in progress. However, at least if I'm a founder and I know, okay, 9 months from now, we want to raise a Series B, then I should make sure that I have the key people on board, or at least most of the key people, and the other ones I should be at least looking for, so that one can see it's work in progress. Another thing is technology. When we look at technology, it should be always the balance. There's always this kind of fight, this power struggle between building it super lean and sometimes even quick and dirty, and shipping and speed is everything. And on the other hand, there's also this ambition to build towards the vision and to build it rock solid. And I think a good CTO always finds that counterbalance and manages to figure out how to build in fast iterations and in a lean way towards that vision. Does that answer your question, or?
Very much so.
Okay. Okay.
No, that's great. I think those highlighted some good red flags in that scenario, and I think the way you approached it is different angles, so it gives not just one answer but four, which is good. Could you maybe share an example where tech due diligence significantly impacted the outcome of an investment or acquisition decision? I understand that you might not be at liberty to disclose who and what, so if you want to keep it anonymous, no problem.
Yes. So I mentioned before already the highly competitive situations, and that is, for example, something in a DD. It's rarely just the one thing that is a big fat red flag, and then the investor backs off. And most of the time, it's either if there are question marks on the business model or on some other DD streams, and then tech comes on top, or it is a combination of various tech issues plus maybe a challenge in business. For example, highly competitive landscape, and we go in, do the tech DD, and come back and say like, whoa, tech has so much technical debt, so many things that need to be reworked in order to still have a good velocity in feature development, that they might be busy for the next 2 years just kind of cleaning up. They will have very, very slow output until they have cleaned up everything. So if that is the case, and we say there is barely any way around because they have already produced so much mess, that would be probably a deal breaker. Yeah? If it's in a highly competitive environment and everybody knows, okay, there are 10 competitors outside there, they will basically overturn them. They don't have a chance. The other way around, if for example, a company does something highly innovative and it's a big bet anyways, and they have the time because there's no competitor on the market anyways, the same issues we find might be more tolerable, and so it could be totally okay.
Right.
Yeah.
So it depends. Yeah. So again, it depends on the context, but there's just that's some general frameworks there.
Yeah. Or another good example is if a technology is absolutely not suitable for a certain problem or for a certain context, or you already know, okay, the founder built it itself with Visual Basic or some like Code Fusion Pro. I think 3 years back, I even saw something built in Code Fusion. I was like, wow, I thought that died 20 years ago or something. But I think that was a case where someone still knew it and thought it was okay and just built it. And as a prototype, it's maybe fine. But if it's already a production system, it will be pretty hard to maintain that over time, and also to find a team for that, right?
Interesting. And I think I have like spoken to someone recently about no code, low code software builders.
Mm-hmm.
Their take on it was that for a prototype, until an MVP, it's okay, but they would rarely see it in terms of a tech business that following a certain stage, they should really think about building that in-house, right? From your perspective, what's your opinion on that?
I totally agree on the prototypical phase or MVP phase. I think have as little effort as possible, and even if it doesn't totally fit, doesn't matter. It's always a trade-off. I'm a big fan of buy overbuild. So also for later stages, if you have the possibility and something is not your absolute core, please, if there's any decent solution out there, buy the component, build a component that is like highly component based, like the components talking to each other via APIs, so a loosely coupled system, so that if you decide to kind of pivot your business or like over time things become outdated, you can relatively easily unplug one component and plug in a new stuff instead of having to rebuild everything. So, and that is the case if you have a lot of third-party components and kind of by decision in there. In terms of low code, no code, it's sometimes it works, but sometimes it's unfortunately an illusion. And the adaptation or the customization rate is so high, and you didn't anticipate that in the beginning, and the complexity is higher than you initially thought, and then you might abandon that path and then eventually build something yourself. That's true.
Right. Okay. Very good food for thought there. And look, we talked about AI a bit already, right? But I want to explore a bit more about the integration of AI within the tech due diligence process. So in that context of AI and ML into technical due diligence, there's a spectrum of opinions on the reliability and depth of analysis compared to traditional methods. From your perspective, how can firms, and maybe how does Phillips and Byrne balance the efficiency gains from automation with the need for a nuanced expert evaluation, especially when assessing complex or novel tech environments?
Yeah, absolutely. So, I mean, that is something where I think the entire industry is still in a mode where we are experimenting and we are making assumptions and we are building first products that support our work, but we all know that might be wiped off the table with the next release of like, for example, GPT-5, or some other technology that kind of is another paradigm change. However, so I think it forces all of us to be even more data focused and data driven, which is a great thing. As I said, we ran experiments on anonymized DD data, and what we saw here, even with GPT 3.5 and 4, for simple context, the results are already pretty surprising. Reality is rarely simple. When we fed it with more complex, multidimensional context, then the limits were reached pretty quickly, and the analysis became quite shallow. But I mean, that is changing on a almost daily basis, I have to say. Like 3 months ago, our like experiments on architecture diagram analysis was devastating. Last week's analysis was quite promising. So I think it's important that you place your bets, or you exactly deeply think about how and where to place your bets here. That you increase your AI literacy in general as a consulting company. And apart from that, as I said before, like on the human side, like expertise, experience, and empathy, the 3 E's, will be still important for quite a while. Expertise, probably not that much anymore, because a lot of expertise will be substituted by machine. Maybe at some point also experience. The empathy part will remain for a bit longer, but I think especially you mentioned the nuances, especially in the nuances, humans will have a few more years of leeway, I would speculate today.
Yeah, and I think it's more than a few years, in my opinion. I've spoken with a lot of investors, not about tech due diligence, because I don't know much about it, but I know a lot about, well, know a lot. I know due diligence more, regular due diligence more. And they say, especially in early stage, right? I'm not talking Series B+, I'm talking seed, pre-seed, maybe a bit of Series A. The team at the end of the day is the most important thing. And I don't know if the AI will be able to discern Jack from James in terms of who can lead this team better, right? I understand maybe from a tech due diligence, when you look at the data, that can maybe be analyzed quite shortly. It does it in a way that's maybe not great today, but you can see how he gets there. But analyzing Jack from James, from Emma, from Marie, I think that will stay difficult. But what are your thoughts on that?
That's interesting, because that was, I think, my biggest USP when I started doing DD. Investors recommended me to each other because I was known as that person who also brought gut feeling into the discussion. Yeah, and it was I had a pretty pretty good quote, or how to say that, target hit rate, so to say. When it came to talking to founders and feeling whether something was off between them, whether there was an elephant in the room, whether there was a hidden conflict, or like how they interact with each other, what kind of standing the CTO has on among their C-level peers, stuff like that. And that is, even today, that's still, I mean, that's still a topic that is still, as you said, team is focus point number one, and that is something investors want to know. They want to know who to deal with. Yeah, absolutely. And that's still a human domain.
Absolutely. And look, for founders and investors listening, how does engaging with a firm like Phillips & Byrne early in the investment process help them?
It helps in the DD context, or in the DD phase, after the term sheet was signed, by like the hygienic stuff like mitigating risks, identifying risks, etc. But on the other hand, I think the most important, or the most valuable stuff is probably like, okay, can we invest into that? And we answer that question very clearly. Internally, we always ask ourselves the question, if you had 50K as your own money, would you invest into that company? And that question helps a lot in order to make that recommendation. And we also get clear recommendations what to do after the investment. And that is a crucial point that I learned in my time as interim CTO and CTO, when I sat in board meetings, and I had the feeling, sometimes that's not the right discussion here. Yeah, because they didn't consider what was going on in product and tech, and made plans without, for example, being aware of some things not being possible because of some limitations, some technical debt to deal with, or some other potential that was being left aside that could have been utilized, stuff like that. So, but especially in the negative topics, I like to address them within the DD, and I see ourselves and our work as a conversation starter between founders and investors to really address the difficult topics and turn them into a constructive dialogue. And I personally think that is the biggest value that we give, but probably the investors see the biggest value in giving clear recommendations to both the investors, but also to the founders, and of course, including CTO and CPO, what to do next and how to accelerate growth and accelerate progress, etc.
Yeah, because I'm looking, at some of your clients, and it's pretty remarkable on the investor side. Notion, Lakestar, Axel, HV, Early Bird. It's really remarkable. On the company front, it's also very, very impressive. So I think you mentioned earlier some things that sets you apart in this space, including bringing that dialogue and having that in-person interview, that face-to-face thing. But what other things would you say sets you apart in the market?
I mean, we spoke already about the zero bullshit rule, and as I said, that's my prime directive. So when we don't sugarcoat things. I mean, sometimes we kind of, as you said, sometimes it stirs things up if you don't sugarcoat and are not super diplomatic. But I think it's super important for an honest conversation and also for a tough conversation that is sometimes necessary. And that is definitely something both sides get from us. Another thing is that we have this startup and tech DNA, and sometimes even to a certain extent, the mini investors or wannabe investors perspective, because some of us have also several angel investments, so at least we got a glimpse of that perspective. And last but not least, we are techies. Yeah? We understand tech. What I see often in tech DDs is that it's a business DD with very superficial findings. And what we do is we start with the business model and this tech strategy, and then we go down the rabbit hole down to the very code level. We look at code, we look at data, we look at algorithms, we look at models, and not many teams do that in that depth without forgetting about the broader context and the business perspective.
Yeah. From what I've seen, also you do this quite quickly, right?
Yeah, that's true. But I think that's the nature of the business. If you work with VCs and founders, everything needs to happen yesterday. And I personally enjoy it, even if it's stressful. But that's exactly that speed and that this what's the name, like frequency or rhythm that shapes or like kind of characterizes the industry. So I love it. Usually it's 2 weeks or something. We have time, including prep and report and everything. Sometimes it's 4 days. Then it's a bit stressful. So I don't want to burn my team and do that every week. But yeah, I like the speed of our industry.
That sounds great. And looking beyond conventional markets that you might be used to, maybe European, and I don't know if you guys deal with American markets, but by the looks of it, you do. How do you assess the potential of tech startups in emerging economies? Is it very much a similar framework, or do you look at it from a different angle?
No, it's basically the same framework, but you need to be aware which market you look at or which country. I mean, we have worked in, I think, 25-ish countries. Most of them being in Europe, but also in North America, for example, or in Southeast Asia. So we know the markets very well. And for example, to pick an example from Southeast Asia, if you look at Singapore and Malaysia, very, very close by, but totally different markets. Because the salaries in Singapore are so much higher than in Malaysia for tech people, for engineers. So everyone who is more or less independent goes to Singapore. That leaves Malaysia with quite a talent drain in the engineering space. So if you want to build a startup in Malaysia, you need to work very, very hard to recruit great tech talent there. And you also need to pay above average salaries. So that is one understanding that you need to have if you assess certain local markets. Another one is that surprises me quite often, that despite all the globalization and globalized tech community, there are always still, let's say, technology hubs in different areas or countries. For example, Eastern Europe. In Eastern Europe is C# and .NET are much stronger than in Western Europe. So that is something that keeps surprising me. I think generally you can say that the US still has a big advantage in terms of best practices and tech talent, density and spirit and attitude. I still find that when I work with US companies, it's not like in 2010 or so when I had the feeling Europe is 20, 25 years behind. Now I would say it's maybe 5. but still you can feel there's in most of the cases still a difference. But I think the European scene has caught up a lot. And also like the scene in non-American or non-North American and non-European countries has really caught up a lot. Of course, also because the differences due to remote work and a more globalized community have been also equalized. So and that's a huge chance for emerging markets, especially also in the times of AI, where at least that's currently the assumption that organizations will become much leaner, and the capital that you need to build a company will also be much lower. So I'm very much forward looking to the next years what will be emerging in terms of startup scenes.
Yeah, definitely. And I think, I'm conscious of time. We have a couple more minutes, but with regards to remote work that you mentioned there, is that something that comes into the framework when you're doing tech due diligence, or not really?
What do you mean exactly? Can you elaborate?
Like, for example, if the development team, the product team, the tech team, whether they're remote workers or not, does that affect the due diligence at all?
Yeah, I mean, of course, we look at it, and the fact that there are more and more remote teams has also massively influenced our work, because pre-corona, in 95% of the transactions, we were on site assessing the team that was also on site. Then corona came, we all had to work from home, but post-corona, the majority of the teams we need are working either partially or entirely remotely. So there's no need, or also it doesn't make any sense for us to be on site because the developers aren't. And we want to meet them in their natural habitat. So we switch to remote in these cases because we want to see how they work on a day-to-day basis. So yes, we always look at it. What is the case here? We look whether it suits the company DNA and how the rest of the company works. And whether they have the right tooling in place, the right processes in place, and whether the alignment is still there, because achieving great alignment in a remote setup is still a struggle for many companies and many leaders, particularly.
Yeah. And 3 more questions. 2 are quite rapid fire. For the investors in the audience, could you share one piece of advice on how to best prepare for tech due diligence? Just one piece of advice.
Yeah, investors should exactly know what they want, why they want to invest, and what the expectation is for now, what they expect us to find, and what their expectation is for the next year or 2. That helps the company to negotiate expectations and see whether they can meet them or not. And also it helps us, of course, in our work to make a realistic assessment. Is that what you mean, or do you mean something else in terms of expectation or advice?
No, that's what I mean. And now turning it on its head for the founders in the audience, let's assume maybe that they're about to open a round. What was one piece of advice on how to best prepare for a tech due diligence for them?
On the founder side, I like to say that always lead your department in a way that you always could have a tech DD coming within the next 3 months. So have your stuff in shape, but because in the end, I mean, apart from a few bureaucratic requirements, 80%, maybe even more, of the information that are being requested and also assessed in a DD should be there already and should be kind of working artifacts that you use in your day-to-day life. For example, architecture diagram. That should be a living document that your teams use in order to make sure they speak the same language. So it shouldn't be prepared for the DD. It should be there. Same with a lot of knowledge. That advice I can tell to founders and particularly CTOs, I learned that tribal knowledge is something that will cost you a lot of energy and a lot of confusion, or it costs you a lot of clarity as your company grows. So write things down. It might be annoying, but it will save your life.
Great. And finally, how can interested parties get started with you guys from their tech due diligence needs?
Yeah, just ping us. I mean, we are there on all channels, LinkedIn, email, or phone, or whatever. So reach out. You can reach out for regular investment DDs, but also M&A on the buyer side, and also founders who want to sell their company in a few months and they want to have this health check beforehand in order to avoid risk in the DD process. And also, if you just want to have an internal feedback and health check, we are there for you.
Fantastic. And yeah, first of all, thank you very much for joining today, Chris. It's been an absolute pleasure. And for everyone joining us, thank you very much. We'll have a couple of links in the description with their website, with Chris's profile on LinkedIn. But yeah, thank you very much for joining us today, Chris.
Yeah, it was a pleasure for me too. It was really fun. Thanks.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
All right, welcome everyone to this episode of Capital HQ. I'm thrilled to welcome Bastian Buch, Executive Product and Tech Advisor at Philips & Baron, to explore the critical world of metrics and tech. He's first going to give a presentation on that, and then we'll go into a bit of a Q&A. So with an illustrious career spanning quite a few years, Bastian has left his mark on leading companies like Zalando, Delivery Hero, and Omio. And as a co-founder of the Mentoring Club, he's also deeply invested in nurturing tech talent across the globe. Today, Bastian will share his insights on the power of metrics to transform tech strategies, drive innovation, and steer companies towards success. So get ready for quite an enlightening conversation that will deepen your understanding of tech metrics and their pivotal role in shaping the future. Welcome, Bastian.
Hey, thanks for having me, Hugo. I'm very, very happy to be here and share a few of our thoughts on how we work at Philips & Baron, and also my experience with working in tech. Of course, we can go like 3-4 hours instead, right? So I'm really touching surface here, but I think in our Q&A afterwards, we can really dive into some of these areas. All right, so I think I can skip this. So you already introduced me. Maybe a few words about Philips & Baron. We are a consulting company doing like tech DD, sales checks. We help investors, founders to really shape the organization with that, the products, and with that, the future. Yeah, super happy about that, and really KPIs, metrics, and how to set these up in a growth environment is kind of very close to our hearts, because that's what we do every day. All right, so metrics in tech, or metrics just in general. Let me start with like shedding a bit of light on what are metrics and what they are not. It seems so obvious, but we see that a lot of companies, a lot of teams, a lot of managers kind of use them not in the best way possible, let's say. And let's say metrics are a good compass for management steering. They are a tool for self-improving the organization, teams, the product, and a good way to align goals, ambition, and priorities to grow a company into being more of a kind of, some of more autonomous entities which is the foundation for growth. However, metrics are not micromanagement tools for teams individuals. So it's not about like going into teams and like trying to manage individual things, aspects of a team just by using metrics. It's also not the cure for evil, because in the end, they are not the goal, but just a means to an end. So even if you have, for example, OKRs and set yourself KPIs, the KPIs that you're using is a language with it, like a means to an end, right? So you are trying to bring everyone together by using that metric, but the actual goal is something different. It's a real change within the company. It's a real change within the world, but it's measured by KPI, and the KPI can be wrong, needs to be improved, and so on. So don't use the KPI as the only thing that you see when you talk about goals, right? In a lot of cases, we see that organizations try to implement metrics and KPIs and just stay at a very, very high level, the surface level, and think that by having KPIs, they're doing everything right. We believe that in the end, it's a cultural aspect, and everyone in an organization that wants to use metrics as an operating system, let's say, to grow, need to understand the system behind, right? And here's just like two areas which are very important to understand, that when we talk about metrics and KPIs and targets and goals and so on, in a lot of cases, these are used as like almost synonyms, but they're not, right? So you need to understand the cascade of things. Metrics, just numbers, then KPIs that are like key performance indicators. So what are the metrics that you want to use that make you understand how your business, how your team, how your product performs in a specific market, right? Metrics is like almost everything that you measure. KPIs is a subset of those, or even just a ratio of different metrics to make you understand how the business goes. The target then is just like a KPI and where you envision it to get to. So define KPIs as indicators for success and failure in a specific time, in a specific case, and then you set specific goals, specific strategies to you want to leverage to accomplish business objectives, right? And understanding this makes it more easy to communicate and to discuss certain things within your organization. Because in the end, you have business people, you have product people, you have tech people, you have managers, you have individual contributors, and bringing all of this together needs a specific framework. This is one of those. Another one is on the other side, on the right-hand side of my slide here, which is understanding, and I know it looks very obvious, but in the end, it's not, to understand what are you actually talking about. Is the KPI that you want to put in the center of your, like, let's say, intention in a specific meeting, is this an input? Do you measure process? Do you measure the output? Or is this all about impact? And specifically for setting goals and targets, this is super important, because you want to know, and you also want to align everyone behind that thinking, if the leverage that you currently see is on the input side. Right? So for example, as a company, you might see that hiring more people makes things better, because currently you have a lot of bottlenecks in your engineering. Oversimplifying here, but in the end, it's an input, right? How many people can you hire? It's not the outcome, it's not the output, but you leverage the input. In some other cases, especially when you already grew, this input is actually not what you want to leverage, but you want to leverage the outcomes. You need to know more, think about, okay, how can we actually say more no to specific priorities? And measuring those means that you need to have a great understanding about what is the value of each of the initiatives, each of the features, each of the systems that you're running. And then you can have an impact on the actual outcome overall, right? So that being said, there's another framework, and that's something that we use quite a lot when we speak to founders and leaders within organizations, which is looks a bit complex here, so let me try to step back a bit and simplify. So when you have an entity, whatever it is, might be a team, might be an organization, might be the whole company, might be a product, or just a feature. You always have two perspectives on those. One is the perspective from the outside. So how do you know that this is successful? Right? For a company, it might be the market share. For a team, might be, I don't know, the feature adoption rate that of the features that the team is building. Might be also some quality measures, like how many bugs does the team produce, also, and so on. And then you have a different perspective, which is from the inside out. And this is only who is part, or what is part of that entity looks into in order to improve. So there's an evolutional metric or evolutional perspective for teams, for products to improve over time, right? So the outcome of that will be eventually, and hopefully, be more performant outside in view. But in order to get there, you need to grow. One example for that is discussed in a lot of companies, which is velocity, right? Velocity is a very typical evolutionary metric, which is only true for one specific team and cannot be compared across teams. But there are managers out there, there are companies out there that use that specific metric as a KPI to measure team success and to measure if teams perform. And then they even start to compare specific or the different teams with each other. That's not possible, right? So in the end, that's a metric that the team owns, uses in order to become better, but it's not something that tells you anything about the actual success and performance of that specific team, right? And you can apply this framework across like all different layers of company, roles, products, as said. In the end, the important part here is that you always need to know what are you actually talking about. Is this a metric? Is this an aspect that speaks about a specific, about the impact of a specific entity, or is it something that speaks about the growth of a specific impact? As a manager of a team, for example, like let's say a VP of engineering, and you have multiple teams, you should be interested if teams use metrics like velocity, but it's not a measure that tells you anything about the performance of a team. So leave that to them and really look more into the quality that they produce, the impact that their features have, and so on. Then when you go into a specific tech team or product engineering team, the curation of the optimal set of operational metrics is super important. There are different starting points here, and I would really say if you're a startup, you should just start by using those and then adapt over time, add more things, like for example, the DORA metrics or the space metrics. They talk a lot about the team, right? It's, evolutionary metrics that speak about, okay, how does the team work, and is there anything that they can improve in order to create better products? But then there's also system metrics that you need to find. The most important thing here is that you should not only look into one thing and just measure for the sake of measuring because someone else told you, or because there's a specific system like DORA, but really understand what is the system that you're in, and then try to capture the overall system. I tell you why. Here's a little video of a very simplified team system, let's say, right? There's trust in the team, psychological safety, engine happiness, but also something like external things like the customer happiness or the work in progress, speed of iteration. And I try to model here how these different elements relate to each other. And in order to understand this, you need to have metrics. Right? Measuring the work in progress is kind of easy, but customer happiness is not just something that you say, yeah, our customers are happy because we read so in our app reviews, but something that you need to measure. And then you really can understand how certain things belong to each other. And why that? Because not to have the numbers, but because you want to find how you can actually optimize the system. So if you see that that the employees, that the team members in the team become unhappy because you measure so, then you find out, okay, there are other things that might impact those this element. Bottom line here, really see that you measure the overall system, team health, quality, infrastructure, application, and also product, and just don't ignore a certain level here, layer here. One thing that a lot of teams do is not really looking into product metrics, because if they are, this is for designers and product people or business people, but not for us. We look only into infrastructure. I think that's not good. We need to see both things. One example that we can also speak later a bit on is cost for infrastructure. So you measure the cost of infrastructure, but just having a number of like whatever costs 5 million euros doesn't tell you anything. But if you bring the customer and the product into it as well as a ratio, will tell you much more, which is like let's say cost per million euros in revenue, or cost per customer, cost per just traffic, right? And with that, you get a ratio and get an understanding of here's how we can optimize the overall system. All right. Yeah, product analytics, I already started to talk about that. Especially in the SaaS context, where people build, for example, developer tools or just very technical products, they tend to, not everyone is doing it, but they tend to not really apply traditional product metrics, product analytics, as we can call it, right? Like, I don't know, engagement metrics, even conversion rates, user journey metrics. And we believe that especially in a SaaS context, where of course it's very difficult to measure these metrics because you don't have the high amount of customers, it's super important to focus on these, right? Because in the end, there are certain elements, certain decision points that you want to still make, and not just out of gut feel, but because you measure so like user adoption and satisfaction of your customers. And in order to understand, is there features that you want to sunset? How can you actually sunset those features? Because you, in the end, have to see the whole product development life cycle. And just saying a feature is not there anymore does not mean that there are no dependencies and customers still using it and so on, right? So it's very complex. And in order to understand that and measure this and manage this right, we need to have product analytics here. Also, pivoting is a thing, right? To understand, okay, are users using your features in the way you intended them to use it, or are they actually ignoring specific features and so on? And with that, you get the story behind how the user actually uses your tool to solve their problems. And there might be areas where you want to pivot and just like really do things in a completely different way. A huge topic also in our world, Philips and Burns, developer experience, right? So a lot of companies nowadays, and since already many years, build their product not just with a UI for certain people, but also with an API, and with ways for developers of the client companies to use the features in an integration scenario. And measuring developer experience is super important, not just internally for your people, but also externally, to understand, okay, how are actually developers using your tools or your APIs? Are they happy with what they have? Are they happy with the documentation? How do they actually onboard? How do they test this? And so on, right? To really go into that as well. So the next question, or one of the biggest questions that we always get, be it now in the consulting context or as a manager of a specific company, is actually how can we introduce metrics? Right? You started somehow, you've been a small team, everyone knows what to do. A lot of things become, or a lot of decisions are made based on gut feel, on just like because you know the path forward, right? And at some point you believe that, or you see that introducing metrics is an important point. And here are a few things that we can mention here. Start with your culture, mentioned this already, right? So understand the systems behind how you make decisions, really push to not only base your decisions based on opinions, but on facts. This is especially true and hard for founders who, of course, need to have an opinion. They need to have a vision of where the company goes. But putting facts over everything is super important, especially when you have more and more people coming into your organization, right? Establish scientific approaches, A/B testing, for example, not just like look at the numbers, but really understand what is significance, how do you use these things is important. Yeah, and then of course, when you, I don't know, create slides, create documentation or narratives, whatever way you go for documenting things, really invest into creating insight and proper reasoning. So it's all part of the culture that needs to be behind that, because without that, metrics always will be just a side thing, right? Second point is agree to what to measure, right? So come together as management team on all different layers, right? Executive, but also in a team, product manager and engineering manager, for example, also team, and together agree what is important, right? So I showed you the cascade of things, right? From input to outcome. We look at the system that you have, the problems that you might have, or the areas that you want to improve and grow in, and then agree what to measure. It's so easy to measure everything with all the tools out there, but it's super difficult to understand what is important at this specific point in time and then start to measure those. Another element, especially in startups, in bigger corporations, might be more difficult, is democratizing data, right? So try to collect everything, try to make it anonymous, right? Of course, we're not talking about personal data, but then make this available to everyone so that they can query the data, that they can experiment with it, build their own Python script to visualize specific elements, right? And with that, make it easy for everyone to understand how the product works, or how the team works, how the system looks like. Because with that, you will get the creativity of the people back in the end, right? Thinking holistically, I already mentioned that, right? Not just look into infrastructure, but really see the whole thing. If you're a sales-heavy product, make sales available, sales data available to people. If marketing is your current thing because you want to grow, make the marketing narrative visible and manageable by using metrics and KPIs. So always see the overall picture. People development as the next element. It's just not true, right, to say, okay, we are working in a startup and everyone understands metrics the same way. No, make them understand how metrics work. Make them understand what is the conversion rate in our context. Make them understand how to use the data warehouse that you might use, etc. So invest into making people able to understand, use, and make sense out of the data that you have. It's an investment that is absolutely worth it, because it will just bring everyone behind the same goal, A, and B, as said before, you will unlock the creativity of many here. Yeah, and phased rollout is also important. It's a bigger change, right? So you need to look into, okay, what is the right starting point for that? Start with, I don't know, having a metrics meeting every week with the management team in order to understand where you stand, and then roll it out to more people. If, for example, you are already quite data-driven, but your tech teams are not, then maybe as tech managers, engineering managers, you can start by just releasing one very simple, lightweight data story every week, so that everyone starts to understand, okay, this is the impact that our products are doing, but not do not more, right? So it's all about finding the right things or the right iterations to make the change successful. And last but not least, I have a few best practices and anti-patterns that we collected over the years that might be helpful for you to know beforehand, right? So prefer push over pull situation, right? So just having the data somewhere and believing that everyone just goes into it is probably not the right idea, right? So there might be people who are interested in getting the data, but if it's hard not everyone will do it. So I told you about the data stories that you can release every week. Bring the data to your people, make them understand. I see this as, especially as a manager, or if you're leading a data team, for example, make this your responsibility to really bring the data to the people. Don't wait. Don't wait for people finding where they can find the data. Right. Another one is absolute numbers. So I've seen a lot of cases where KPIs were just absolute numbers. Cost is a good example. I already spoke about that. Put, whenever possible, things in ratios. Can be different ratios, right? So in order to understand how things correlate with each other, that in the end will then unlock the patterns within your organization, within your product, that might be worth investing into. Just absolute numbers don't tell you anything because you don't have a connection point here. And this is even true for the team invest that you do, right? So if you have a certain understanding of what is the value of your product, and you know how much you invest in the team, but just summing up the salaries of people, you have a ratio that is super helpful because you understand what is the return on invest. Really, quite a useful and well-known metric, but a lot of companies don't do it. And I think it's absolutely worthwhile to do it in order to understand where to invest into. What are the biggest, say, fruits to find, right, in your organization. Prefer visualizations to create insights. Just looking in, like, if you have a metrics meeting or like quarterly business reviews or whatever you have in your organization, just opening a table, a spreadsheet, in most cases does not make the trick. Look at trends and look at correlations means you have to have some kind of a visualization in order to talk about insights and not just about the data, right? An example here was it's like when you look into data and you see it's going down for a week, doesn't tell you anything. You can just like freak out and say, oh, let's look into this more. But if you have a bigger line and you see, okay, actually there's always a drop at the weekend, or every other week there's a drop, but overall the trend goes up, then you can relax, right, and actually go to the next thing, because there is no insight. It's just the data that tells you something, or which is not relevant. Combine metrics into dashboards. I think it's clear. Standard tooling, especially in the beginning, right? Don't invest into building your own dashboard or building your own visualizations. Really try to use as much standards as possible, because it's your company is about building a specific product and not about building dashboards, right? So use standard tooling here, which makes it also easier to change later. I think a lot about the right visualization. I had this already. Colors, chart types, consistently. This is important, right? Not having a different language just because you have a different person and they are just a different team. So make this part of your company DNA to like know when there's a line and there's a red mark somewhere, that everyone understands, this is the same across the board, and people don't use things in different ways. On the avoid side, already spoke about some of these, like micromanagement. Just makes it worse, right? It's a cultural anti-pattern here. Why did the team have 5 story points less than last week? Might be a good question, but it's not a question that is relevant. Metric paralysis, too many metrics, clear time frames. I spoke about that, right? The weekly dip, is this relevant when the overall trend is positive, right? So zoom in, zoom out, drill down, drill out. So seeing the whole picture is always important. And the isolation of metrics is also one thing, right? So ratios is one way to do it. Another is really to have dashboards that put things in correlation, right? You see, okay, here's the product metric goes up, but at the same time revenue goes down, and you put an infrastructure metric there as well, or a quality metric, right? In order to really see, this is the overall pattern, this is what it tells us, and then you can make better decisions. So isolation, just because you have teams in isolation doesn't work. Question metrics, of course, super important, right? So you always need to question it. is actually the conversion rate the right thing for us, or is it something different? Does the conversion rate, as we look at it, really matter, or does it tell us the whole story, or do we need to change it in its meaning and with that in its mechanics? Always do that, evolve them whenever possible. Yeah, and then last but not least, and I started with this is, of course, metrics. That doesn't mean to an end. It's not the goal. And with that, you cannot ignore your intuition. Right? Sometimes you need to push forward in order to understand what's happening. You need to bring your experience in order to, yeah, in the end, it's human work that you're doing, and metrics only help you to get to common language, let's say, to drive decisions. All right. I think that we can send out or make this available to everyone who sees this talk and the Q&A. Here's some useful resources that might just help you to deep dive a bit deeper into that. But yeah, as I said, we can definitely make those available to all of you. All right, that was it from my side for now, and I'm now happy to answer your questions, Hugo.
Thank you very much, Bastian, for that insightful presentation. And yeah, the resources you've added there at the end, I'll add it into the description so people can have access to those. I'll also put your contact details as well as Phillips and Burns' contact details there. So if anyone wants to get in touch and dive deeper into those, that'd be great. Well, look, I think you've gone into a deep dive into metrics. I just want to take it back a bit in terms of you. First of all, how did you get into this sort of industry? And let's say, how has your perspective of the importance of metrics evolved since your start?
Yeah, it's a very, very good question, because it's indeed an evolution. Right? So when you start somewhere, you're like very energetic. You go into products, you see what's going on there, and you are very opinionated. Right? And I see this also with a lot of founders out there who are like young and like start something. But over time, I understood that being led by intuition and being led by metrics is not like a black and white view on the world. Actually, you need to combine both, because as I said in my talk, the metrics give you a language and give you signals to prove your intuition, prove your gut feel, and then drive better decisions. I think that really developed over time when you are more complex scenarios, right? In bigger companies where there's not just 12, but maybe 40,000 people, right? And then you have to drive a decision like, okay, do we actually need to platformize this? Do we need to invest into reducing the cost of this and that, let's say, infrastructure? And yes, you can always say, yeah, I believe that, because I see it's very, very costly, right? So I've seen other things before, and why don't you believe me? Whatever. But if you then use metrics, you get to a certain language. And in a lot of cases, also investing into understanding more about the actual opinion that I formed by using metrics led me to a conclusion that actually my opinion was not right, or was only partly right, and also informed me. Another element that I really, that I learned and really liked and leveraged today is the value of KPIs for leadership. I'm not speaking of management, but leadership, right? Especially in tech, people oftentimes don't know what they actually produce, what's the impact of things, right? And what I did, for example, at Omio, quite a lot is really myself going into the data warehouse and getting data out and making understanding, okay, how many tickets, right? It's a ticketing platform for buses and trains. How many tickets did we sold today? And then putting this into context, how many trains did we actually, like if you put the tickets, and then how many trains did we make full over the last week? And then sharing this with the engineers. And this in the end helped them to identify with the product, with the company, and make them proud about what they actually do there every day. Right? Because what they see is code, they have all these challenges and bug fixes and technical debt and so on. But investing into those and having these data stories made it tangible, and is a great leadership tool.
Yeah, absolutely. And, we find it a lot. I'm sure you do as well. When companies, when founders are asked during the due diligence process about different metrics, Some of them who haven't installed it need to spend at least 1 or 2 weeks getting it all together. And it's really important for investors. So I think, it's one of the things that we usually tell our founders: have you got this metrics ready, etc. But I think one of the interesting things I want to get to is you've worked at large tech organizations. Zalando is an example. Are the metrics different at different state, as in, like, is the importance of specific metrics different for different stages, or is it still very similar depending on the stage in terms of the most important metrics that the executive team need to have a look at?
So of course, right, the mix of KPIs is different, as I outlined before. You might measure the same things, but in the end, what you look into, the actual KPIs, key performance indicators, is different, because you have a different, different focus, priority as a company, right? While a growth startup might look into just growth and ignore profitability, at least for now, a bigger company where the cost can be extreme and the growth is not so big anymore, you want to look into profitability, right? With that, of course, the focus changes. Another big difference, of course, is that it's way more difficult to give a holistic perspective to everyone in the organization, right? So at Zalando, I led a platform team quite far away from the actual product, and obviously there were metrics like conversion rates and engagement metrics and so on, but they were in a complete different department, complete different area of the organization, and it was very hard to say, okay, what we do here and how it relates to how customers use our product was almost impossible, right? So you need to find ways to still tell these stories and make this available. The silos that form in bigger organizations are good for some ways, right? Because you don't need to discuss everything with everyone. But at the same time, there is distance created, and it's very tough, right, to bring metrics to everyone. And I think this is a fundamental responsibility for leaders and managers in these organizations to connect the dots, right? So I'm leading this organization, need to go out to the marketing people, understand, okay, how do we actually make revenue with the data, right? When people click on certain advertisements on, we were speaking about Zalando, how do we make revenue here? What does it mean if, for example, certain elements in our backend, when we measure events, get lost? What's the impact on revenue, right? And I need to understand this complex, let's say, scenario in order to bring the people in my teams along. So this is way more difficult, and with that, let's say, the challenge for leaders is more into that, right? And in a smaller startup, of course, it's very easy, because founder, when they speak about that, you have dashboards available for everyone. It's more like a very easy, hands-on, or organic approach.
Yeah, absolutely. And look, can you share maybe an example from your time at Omio where a specific metric significantly influenced product development or strategy?
Yeah, so of course, cannot go into like lots of details here, right? Not talk about how the company strategy looks like. But one thing that I can say is, during my time there, we made a quite big decision on investing into flights, right? So it's a ground transport platform doing a lot of for bus and trains mostly. But we also saw that it's very difficult to become a global platform, because ground transport and trains and buses are by definition local businesses, right? Mostly local businesses. You cannot go with a train from here to New York, right? So you need to have something in between. And what we've seen is that people use it once when they travel, maybe coming from the US, use it once to take a train, but they never use it again because they only fly to Europe every, whatever, seven years, right? So what we understood is actually we need to find something that combines those local markets, and this is only flights. And this is what we really made to measure, right? Okay, when we have people searching for flights, do they use the platform that we have even more in their local markets, right? And this was definitely definitely one area where looking at the metrics, looking at how the customers behave, made us then decide to invest into flights and making flights a product of our company.
Yeah, it sounds like, yeah. I mean, metrics sounds like it's been a lot of influence on that. And look, another one of your personal experience, right? So you've successfully reduced cloud costs by implementing cost metrics at Zalando. Can you guide us through that process as well? I know you probably have a lot of different examples, but if we can maybe focus on that one for a second, because it was a significant amount of savings as well.
Yeah. So first of all, it was not me, right, reducing costs. It was about the team.
Yeah, of course.
The difficulty here was that there was a system that cost like 12-14 million a year in terms of infrastructure. And we measured, and I outlined this before in my talk, we measured total cost against budget. And when you do that, right, your reference point is actually not the right one, because when you say I have 15 million in budget and your cost is 12 million, you just change the budget with the growth that you have. In the end, you are in a way lying with two. So what we did was actually trying to find a way to measure let's call it kind of the return on investment, to find a mechanic that tells us about how efficient is this cost, right? And what we did is like trying different KPIs here, and we ended up with having cost per million events, because the machine that we actually speak about is a kind of a stream machine where customer clicks, customer engagement, right, goes through. And we found out that actually there's a lot of variation in that. So by looking at that number, we understood actually when this is not stable, then there must be ways to reduce that, right? And we looked into the architecture, we looked into the infrastructure for ways to optimize this. And then we just used this metric as a guide for us to experiment with certain hypotheses that we had on the infrastructure. And in the end, right, so long story short, we iteratively reduced the time by almost 50% overall over half a year, by not changing how many events go through that, but actually by changing how the RAM was, the memory was used, how the architecture was designed on the back end, and so on, right? So there were a lot of different things that we were doing. The important point here was really that we had a measure that told us the variance of things, how things relate to each other. This, in the end, also helped me to rationalize the invest into that area, so that I could get, like, the buy-in from my managers and the managers of their managers to say, okay, the team is busy in optimizing that part, so we don't have enough capacity for other things. But this is worthwhile looking into, because we save 5 million or more than 5 million year over year, and in the end, this will amortize itself, right? So this was really, I think a good example for how you can actually make things tangible by doing metrics, and not just like your gut feel.
Yeah, data rules the world. And look, in regards to just generally, right, what do you feel is the most underutilized metric in tech product management, and why should teams pay more attention to that metric?
I think one of the most underutilized metric is developer experience internally, not the one that I mentioned before in the SaaS context, but really internally. Developer experience might be misunderstood as happiness, and people need to have a good time at work and so on. But I think it's not. It's like, do they have the right tooling? Is the onboarding that they have right? The decisions that are being made, building or buying certain things or whatever, right? All of these need to be well understood. And especially when you grow larger as an organization, you will have it's called kind of a microservice architecture in your organization, right? So you have a team that builds something that another team uses. So, and then developer experience becomes even more important, because that team that builds something, in a lot of cases, I've seen that you know, they think, okay, the other teams need to just like take what we build because we believe it's good. But if you put developer experience as a cultural measure for you to, you know, evolve your organization, then the other team needs to think about, okay, is the documentation that we write about that specific element that we provide to other teams, is it good? Is the API well understood? Do we use the the right standards here? And so on, in order to not just provide some piece of technology for others, but also make it useful, make it great, make it, improve the culture, right? And this is specifically true for teams that have which purposes it is kind of to maintain and implement external tooling, external platforms. For example, localization is one thing, right, where you translate text elements. They look a lot into, okay, how do editors, marketing people use this tool in order to translate their copy? But in the end, this tooling needs to also be integrated in the product, in like whatever your landing page machine is like, or whatever, right? And this element of developer experience cannot be forgotten because there's a lot of frustrations in it, right? If implementing or integrating an external tool, also an internal tool, is hard, right? Is heavy lifting for them, then it will just reduce the happiness in the team, the engagement of them, and also the adoption to that new technology that you want to introduce. So looking into developer experience, I think is fundamental, especially in organizations that grow and then create these dependencies.
Makes sense. And you know, you mentioned earlier, you know, metrics are not a cure for all evil, right? And they're not the goal, but a means to an end. But a lot of the time also metrics often tell a story beyond simple numbers, right? Can you maybe describe a situation where you use metrics to, or your organization use metrics to craft a compelling narrative for stakeholders? Perhaps it swayed a strategic decision or highlight an overlooked success.
I mentioned the one with the flight and train and Neo, right? I think these were a good example. Let me think about another element. So my time at Delivery Hero. This is actually a super interesting one. We looked into conversion metrics, right? Very simple. People order food, put it in their basket, add their address, click a button, and then some rider comes to them and delivers the food. What we've seen is that across different markets, you know, and the platform was built from for products for South Korea, Taiwan, Singapore, Pakistan, Sweden, Germany, right? So in a lot of different cultures, that conversion rates were very different, very, very different. And we did not understand why. And we looked into that and we compared those and we made like drill downs into, okay, why is actually, I think it was Pakistan, but doesn't matter so much, was way more below that. And the user behavior seems to be off. And we first thought that there's a bug. And we made a kind of big bug bash and big, like, you know, deep dives into what is wrong here. We didn't find it. And in the end, we found out that actually the user behavior is different. People have a different understanding, have a different learned behavior of where do they put, when and where do they put their address, when do they want to decide which payment method they use, and so on. And with that, right, it was a great way to say, okay, I think we need to invest into feature management. So to actually make one product, not one size fits all, but actually make it manageable in a way that we decide per market, per brand, how, you know, the conversion flow looks like. And this I think this is a good example, right? So just look, conversion rate, very simple. We need to just optimize for that. But if you really go deeper, you see, actually, it's very different from culture to culture, from product to product.
So it gave you, it's crazy how metrics can highlight those cultural differences as well.
Absolutely, absolutely.
And look, with regards to, because, you know, at Phillips & Byrne, you guys are well known for your tech due diligence, right? So how do you recommend investors balance hard metrics with qualitative insights, maybe such as team dynamics or product innovation, and making informed investment decisions?
Yeah, as said before, right? It's always a holistic thing, and I can tell you, tech due diligence is about tech. Yes, it's about kind of very mechanical things like say, okay, we need to have this and this in place, but the major piece of it is almost therapeutic, right? So it's almost looking into, okay, what are the different people in the company all about? What kind of roles do they have, and so on. So the qualitative aspect is even more important. Now for us, the difficulty is how do we make this measurable? Because in the end, no one cares if we say, yeah, they are fighting about certain things again and again, right? And this might be attention. This is not something that an investor can use. So what we do actually is trying to rationalize those observations by having a score. So we have a score in place that tells the investors all about like organization, leadership, all the different aspects in the company. We have 12 different areas and sub areas. And how we do it, we have a standardized way to score certain elements of this companies by having like, standardized questions, standardized observations, blah, blah, blah. I'm not going to many details here, but this helps us then to give a perspective of the company, which tells like, here is elements that you need to look into. Here's elements that might be, I don't know, problematic. We can translate those into recommendations to improve. And even more important, we can benchmark those, right? Because we can say, okay, a Series A company in a fintech environment in Europe looks like that. And here we have a different company, and how they benchmark against those then will tell us, okay, is this correct, what we look into here, but also the investor, how like a certain target company that they want to look into performs on a qualitative level, right? And again, as outlined before, it's just a way to find the same language here.
Great. And look, with regards to Philip and Bern, how do you mentioned it a bit there. I'd love for a bit of a deeper dive from you. How does Philip and Bern tailor its approach to tech due diligence with a focus on metrics? And for startups and VCs listening, how can they engage with you to leverage your expertise in that?
Mm-hmm. So yeah, as I said, we look into many different areas, and what we do is we do two major, let's say, streams into looking into company. One is looking into what we call a virtual data room, right? So we get a lot of data, we get source code access, we get access to their Jira or Asana, and we have ways to get the data out of it and then create insight metrics. We have standard ways for that, and this is what we look into. We invest a lot into automation in that regards, right? To really make a sense out of what the company is currently producing, not just from a product perspective, but also of code, in terms of infrastructure, in terms of documentation, in terms of roadmaps, and so on. So this is one element, and obviously there's a path moving forward, right, which comes with AI, which makes it even more important to do that. And then the other element is to prove these and to question these and to challenge these together with key people within the organization. So for DD, we usually do like 5 to 11 interviews, certain formats like from a leadership, but also code walks with people to really look into things and then find the right balance between what is the truth here, what is the actual insight that we want to give to an investor. For a company to also prepare for tech due diligence is actually from the beginning make one thing key in your understanding, which is that as a founder and as a leader, you're not building a product. What you're doing, you build a company that creates great products. It's very important, very different perspective, right? And if you understand that what you do is actually building a company to build products, is that you need to invest into all of these elements that create leverage and scale along the way. Of course, a product can scale, right? Product scale is a complete different perspective here, and a complete different way of looking at something. But creating a company that scales and leverages is even more important, because a product can only grow to a certain, let's say, goal. But what comes after that is only possible by having a great organization. And that being said, and that's what we look into. That's also what investors are interested in. Not so much interested in the current product. Obviously, this is one element, but what they are more interested in is how is the team, is their experience in scaling teams, what is the team setup, what is the organization, so what kind of dependencies do they have, blah, blah, blah. And this already gives the answer of how to prepare for a DD, which is just like focusing on your company, focusing on documentation. Do you have developer onboarding in place? Do you have the right metrics in place? How do you leverage metrics? Is there a way to scale teams in an organic way, or do you always have to reinvent the wheel because, oh wow, we have a new product and now our front-end teams becomes 20 people? Is this manageable? Probably not. So from the beginning, think in product teams, for example, right? And this is, I think, the major focus. And I would also personally believe that this makes is one of the fundamental differences between just good product and great organizations.
Okay, sounds good. And for people to get in touch with you guys, for you guys to help them with any kind of metric related or just general tech due diligence, what's the best way for them to do that?
So, I mean, obviously you can find me on LinkedIn, right? That's the best way. Just reach out, send me a message. That's definitely possible. I also will added already a link to my Calendly that you find later, right? So book a session with me, definitely possible. Another way is I mentioned, you mentioned before that I'm also leading this mentoring club. There's also a way, right, to get in touch with me for like some 30, 60-minute mentoring on these topics. So that's the ways we have.
Okay, great. And look, last question. And I want to first of all say thank you. It's been very enlightening, actually. And also, your real life experience actually puts that tangible, sometimes intangible metrics to actual some real life applications, which is refreshing. But look, as we wrap up this conversation, could you share one tip, and just one, for founders on how to effectively leverage metrics?
Not just talking about the metrics, but actually making it almost like a product yourself. So visualize it, evangelize it, and make it not something that is there because you have to have it and because others have it, but really make it part of your DNA. Right. Okay. So if let's say let's talk again about this conversion metrics, which are kind of boring, but it's always because everyone knows about it. If this is what you're looking into, make it part of every single conversation that you have, make it part of your management meetings, make it visible, bring it to the screens, right? Be proud about it. Show like the company in your Orleans meetings that here is the hockey stick and that's how we did it. We are proud of your engineering team because they unlocked this specific change in our on our metric here. I think that's the number one metric. So if you want to be a data-driven company, take it serious and make it a premium member, let's say, of your startup's elements.
All right. Very, very, very good tip. Look, Bastian, thank you very much for your time today. It's been an absolute pleasure. And as mentioned, Bastian's Calendly will be in the description. So feel free to reach out to him and his team. But thank you very much, Bastian.
Thank you for having me. It was a pleasure to be here.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
So, welcome everyone to this CapitalHQ Masterclass session, where we have the privilege of sitting down with Simon Brendel, Associate Partner at Phillips & Byrne. Simon brings a wealth of knowledge and insights into the dynamic world of tech investing, from seed funding to major M&A transactions. Simon's expertise spans the full spectrum of the tech ecosystem. Today, he's here to share his experiences, predictions, and strategies for investing in tech, offering invaluable advice for investors navigating this evolving landscape. Join us as we delve into the intricacies of the tech investments with one of the industry's leading minds. Welcome, Simon.
Thank you. Thanks a lot for having me. I'm really looking forward to this conversation.
Fantastic. So look, before we dive into the intricacies of tech investing, could you share with us a bit about your journey that led you to becoming an associate partner at Phillips & Byrne, and what drew you to focus on venture strategy, technology, and innovations within this role?
Very happy to. So I was initially studying liberal arts. I wasn't a lot into the business world, and I was doing the typical internships, so banking and consulting, the stuff you'd normally do, right? And at some point I realized that maybe that's not for me, because you can't really move a lot of things day to day or operationally. And I went into the startup world. I was with a startup in Munich. I'm also from Munich. And we've built a marketplace to rent construction machinery. And that was actually where I really felt I can move day-to-day operational tasks, not like in banking or in consulting at the big consulting firms. And we built the company out, and it was really great. We hired a lot of people. We raised a lot of venture money. And that's also how I got into the whole venture private equity ecosystem. And I was also responsible for the whole product side there. So kind of that was also my intro to tech. And then after couple of years and around 25 million venture money raised, I realized that I'm more of a builder, more of the early phases in actually building the company. And then we had around 100 people, and I realized I'm not a manager so much, and handed over to other people, and actually was looking out for what I want to do next. And I was actually about to go into an investment role, but then realized I'm actually want to focus more on the tech side of things, similar to investing, but more tech heavy. And that's why we scaled Phillips & Byrne over the last years, which is a tech advisory company where we go a lot into transactions with investors, with scale-ups on tech side, and advise them how to build the best products, how to be the best tech companies possible.
Yeah, so you want it to be a big cog in a smaller machine is essentially...
You could also say that, yeah. You could also say that, and also still be a bit more technical than the average, because we're not doing finance advisory, not really look into finance. We just look into tech, and that's what I wanted to learn more about, as I feel that tech is moving the whole investment scene over the next 10 to 15 years.
Absolutely, and we'll get into that. I think it's going to move the next 10 or 15 years, and it's moved significantly in the past 10 to 15 years as well. So look, having been at the forefront of guiding significant funding and tech assessments across Europe and beyond, how has your experience shaped your perspective on the tech ecosystem?
And it was quite interesting, because in the last years I now was involved in about 100 transactions from all sides. So really small, as you said, really small seed transactions, but also then really big fundraisings and also M&A private equity transactions. And first of all, and obviously if you build your own company, that's not what you see, but the variety is really big. So in Europe, you have such great software companies, but you also now start to have all these crazy deep tech companies, all these great innovations coming out of Europe, of all the different centers. And tech is not like one bucket where you can fit everything in, but it's so diverse and it's so great, the tech ecosystem we have. And that's a really cool learning. But then you also see that a lot of the companies also across the fields are very similar in the topics they have across the different stages. So a lot of the seed companies, whether it's software companies, whether it's deep tech companies, have similar challenges, and also across the stages, Series A, B, growth stages, and then also in M&A, questions typically do not vary so much across the different segments. And then obviously you have also a time horizon in my learning. So I started with before COVID basically, and took the whole COVID down in the beginning of 2020. And then we had the last couple of years, we had the craziness before. Now the last 1.5 years, the whole venture ecosystem was down, and saving a lot. So yeah, there was a lot of shift, and also how you scale your tech company and how you plan for it.
Yeah, absolutely. And at Wholesale Investor, we work with seed to Series B companies and tech predominantly, right? So what we often see is what we've seen recently. So I joined in the summer of 2021, right? So that was the peak of venture investment, right? But I only saw 3-4 months of it, and then it started going down. And what we found is that now it took a while. It took maybe a year before the shift started happening in the founders' mind space, in that they are now all about sustainable growth and profit, right? I'm sure we'll touch on that. Maybe you can talk a bit about that in terms of that evolution, especially since COVID, especially since 2020, perhaps after the down that we had at the start because of COVID, and then after it started picking back up.
Yeah, I mean, as you said, like there was this down where it was all uncertain. We didn't know like what is even a lockdown, how does it work? I mean, that was still the crazy times. Like how does this all work? What will happen? Are we all gonna die? But after a couple of months, everybody realized that it's probably the biggest push for digital innovation, for everything digital in general that you might get. And so venture was pouring in a lot. And also, obviously, we were still in a zero interest environment. So fundraising for investors was a lot easier. And then we had 2 years of absolute craziness, or 1.5, 2 years, around about, however you define it, where basically everything was about growth, even at all costs. Also in tech, you would just try to grow no matter what it takes.
Yeah.
And also, obviously, we had it in advisory. So it was never about how to be more efficient, how to refactor your code, how to scale efficiently with the resources you have. But the solution for every problem was we just put in more resources because we can get more resources, right?
Yeah.
And a lot of companies were doing that also then into 2022, as you said, in like summer 22 was a bit of the breakpoint where the first fundraisings were going slower, interest was rising, and also GPs had a harder time in fundraising actually. And then it was kind of a dragging out effect where all the companies now realize slowly but surely, hey, we might not get as much money fundraising further on. So we have to be more efficient with what we have. And that's also the main theme then of late 22 and the whole 23 is actually like, we have to be efficient. We won't fundraise. We may do a bridge round internally with existing investors, but we will probably not fundraise. And if we fundraise, probably not at the existing valuation or with a lot of structure in the deal. And so basically in 2023, also the advisory projects, all the mandates were actually like, okay, let's imagine they don't get more resources on tech. How can they scale efficiently? Or can they even scale efficiently with the existing setup? Or is there so much tech debt, so much challenges on tech that they might have trouble scaling into, for example, enterprise segment or larger clients in general, or even just higher margins?
Yeah, absolutely. And coming back to to what you guys do at Phillips and Byrne, you work with both the investor side, right? With clients, that's really remarkable. Axel, Early Bird, and then you also work with the startup side. How was the feeling? How did you realize it pretty quickly that the investment flow and the investment time was getting longer, or was it really when the general market started realizing it?
No, we realized it actually pretty quickly, to be honest, because I mean, we are at a pretty interesting spot because the investors typically come to us when they sign a term sheet, and sometimes even earlier when we discuss certain industries or verticals and whether an investment there is interesting or what company in a certain vertical is interesting. So we were in a pretty interesting spot because we started noticing that the investor interest is basically differing a lot from our initial forecast. There were just no investors coming to us, and you have the venture world is really cyclical. So you have this down in January and you have this down in summer, and that's quite typical. And basically in August, you can't really reach an investor. You will hardly reach any investor in August. And that's quite normal. We know that. And there's also no inbound from investors in August or in January, typically, or very low. But then over the whole spring in, for example, 23, there was literally virtually very little inbound, and it was totally different from what we normally experience. And we realized that also for the whole year then, there's a lot of down. But vertically for us, or happily for us, what happens then is obviously there's a lot of M&A coming up and a lot of private equity investors, because if companies can fundraise but need cash, they are looking for other methods of exits or even of investment.
Yeah.
And then private equity is getting involved, maybe even an M&A consolidation in a certain industry is happening. And that's also where we act as an intermediary between these investor types and the company.
Great. And look, reflecting on all those challenges within the venture and tech scene in the past year and a half, 2 years, what key factors do you believe will drive the European tech ecosystem in 2024 and beyond?
Yeah. So, I mean, one thing that's very certain, and that's still quite a big push on the industry, is the whole deep tech topic, deep tech industry vertical, however you want to call it. And that's basically not only deep tech. I mean, there's all these studies that you get a better return in deep tech, and it is the way bigger market and everything. But the underlying topic is that the industries that deep tech is normally pushing into, or deep tech companies are normally pushing into, are just industries on the rise. I mean, it's climate, it's the whole impact climate topic, which obviously we don't need to argue about that. It's one of the pressing topics of the next decade or even 50 years. The same about the whole military sector, where deep tech is often moving in. We've now seen that military investments have been a little underserved in the last years, and a lot of funds, a lot of private equity funds, a lot of venture funds are pushing into that segment because they realize that there's a huge return and huge upside there. And then there's also a lot of governmental money flowing into it. So we have a lot of subsidies and investment support. And that's basically pushing the deep tech side. Subsector of deep tech and venture, I'd say, is the whole AI topic. And yeah, also they are driven by the US, driven by the great innovations there on the whole LLM, but also on the semiconductor side. That's a huge topic and will drive the whole venture segment. Sort of all the layers, all the different stages in the AI process are just pushing like crazy, and will drive a lot of venture push. And then subsequently, that will also, again, AI will enable a lot of business model innovation in different segments where you will see venture. So all the big old industries will be challenged by AI, and there will be young challenger startups going into whatever industry, old vertical, combined with AI, especially where you can gain proprietary data. So one big segment that we are seeing, one of the biggest industries, is generally health tech, and also industry where you can do a lot with proprietary data. So you can get a lot of data in health, and from that data, you can then again gain competitive advantage with AI. Similarly for manufacturing, just a very big industry, predictive maintenance, QA, for the product you manufacture. And there's also a lot of potential for AI happening.
Absolutely. And I think, talking about the couple of pieces there from what we've seen last year in terms of the data of the companies that have successfully raised capital on our platform, etc.
Yeah.
A lot of, first of all, it's lower than it was in the years before. I think that's just general market.
Yeah.
When I joined, fintech was, as long as you put fintech on your thing, you were raising capital pretty much. Yeah. That's an overstatement, but you get my point. Last year, what we saw was obviously a downturn in everything, but the two that really spearheaded is climate tech, green energy, impact. And the second one was agriculture comes into that. And the second one was med tech, health tech, huge amounts of that, whether you're a medical device or whether you're pioneering maybe new research into drugs or even new treatments. It was really impressive. And last year I was looking at trying to get speakers for another event, and I came upon NATO Innovation Fund, with 1 billion euros. So I think that's also their push into, I don't know exactly what they do, right? But I can only assume it's a lot about deep tech for military purposes and probably other things.
Exactly.
Yeah. But look, let's talk a bit more about deep tech and AI in general. So maybe what would be great is for a bit of a definition of deep tech from yourself and what you consider deep tech, because online and people have varying definitions. So it'd be great to hear about what you think is deep tech.
Yeah, that's I mean, that's one of the big questions actually. What is deep tech? And a lot of the investors also, is this deep tech? So what we typically consider as deep tech is if there's considerably IP built within a company. That's actually, I mean, if you build a software company, especially if you build a SaaS company, you might also build IP, of course, but typically in the standard SaaS company, also in the standard fintech company, in the standard software company, there's not so much of IP that could be patented that is actually proprietary involved. Of course, there's exceptions to this rule, right? But what we typically consider deep tech is something that could be patented, may not be patented because of the bureaucracy around this process and the lack of speed involved, but could be. Quite often it's also a spin-off from some sort of scientific organization, can be the case. And that is what we typically consider deep tech. And again, this can be, of course, in software. So a lot of the AI topics, a lot of the machine learning topics are spinning out of scientific innovations, but can also be in all kinds of software hardware combinations. So IoT, we've done a lot of autonomous driving also, autonomous driving cases. And there it's quite often the case that it is considerably IP involved. And that's what we consider a deep tech company or a deep tech case.
So considering that and what we've talked about, there seems to be some sort of resilience in the deep tech field amidst everything else that's maybe contracting. Yeah. So why is that? Like, what unique value propositions do deep tech startups offer to investors and to the general market?
Yeah, I mean, what I just said, if you have certain proprietary IP or if you have IP that could be patented, normally that also means there's quite a moat in the company you're building. So typically in traditional software cases, the moat is more in your customer login and in the go-to-market you've built, for example, and then the customer go-to-market expansion. But if you have such a deep tech case that is evolving around certain IP, your competitors have to first build this IP or get the IP on their own or better IP. And that's a strong moat you're building in your own. So that's helping a lot of the deep tech companies once they have it. And then also the other cases, there's a lot more capital needed to build this IP quite often. So deep tech companies are normally more capital heavy. But that also means if you have built a company above that threshold, if you have built that moat, it's way harder to just build another company in the exact same space because investors will just say, okay, they already raised whatever 50 million, build this IP. Why would we fund you doing the same if you again have to build the IP? So there's a very different risk profile. And then there's a not so much technical factor, but often deep tech companies, as we just said, come with less cyclical industries. So the whole climate, the whole agriculture, the whole medtech. This is just industries that will always be working, even if, as right now, the economic climate is a little bit down. A lot of the companies that the deep tech startups are serving, a lot of the industries that deep tech companies are serving are just less cyclical and better markets or better companies to sell to than the typical software SaaS company.
Yeah, so more long-term and sustainable in terms of what the output they can do. But look, you mentioned moat there, right? Which is very important for deep tech. I was wondering what the value when investors look, right, for SaaS companies, fintech companies, a lot of the time they come back to product market fit. Is there product market fit?
Exactly.
I'm sure it's the same for deep tech, but from what I hear and just general feeling, and this might not be the way to go, right? But it feels like the moat of a deep tech is almost as valuable as product market fit for investors. Is that the case? More so maybe than a SaaS or a fintech?
Yeah, exactly. So in the early venture stages with a deep tech company, it's quite often the question, not like, does it fit into a market, but can you actually build whatever they have in mind, also at scale? So can you actually build this fusion reactor or this rocket engine or this semiconductor manufacturing machine or this medtech device? Is it actually from the theory and the IP and the patent they may have, is it actually buildable and scalable as a venture case later?
Yeah.
And that's, in a SaaS company, you just don't have this, or in a software company, because you can build most of the stuff with software that's envisionable, right? You can just build it, just needs time and resources. But for a deep tech company, you have this way more often. And then again, this, if you cover, or if this technical risk is covered, then you get to the market risk. But normally the assumption is that the market for the deep tech companies is secondary. There's way more the question about for technical risks and whether you can build it, which again gives you this moat that we spoke about.
So this leads very well into the next topic that I'd love to talk with you about, you know, the role of due diligence in all of this, right? Because product market fit obviously takes due diligence, but I think from a due diligence perspective, if you look at the numbers, if you look at the team, it's probably easier to find whether a company has product market fit, right? Whereas that moat, especially considering that moat usually means novel, new, something that's disruptive, something that people, general investors, or even technical investors might not necessarily understand, right? So from that perspective, what kind of framework should investors employ when looking at a new deep tech company that has a new moat?
Yeah. So, I mean, if you speak to, obviously, a new deep tech company, you always need experts from that field to challenge them. And that's, in deep tech especially, that's quite often very hard, because you have there's these funny cases where it's like a really, really innovative deep tech company, and then you realize, okay, they are pioneering this concept, and there's maybe 10 people in the whole world who actually understand this concept deeply enough, because it's a really new scientific concept. And obviously you need one of these 10 people to actually DD the founders, and the founders is probably 3-4 of the 10. So that's a quite interesting challenge in deep tech, is really going into what they have built and understanding deeply where the technical innovation they want to pursue or want to build is involved. But then also there's certain standards across companies that you can involve, and quite often it's repeatable in whatever you're looking at. So there's a lot of AI cases that are similar. There's a lot of innovative cases that are very similar also in IoT, in the whole software hardware connection cases. And quite often it starts with the team. So you really challenge the team. You look in what they've done over the last years, and you also look into their plan. And that's quite often also the first thing, how they want to transfer out of the scientific innovation, where you discuss a lot of theory, where you build your IP, into how they want to build it as a technical product with and for clients. Because also the early stages in deep tech is where you start the conversation with your clients, what you normally don't do in the scientific innovation case. And then scaling out how they really want to build it also at scale.
Yeah.
So you really challenge the team. And then secondary, obviously, you go into the product. So you read the papers, if there's papers, you really look into the architecture on the software side, you look into the supply chains and the planned manufacturing, if it's a more hardware product. And you speak to clients, I mean, that's for sure. You speak to the potential clients, maybe even to the people co-involved in building the product, because that's also quite often the case, that you have industry partners that you build a product with, is also kind of de-risking, is saying like, hey, we built this rocket engine, you and maybe 5 other potential customers for this, do you want to be involved in building already? Because then you might ensure, also maybe with an LOI, that you actually want to buy it. Because if there's only like 10 potential buyers in the whole European market, you probably want to go with an LOI first and de-risk building something that they might not need down the road.
Yeah.
And co-build based on their needs. And you speak to them. So that's typically what an investor should do or would do in such cases on due diligence.
Yeah, and I'm sure, well, for the people that don't know, Phillips and Byrne, you guys are experts in this, right? And tech due diligence. Can you maybe share an example where tech due diligence that you guys led revealed maybe critical insights that significantly influence an investment decision?
So what we don't share specific cases and names. That's just one of our golden rules. We never share names. There's some positive case studies on our website. but we never share names, especially not with details of the findings that we had. But maybe I can give abstract examples.
Yeah.
So, I mean, there's typically 2 to 3 common pitfalls that also are the same or similar for deep tech companies and for more software standard or standard tech companies. One is, and I've already mentioned that, is actually on the leadership side. So if we do a tech DD, we don't only look at the software or at the product side, but we also challenge the organizational side of tech, because that's quite often a very involved factor if you want to scale your tech. And one standard thing is actually that very early tech leaders or CTOs, they are great builders. They have built the first version of the product. They are the ones that are really, really deeply involved and smart about this product and know a lot. But they might not be the perfect manager, especially not if the team scales. And it typically gets a topic around Series A, where you then ask them, or we ask them in a DD is, hey, how do you plan to build your team out? What is the critical roles you want to hire? And what is the factors you see you need in this team to actually be successful? And that is when they realize that they see themselves also way more in the role of a builder, but not the manager of this tech team. And they might need a transition and a potential new CTO, or they might need a lot of help, coaching, mentoring, whatever. There's certain formats, different formats that are involved here to actually, from being the sole builder of this product, becoming a manager of 20, 30, 40 people, maybe even more in the technical team. So that's a very common thing that we see in many Series A-ish tech DDs, and also where investors need to put an eye on, because having not the best CTO in place for every given stage has a huge ton of opportunity costs, because you hire very expensive talent into your tech. But if they get burned by not having a good manager, this will be very expensive and slow your company down quite a bit.
Yeah. And look, moving on from that, you mentioned already manufacturing, construction, and your recent blog that you wrote, you mentioned that in 2023 we saw more specific deep tech use cases, right? Including in manufacturing and construction through tech. So what should investors look for when evaluating startups in these sectors?
Yeah, so what I referred to in the blog, and that's a mixture between AI and general old industries, that's what I mentioned earlier, is there's a huge level right now if you have whatever proprietary data. So if your startup or also your old industry company is collecting whatever kind of data that nobody else has access to. And that's quite often the case in manufacturing, and manufacturing is also a big enough industry. That's the same thing in med health tech. And an example for this, as I said, is, for example, all the productive companies and all the predictive maintaining they are doing. Because with AI, there's a huge potential to automate more of this and to use the data and the unique insight you might have across the different verticals, across your clients, to automate the maintenance and to leverage your own investment and be a help to more clients. The same in health tech. Obviously, health data normally is quite proprietary. So if you collect data from your patients, if you have a whatever hospital or whatever patient service, you will have proprietary data, and you can use this data. Obviously, you have to be compliant with certain regulations, but you can use this data to make certain predictions and maybe recommend certain medicine or even supplements to people and build a new business out of this. And so that's what I mean is, in this old big industries, there's a huge potential to build new cases, even as a business model innovation based on the proprietary data many companies have, and lever internal margin profiles by that.
Yeah, and I'm guessing, probably one of the biggest ones, the biggest industry is supply chain, right? That's going to be significantly changed. But yeah, look, you mentioned health as well, right, in your blog.
Exactly.
So it has seen remarkable innovations recently, but yet a lot of it faces a lot of digitization challenges. What opportunities do you see for investors in this space, and how can they assess startup viability effectively for digital health?
So in digital health, obviously, as you said, there's huge compliance needed with certain regulations. Also, obviously, depending across different regions, different markets.
Yeah.
So also means on the other side that your company normally starts in one region and international expansion is way harder. We've done a lot of transactions and due diligences in the UK health tech market, similar in Germany, but moving from one market to another is just way harder.
Yeah.
So first of all, you have to look obviously a lot for compliance in health medtech. That's, I mean, just for sure. It's very critical data. You have to be compliant. You have to be also very secure with the data. Quite often ensured in the compliance. But then again, that's just, I'd say, a hygiene factor that most of the companies have nowadays. But then again, for the second factor, as I said, it's, for me, if I look at a company, there's just no excuse anymore for not having your data structured and usable. So you should, if you look into a company right now, look into what data are they collecting, if so, or what proprietary data, and is it structured in a way, or could it be structured in a way that's already usable for a certain data product, recommendation product on top of the existing business model. And that's, as I said, a huge lever on most of the companies also in health tech that you could have, and will increase both your top line revenue side, because you can just monetize a new product, you can build a lot of different innovation on it, but could also increase your bottom line, because you will just automate a lot of processes in your existing product based on the insights you get from the data. So that's, I'd say, especially also in health tech, that's my most common recommendation, is look into the data the company is gathering, whether it's structured and how it could be used for add-on business models or business model innovation even.
Okay, and I mean, very good points there. But for example, let's assume an angel investor who might not have the technical knowledge to understand what every data point means or what the data is. How can they inform themselves, or what actions can they take to ensure that they're understanding the market and what the data that a company holds?
Totally fair. So it's also not about understanding every data point. You rarely do that. You quite often don't have the time to do that. But I mean, also as an angel investor, the concepts for this should exist. I mean, if you do an angel investment, it's very early. Probably even the product is not existing fully. Yeah. So you would normally challenge, what's the concept in terms of data the company wants to pursue? Is it kind of sensible? And especially, what is the proprietary data they can or want to acquire with their product? So what's their data strategy? And that's what I mean. Also in the angel, in the pre-seed seed stage, the company should have at least a strategy on this side. They will probably not build it or not build much of it yet, but they should be able to explain what kind of data strategy they want to pursue and what is the proprietary data they want to build it around. And that I can also question as an angel investor and ask myself also, obviously, as a potential client, hey, is this data I would hand over to them? And would the advice, the recommendation they might give from this data be helpful to myself and to my broader audience and customer group?
Yeah, and taking this to maybe the next level, right? So we talked about pre-seed seed with angels. You know, last year when the AI hype was everywhere, companies left, right, VCs, private equities, left, right, and center were just investing in AI, right? And then I spoke to someone who had been doing purely AI investments since 15 years, right? I interviewed very similar to this, and he very bluntly stated, some of these VCs have no clue what they're doing, right? Yeah. So for those strategies, for them, what strategies would you say that they should employ, right? So is it looking to hire in-house, which may be quite expensive? Is it looking to work with a company such as yourself on a need-to basis, depending on the company that's coming in? What would you recommend in terms of strategies for them?
So, I mean, I wouldn't say they have no clue, but obviously the pace of the industry is just so fast that you really need to stay up to date. And if you have a, let's say, main job as an investor, it's really hard to stay up to date with all the trends and all the things founders are building. And especially in AI recently, over the last 1-2 years, it's just changing so extremely fast that even we sometimes are challenged to keep up with all the things happening. And so I'd say as a day-to-day investor, you will have a really hard time if you not focus on this specifically. And it's the same thing if you hire specific talent for that. So it's always the question, can this person really only focus on this? And I mean, that depends on fund size and all the different fund allocation topics. But if they can, that's certainly great. And then there's a second topic is normally hiring a third party to do that. And there's different stages. You might also hire just a scientist to do it. There's also scientists quite a lot involved in different, let's say, due diligence cases. But then also at later stages, at bigger transactions, you might hire firms like ours. And just de-risks your individual investment decision, because we see so many different companies across also different investors. And if you are the one person doing AI within an investor, or the very few people doing AI within an investor, you might still be biased by only the companies you see. And we see the company, what we see is that the companies across different investors, what different investors are looking at, how they focus on certain segments, certain technologies. And by that also we are able to de-risk also the internal bias they might have on certain topics.
Right.
I'd say, especially at, let's say, Series A onwards, you try to get a third eye view on the due diligence cases and not only do it internally. And that's also quite often we work with investors who have specific internal people for tech DD, might also have specific internal people for certain DD cases, but they still decide to hire us on that case and have us cooperate with their AI person, with their IoT person, because we just have another opinion on the company, on the industry.
Yeah, makes sense. And look, moving on to leveraging data and AI in investment decisions, not looking to invest in data and AI, but leveraging that tool, those tools. How do you integrate data analytics and AI into the investment evaluation process? And what, let's say, what advantage does this bring to your clients, but also to you?
Yeah, so that's actually, I mean, a very huge trend across investors. And also one of the reasons why investors should hire internally is automizing and leveraging the process of the investors and of the investment themselves. And there's, for us internally, there's two stages of this. So on the one hand, there's basically just optimizing and automizing the process we are having in an investment, or in investment due diligence. And that's basically just increasing the speed and the efficiency of the process. That's also how clients benefit from it, is they just get a better and faster process in
operational efficiency then.
Operational efficiency, exactly. By running certain automations, by running some analysis, for example, on the code level, on the security level, on an automated basis on a company, by also being able to run outside-in checks on companies on certain topics. We are able to speed up the process of such a due diligence. And for example, in a Series A case, need maybe 1.5 weeks for full due diligence on a company, and probably bring that even down to 1 week within this year. So that speeds up the whole process for all people involved. And then the second side, and that's the way more interesting, but also way harder side, is, again, investors are players with a lot of proprietary data, as everybody. And so the same is true for all the due diligence players. For us, the main challenge here, again, lies in how can we structure this data that we get from other DDs, from the industry insights we have, how can we structure that? Also, again, being compliant with the laws, and it wouldn't be great if we just share data we get in the due diligence with other parties, right? That wouldn't be, then we would be out of business tomorrow. But doing that in a way where we can generate benchmark insights, for example, across all the 150, 200 Series A DDs we've done, and leverage that to give you a view on your specific company you might invest in. So we've done whatever 50 companies in a certain industries, a certain industry across the different investment stages. And they can tell you, hey, for a Series A company in, for example, fintech, they are, or in B2C fintech, they are outperforming on certain tech metrics compared to the typical Series A benchmark of 2022, 2023. And that's where we are going slowly but surely, building this engine to be able to serve this on a broader market. And that's also where investors are going, comparing their whole portfolio to the outside market on a lot of different metrics.
Great. Sounds like a lot of work you guys have got on.
Yeah, for sure.
And yeah, so look, that's the model, right? That's what you guys are building. Now the input, the data that's coming in that context, what challenges do investors face in ensuring data quality, relevance, maybe bias, and how can these be mitigated?
So investors, I mean, investors are in a better or in a good place quite often on getting data, because you in a due diligence, you normally get very high quality data from the company themselves, because you will do an investment, and if it's not a fraudulent case, right, you will get data from the company that's actually proven to be right, and probably even certified. And the same is true with the mass of data being available on outside-in cases on certain platforms.
Yeah,
you will be pretty sure that you will get data out of that. Specifically on portfolio analysis, for example, there's one thing that investors need to consider, and that's the whole survivorship bias. So quite often you compare to the successful companies you had and their metrics, but obviously that's also only the successful companies you had. And you actually need to build a bigger pool of all the companies, not only the really successful ones that, so to say, survive the growth, and compare to their metrics, because you really want to have an average of the market or the subset you're comparing to, not only the successful companies, to in the end have healthy and usable benchmarks in a way. And I'd say that's one of the biggest challenges, and you can prevent that by just changing your data set in a way or adequately to not only have the successful, the surviving companies.
Yeah, absolutely. I think if you just focus on the companies that did really well, it might not just be because of the data, right? It might be because of the team that you mentioned or external factors, and the data of companies that failed might still be extremely valuable. So very important to have that holistic oversight. Look, now looking into the future of VC with data-driven investing, right? Or the future of investing. How do you envision data-driven investing shaping the future of investing, venture capital? And what role does AI play in this transformation?
I think it will play a huge role, and I'm really looking forward to that future, because we will currently VC investment is still driven by a lot of bias internally. I actually wrote my academic thesis on heuristics and biases within VC and private equity investing. And it was a couple of years ago, but you can still observe a lot of things actually being true and actually happening in the market. And VC will change, AI and VC will change that, because you will just be able to find companies and to analyze companies without applying bias first, especially in finding. Because I mean, there's still all the statistics of underserved female founders, underserved minority founders, right? And also then female founders, for example, being way more cash efficient. And will take years for sure to build up or to catch up the spaces. But especially in the selection process of companies and in the early stages, data will be able to navigate across biases that individual investors may have way better than just peer pressure, and help in the selection, help in the early stage investment process, and basically navigate a better VC investment based mostly on data.
But so completely see how that could work, right? But the model needs to have as little bias as possible as well, right?
That's one of the challenges. Obviously, the model is being fed by the data that we currently have. and the data is being built in the market with these biases. So you actively have to look into the data set, first of all, what biases might be involved, and also obviously into the model themselves and the decisions. And that's where, in general, not only with AI and VC, but AI in general, a lot of the questions are right now, how explainable are model decisions, the whole explainable AI topic, how well can we explain why a model decides for something, and how well can we detect if there, or whether there's still bias within that decision, or how much bias based on the data set will there be in that decision. But I'm pretty confident that over the years you will be, or you will have less biased decisions compared to a human alone, standalone process, investment process.
And this is a bit of a left field question that probably doesn't have much to do with our discussion. It might, but what's your thoughts on synthetic data? There's been a lot of talk about synthetic data. Do you think we'll get to a stage where it can replicate real world data or not?
I think we will get there for sure. I mean, on the one hand, it helps to augment data sets, and it helps to prevent biases in data sets already. And we will also get there to a point where synthetic data might be able to fully replace data sets in the future, but also already augmenting data sets and maybe neglect or preventing certain degree of biases, I'd say is a great advantage and a huge upside of having synthetic data.
So question on like a much smaller scale, right?
Yeah.
With this, do you think a synthetic data set or could reply to a survey for market research and give you an understanding of what the market's looking for?
Probably, yeah. I'd say so. Probably already is within the realm of what's reasonable. I'd try it out and look into the quality, also try multiple versions of that or variants, but I'd say probably yes.
That's very cool. So look, for I'm conscious of time, we have a couple more minutes, but for investors eager to dive deeper into tech investments, how can engaging with you guys, Phillips and Byrne, elevate their strategy in general and due diligence process? And maybe take us through the typical process of an investor joining you guys, what that entails, and what your outcome is, whether it's good, bad, like what's that whole process look like?
Yeah, happy to. So we typically get engaged around the term sheet of an investment. So normally the investment decision for a certain company is already being done. What we also do on a more customer engagement basis is actually discussing with investors certain industries, maybe even certain verticals, and a comparison of companies. But that's typically then on a higher level, because technically you don't have so many insights into a company or on the tech side early on. So that's only basically a high level supporting their investment decision. And we really get involved and into the due diligence once they sign a term sheet with a company, once or are in the final bid round and actually decided for an investment there. And then we start a due diligence process. We discuss the investment thesis. We discuss what they actually see in the company and why they want to invest. And based on our due diligence framework that ranges from the leadership team across the tech architecture, the scalability, the security, to the code level, to the maintainability, we build out a case for that specific company based on also the investment thesis. And we run some automated analysis. We request a data room. And then we dive into the company deeply. We do interviews with certain team members and also get back with the investor during that process. So basically reflect what we've seen, and that often gets interesting if there's a deviance from what the investor has pitched us, or the investor has maybe also defined as the investment thesis, the guiding questions. And then basically in the middle of this process, reflect and say, hey, that's what we've seen. Do you want us to go deep somewhere else, or is this all fine with you? And then we start writing the report. And that's also where we differ the most from typical tech DDs out there, because what we want to achieve in a report, and that's always our benchmark, is not only give you the, hey, this is good, bad, I don't know, performance is okay, because that we found that not to be very helpful also when we build our companies and were DD'd. But what we want to achieve is give you a benchmark across different topics, how you're performing. So scalability, for example, for a Series A company, you're above market or compared to market, maybe a little bit low in terms of scalability. And then also give actionable recommendations on all the different topics. So we have a huge list in every report. We have a huge list of the topics we found and the issues we found, but also how to prevent them. And these lists are quite often then used by the investor for board decisions, for 100, 200-day plans post-investment. And quite often the CTO also appreciates, or the technical leadership appreciates that, because they actually get a deep sparring on tech, which many investors may not be able to provide on that level. And that's how we typically run a transaction.
Fantastic. Well, it sounds really good. I have 2 or 3 more questions looking towards the future, but I think one that would be very interesting is, you know, you've worked with both startups and investment firms. You do that a lot. What key qualities do you believe define a successful investor-founder relationship in the tech sector, maybe from prior investment to post-investment?
Yeah, so we often say, and I mean, that's, I'd say also from pre-investment to post-investment, quite an important topic is openness. So put your, we always say also that everybody has the skeletons in the closet. Nobody has none. And especially in the investor-founder relationship, put them on the table. Tell the investor what's up, and also be open about the plan you have going forward, navigating them. Because as I said, everybody has them, but investors can be a big supporter in navigating them once you realize that it's way smarter in the long run to be open about them, to tell them, hey, we have this topic, but it's also, we already have a plan to mitigate it. We just maybe need resources, or we maybe need a bit of time to navigate it and to prevent it. And normally, if you run that very well, investors are open to doing that, because they acknowledge that everybody has the skeletons. And that, for me, and that's also what we've seen, helps to build this relationship investor-founder, and often is a crucial part of a successful company and a successful founder-investor relationship.
Yeah, it's on your brochure, the zero bullshit approach.
Exactly.
Great. And you know, as we look towards the future, looking ahead, what significant, maybe give us 2 tech investment trends do you anticipate will take center stage over the next few years?
Yeah, I mean, we've discussed both of them already. I'd stick there. So for sure, for me, the biggest topic of the next years is proprietary data. On the one hand, so whatever certain industry vertical you're in, can you gain and leverage proprietary data within that model, and business model innovate on that. And the second topic is also, again, whole deep tech, not only climate deep tech, for certainly a very big topic, very close to our heart at Philips and Bern, and huge stuff happening there. But then also, and that's very close to my heart personally, there will be a lot of defense, dual use innovation, a lot of deep tech in military use cases that's actually growing and will shape the next couple of years with investment, as you said, also governmental, the NATO, but also the German government, the France government, I think also the UK government are unlocking big money pools for that. On the customer, but also on the investment side. And I'm pretty confident that this will be a driving factor in the investment landscape for the next years.
You know, you talked about Germany there. I read in the Times this week, the Financial Times, Germany has just pledged its highest ever national budget, right? So we're going towards that. But look, finally, could you share one piece of advice? I know it's probably difficult for sophisticated investors aiming to navigate the complexities of investing in tech in general.
I'm at the risk of being very repetitive.
Yeah.
But again, look into data. Question founders, especially on data. If you have just one, or if I have just one advice that I can give to people is look into the data and the proprietary advantage a company can build out there, because that's the only thing that will not be at risk by AI, by challenger companies, and especially also will help you to evolve your company over the next years, is having certain proprietary data models.
Fantastic. Well, look, Simon, thank you very much for joining us today. It's been an absolute pleasure. And for anyone who's interested in getting in touch with Simon, we'll put different links in the description for Phillips and Byrne, maybe to your blog, to different kinds of things that people can have access to. But thank you very much for joining us today.
Perfect. Thanks a lot, Hugo.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
So, ladies and gentlemen, welcome to this session of Capital HQ. It's an absolute pleasure for me to introduce a leader in the world of venture capital and consumer brands, Sumit Shah. As the founder and managing partner of VHS Ventures, Sumit has cultivated a career that stands out for its dedication to fostering innovation and growth within the consumer sector. So with a deep understanding of the importance of community, experiences, and the human touch, Sumit's approach goes beyond mere transactions to building sustainable brands that create true cheerleaders among users. His expertise in identifying the pulse of consumer behavior and transforming it into actionable strategies makes him a pivotal figure in the industry. And today he's here to share his wealth of knowledge with us, offering a glimpse into the future of consumer brands and the intricacies of building resonant connections with customers. Please join me in welcoming Sumit to the Capital HQ Masterclass.
Thank you very much, Hugo. It's a pleasure to be here.
Fantastic. Well, look, before we jump into it, it'd be great to understand a bit about your background, where you've come from and what you've done, and what's led you to starting your VHS Ventures.
Absolutely. My background comes with the past 15 years in the world of early stage and later stage consumer investing and operating. From 2008, when I graduated in college, to 2013, I worked with private equity-backed brands, a lot of their operational improvements and work, both on the project side and on the business development side. So working with the private equity firms directly, and going through the transition of that time with the global financial crisis, almost exclusively spent time with consumer private equity firms. During that time, you had a lot of the direct consumer startups launching and raising their first rounds of capital, as well as the new funds launching from there. So I started meeting a lot of them around 2011. And in 2013, when I moved to the startup world, one of those investors in 2014 approached me, and as I reconnected with him and offered me to come join his brand new firm. So I helped start that firm in 2014, Brand Foundry Ventures, and from March of 2014, and was there for a number of years, investing all in early stage consumer. A lot of prominent brands that people definitely recognize from there. In 2019, I also helped got pulled in by another investor group to help start an early stage consumer and healthcare venture capital firm called SwiftArc. Was there for a number of years, helping it with its entire infrastructure, and also completed a short stint over at ClearCo, helping with their venture partnerships. So ClearCo providing, at the time, revenue-based financing for consumer brands. Then at the end of 2022, I started doing some personal checks to founders who I'd known for many years, again, all in the world of consumer, and brands, and that basically created VHS Ventures by accident, an opportunity that I wanted to build, admittedly later in my career, but I happened to, I guess, a little bit sooner. So when we officially launched it this summer, VHS Ventures is a seed stage focused, with some pre-seed, but seed stage focused consumer venture capital firm, where we focus on the world of brands and infrastructure. Brands meaning a sector specific or sector agnostic, I should say, focus on the product world. And it's more of a founder-driven thesis of how we're investing in foundational growth in brands. And on the infrastructure side, it's the tech-enabled platforms that help the business models of brands, so supply chain, inventory, logistics, data analytics, et cetera, et cetera. We finished 2023 with around 12 deals, and we're still working and building up the next steps of Fund 1, but also getting a chance to do the fun stuff by doing more in-person and virtual events like this.
Fantastic. No, and thank you very much for joining us. I know you very busy start of the year, and you finished 2023 very strong. I was looking on your website, the 12, 13 companies you guys had invested in, seems really good. One of the questions I have is, how did you decide to move from the PE sides to the startup world? What ignited that passion to launch yourself into it?
It's funny. I once mentioned to a friend of mine that my career has been a series of fortunate accidents. When I was over at the private equity consulting firm known as Gotham, during that time, I saw the opportunity to run the business development arm of the firm, as the person we worked with was leaving for the hedge fund world. And as I started working in that world, I started getting an opportunity to connect directly with the PE firms themselves and build my own network from that time. Twitter, of all things, was actually starting to really take off. And I used the platform to kind of help elucidate the private equity industry to the general public, meaning that really understanding the good, the bad, the ugly with a more down the middle perspective to it. And it was a really interesting time because, again, Twitter was starting to really grow, but you also had the presidential election in 2012 coming through, which it was Romney versus Obama. And Romney was taking a lot of shots on multiple sides about just how private equity was basically all bad and vulture capitalism and all the kinds of terms from there. And look, I'm never going to give the PE industry a free pass on there. Neither the same thing with Romney on that end, because no one's perfect, obviously. But what I think was really important was that the story was not being told correctly. That a lot of the major journalists in the finance world were using a lot of jargon, and people just in the general reporting world were not actually taking that bigger piece. And I had spent a lot of time, again, focusing on the world of consumer, but really recognizing how PE was more of a shadow industry, especially like the lower middle market to middle market size of it. And so that their capital was really helping to grow a lot of these businesses. And so as I was building that, and doing it under admittedly a pseudo-anonymous Twitter handle called PE Feeds, which is still my handle today across almost every major social media platform, it started attracting a lot of attention in the media world, which I started doing various interviews and things and started talking through it. Because my ultimate goal, while it was, of course, to help with our business, was to just really push towards a place where, like, guys, it's not hard to do a little bit of back channeling and understanding really what this actually means. For the good, the bad, and the ugly, of course. And during that time, I started getting approached by some of these new consumer funds and firms that were launching in like 2011, 2012 to really connect. One of them being a guy named Mike Duda, who was running a firm called Consigliere Brand Capital. That firm is now known as Bullish, which is one of the most successful and prominent consumer-focused venture capital firms out there. And if it weren't for Mike, and I will always say this, if it weren't for Mike reaching out and opening up his door to chat with me, I wouldn't be where I am today. And I give him a lot of credit for basically being my first mentor in the space too.
Yeah, and that sounds great. I mean, unfortunate accidents. It's like you
fortunate accidents. That's what it is here. Not unfortunate. A serious. I mean, remember, there's the Lemony Snicket book and story, right? A series of unfortunate accidents, but or series of unfortunate events, I should say. This is a little bit of a different side of things.
Yeah, no, you're right, and that's you have to take all the chances that come. You have to take the luck in front of you. But look, let's go into this consumer brand, and let's go straight into the foundational elements of a resonant consumer brand. So, in your experience, what are some of the core elements that make a consumer brand resonate deeply with its audience?
Yeah. You know, when I look at our analysis and our diligence of things, it's really focused a lot towards people, product, and pipeline. And it's something what I learned actually back in my brand foundry days too. Credit to Andrew Mitchell, the founder and GP over there and managing partner. When you're investing this early on, you're investing in people really building these businesses directly. And I'm understanding what kind of role that they fill out between a marketer and operator, a technician and whatnot. But also just how they're thinking about customer journey. You know, what are they doing? What are they making, both in terms of current and the future? And how are they actually portraying the product, both in terms of discovery and retention? And I really think that the best consumer brands know how to quantify and qualify a customer journey from there. You know, far too often, especially over the last 5 years, there was so much focus towards LTV to CAC ratios, the lifetime value to, you know, cost of acquiring customer ratio, which is important. But the problem is that that's all focused towards marketing. And if you don't really identify your brand and recognize your brand, is it, if it's a product or it's manufacturing products, and we'll stick with brands for now, versus infrastructure startups. If you don't recognize like what kind of product you're selling, is it a product that it becomes a necessity type thing where you're getting a consistent reorder and a consistent return rate, return customer ratio, versus one that, you know, you're not going to be purchasing a significant period of time. Let's call it a mattress, for example. How are you then also changing that journey, right? How are you leaning on your customers on more as customers versus ambassadors and vice versa? Like it's again, that level of balancing a quantification and a qualification by sales and qualification by ambassadorship. And so the most general way for me to describe about like understanding foundational growth is that consistent evolution that I'm expecting founders to really understand and grow their businesses with. And there are ways that we do it internally with our own models, whether it's doing everything between liquidity ratio analysis, sensitivity analysis on the financial side of things, and really just finding ways to break the model from there, but also looking for the different X factors of the people themselves who are building these businesses. Like, are you coming from this space directly? Have you done just a crazy amount of homework and done a lot of deeper research to it, right? Do you have people within your advisory board who aren't just advisors in name only, they actually are dedicated to the space? What are your kind of secret weapons or weapons that do exist from here? And there's a lot of different functions and features that you have to think inside and outside the boxes for.
Yeah.
So
great. And moving on from that, well, staying closely, but moving on, we know how important an emotional connection is for consumers of the Apple products, for example, right? But how important is establishing an emotional connection with customers in an early stage of a brand's development? Is that as important as, for example, what you were saying, quantifying and qualifying, or would you put that more important, the same, or less important in that regards?
I think it's part of that journey to experience it, because it's less about also quantifying and qualifying on that, which of course is one of the core pieces to it, but it's also evolving with your customer, right? I think about a dartboard where you have concentric circles growing out from there, right? Your first round of customers, whether it's beta or, you know, paying customers, free customers, whatever they are in that first level, those are the ones you're starting to work with and learn from them over time. Get as much feedback, get as much knowledge from them, and learning from them in terms of, you know, what's working, what could be better, what would you like to see, and also what would be things that you would like to see that you would also like empower you to recommend the brands to others, right? And I'd love dartboard. Obviously, those circles are all, you know, equidistant lengths and widths from there, but more often than not, sometimes those circles can either grow more small or grow even larger, from maybe due to a viral campaign or something that basically just creates so much of a credible effect of new and, you know, returning and new customers from that end. So for me, it's more about how are you also learning from them, right? What are you doing to learn from them? How are you also empowering your customers on that? I mean, think about the most basic adage out there: the customer is always right. And I am surprised that especially again over these last 5 to 7 years, that a lot of the mindset was just throwing a lot of money on marketing and almost forcing brands down people's throats. Obviously, that's changed a lot. You're seeing a massive reset in the market from it, and back to really what happened in the early 2010s, where it was more foundational growth, building good, strong businesses, like focusing on the foundation of the house versus building basically an inverted pyramid that is going to fall at some point. But it was very much about just growing, right? Like you can build the most beautiful store in your eyes and think everything is perfect there. But if you put it out there and you open the doors and no one shows up, right, your business is going to fail.
Yeah, absolutely. And I think this comes on to my next question, which is customer feedback is essentially what you're talking about, right? Listening to your customers, listening to what they want, what they, anyways, all of that, right? But what strategies do you recommend for brands to effectively incorporate that? Because sometimes I know that the old adage of the customer is always right, but if you listen to everyone, then it might not work out well. So how do you pick the good from the bad, right? And what strategies would you recommend for brands to incorporate into their consumer feedback for growth?
Yeah. So you want to get the right kind of feedback, but you want to set the right kind of limits, right? You want to ask the most targeted questions that you can get through, where it's like, what do we think about the brand, right? What could be better? What could be, what do you really enjoy? And almost having specific options that would go from it, right? Whether it's in terms of product assortment, whether it's in terms of marketing campaigns, whether it's in terms of, just the resonation, like the connection that you have to the brand, like, is there, like, it feels like you're truly marketing as the customer. And ultimately, right, what is going to empower you to want to actually talk more about the brand directly from it. And that's also a system where you're learning from them directly, but you're also using the other tools, whether it is through social, whether it is through, just sales data, and giving people an opportunity to create a profile and start adding and growing from there. If there's a brand I think that does the best of all the startup world, and obviously it is significantly large these days, but their ability to encourage people to create a profile, to start saving things even for favorites, even if they don't buy anything when they go walk on their stores or even online, it's a very natural opportunity for people just to start like building a whole journey with them. And that company to me is Warby Parker. You go into their site or you go into their store, you just start with as simple as an email address and start being able to save products, start enable things. And as soon as like maybe you've like 3 or 4 pairs of glasses in the stores, they'll be like, great, we've marked them into your favorites, we've added them into your profile, and you'll get an email basically from them. And you start slowly building out that journey. But it's not an invasive journey. It's more of just like, hey, here are the things that we know that you've liked. It's up to you in terms of whether you want to complete from them, and you will get added, of course, to the mailing list. But as your purchase history, your favorites history, your other things on profile grow over time, the mailing list and things will get tailored over time to it, right? Also just encouraging where it's like, look, we also have things that are just complementary between eye exams and sunglasses and contacts, and just making sure that you can just have everything in one place and done it with 2 taps. I give Warby a lot of credit being able to do that. And they've come to a point where, their store traffic for square foot is one of the highest of all major retailers. Like, I think it's like second to Apple in terms of it. Now, again, is everyone going to buy in that square footage immediately from there? No, but it's a sense of brand awareness that just works really well. Now, how can a smaller startup do that, right? It is that level of building those kinds of surveys and things, and just like learning and just building as much of a deeper connection from the founder themselves, right? Whether it is as simple as writing thank you letters, sending emails out directly. It's like, hey, it's Sumit, the founder of, so-and-so company. Would just love to, thank you for buying the product, blah, blah, blah. Like, here's a call to action that does exist from that end. And it seems trivial at times, but I think it's just the more open that you can build a brand to someone, especially in the day and age when like some of these much, much, much larger brands are trying to find ways to get into people, and it just feels very cold and forced. There's a bigger opportunity where it's like, if your product does change, a person in some sort of way, they're going to definitely want to share that with you, because they will recognize, like, ultimately you're a small business and you're a small business owner. And there's much more of a deeper connection that can read to there.
Yeah. So effectively, at least, I deal in my role, I deal with a lot of B2B companies, right? So, and still the value of storytelling is so important, even though it might not be that important maybe for their B2B customers, but even from an raising investment perspective, that storytelling attribute is extremely important. And from what you're saying, it sounds like that's also the case with customers.
100%. But also, because you focus on B2B, that doesn't mean customer service and customer experience, right, can be thrown on the wayside. I think that's actually an issue that many B2B founders and investors, but especially founders, seem to forget. I mean, I take Slack, for example. Technically, Slack is a B2B company, right? It's a messaging platform and a communications platform for major businesses. And if you're not post-contract, let's say NASA, for example, if you're not consistently checking in and making sure that they're actually enjoying the product and utilizing the product from there, and if they run into issues and you're actually handling the feedback, handling the issues, and versus just like writing it off as a contract, there's a higher propensity for abandonment, and from that abandonment could lead to either the canceling of the contract prematurely or just not renewing it whatsoever. And that, yes, storytelling and that experience, of course, to land customers and close contracts is important, but it's always that post-contract experience that also matters. And I think that's why I in the past I've had B2B investors and founders being like, I mean, I could never do consumer. Like, people are just so volatile, and consumer trend lines and everything are just so hard to track. And I'm like, yeah, it's true, but that doesn't mean it doesn't exist in your business as well, right? And if you're just relying on like getting a bunch of contracts and you're just kind of locking it as a quantitative perspective, you're forgetting the qualitative side of things, because again, these customers are growing with you.
Absolutely. And coming to the because B2B and B2C, I think, a lot, I reckon, I don't know, right? But I think B2B founders, a lot of them think that the B2C market is extremely saturated, right? So I think that's something I want to get on to with you. And so in a market saturated with new brands and products all the time, what advice do you have for brands to capture those in that initial consumer attention?
Yeah. It kind of goes back to learning what's the problem you're trying to solve with your products or your technology or your platform from it. And when you are able to almost be laser focused on the kind of solutions you're providing and how they're actually targeting, and you're learning from your customers about like if that solution first off even makes sense, let alone the fact that you have the right tools and things to actually address those solutions, address the problems and provide those solutions. Like that's such the most important thing above everything else. Because from there, right, that first wave, that first circle of customers will help you determine, right, potential or current, if you're going in that right direction from there. And as you're building those pieces to it, especially again, just focusing on the world of brands, you also have to come to the terms that you're not going to be really taking a significant market share with your business, right? That the competitive dynamics that exist within your industry, recognizing ultimately like if the bigger players are going to use you as a tool to learn and to evolve quickly. Like in the early 2010s, when the Warby Parkers of the world came out against the Luxotticas of the world, or that the Harrys came out against the Gillettes of the world, they had the ability to build business models in spaces that were very acceptable and very like highly excitable by consumers. And a lot of these major companies were caught off guard, and for them to innovate and evolve from there was almost like the equivalent of turning around an aircraft carrier. So I look a lot at in the last 5-6 years where some of these other brands, admittedly more lifestyle brand type items that launched, they didn't recognize the fact that like a lot of their competition were able to actually learn and evolve and grow much more quickly and expedite that from it, and especially from what they had learned from the direct consumer boom. And that's fine and all. And it's as a result, like you've seen a lot of either like very low sale prices for some of these companies, maybe some of them going bankrupt, and otherwise just like trying to figure out how to keep the companies going when they've raised way too high valuations. And we'll see what happens to a lot of those companies. But what I think is really imperative to it is that to any founder that's out there, you don't have to be wildly successful sales-wise you don't have to be wildly successful on the sales side of things to actually call yourself a successful company. Like you could end up building a business that could be $1 to $2 million in top line revenue, profitable, or maybe get a small net loss from there. Like that is success in its own metric to that, right? But ultimately, that's also depending on how you grow your business. If you do take the right kind of outside investing, because that's the whole another conversation. If you do go down that route, because of the fact that you will get the outside pressure from an equity investor who also admittedly has a fiduciary duty to his investors. I mean, I'm saying that as a venture capitalist, right? Like, you don't have to take VC dollars to grow your business and you're comfortable with the way it's growing, don't take our money. Unless you see an opportunity that makes a lot of sense to grow together.
Makes sense. And look, based on, just based on, if we look at what you posted on your website in December 2023, the fact that you've invested in X amount, I think it's 12 companies, is that right? Yeah.
Yeah.
Based on just that, and I'm sure you have a lot more experience and your observations are quite wide ranging, what emerging trends in consumer behavior do you believe will impact brand strategies in the next few years?
Yeah, so I'll focus on the trends and strategies that we're focusing on in the world of both in brands and infrastructure. With brands, I'm focusing a lot towards the future of healthy nostalgia, and also who are making the next heritage brands onto that end. With the infrastructure side, I'm really spending a lot of time on companies that are looking to empower the creator economy, in terms of just how are you actually giving some of these influencers the next ways to really build sustainable businesses, but also just ones that are just actually tackling I call it the infrastructure boom, and I'll get into that in a second, what that means. So let's talk about the first one when it's healthy nostalgia. It's pretty straightforward. What you're seeing is that you think about a primary and a secondary discovery for people, right? Primarily when it comes to food and beverage, it's either going to be better for you options to it or ones that just also are going to taste delicious. And far too often over the past number of years, it was always very focused on primary being better for you, with the secondary being oh, it also tastes good. And more often than not, you're seeing just a lot of customers are just look, I'm being overwhelmed by a lot of the better for you products and things. But the concept of nostalgia, especially with this younger generation, that's really tapping into, honestly, my childhood, childhood of the 90s, when you're building products that also create that sense of nostalgia, eating or you're drinking some of these things that really brought joy to your, maybe it might not be the healthiest from there, but it's as a surprise, it's a delicious, incredible product for you. It might be good for you or better for you, but also it's something where you don't have to worry about creating an obsession around, whether it's something like the Poppies or Ollipops of the world and the prebiotic sodas of the world, to the company we invested in called Peaceful Fruits in the fruit snack space, the tackling the fruit by the foots and fruit roll-ups of the world, to Fronen, which is a non-dairy ice cream using coconut cream, builds less of a worry in terms of the unhealthiness of ice cream in general, and giving an opportunity to still create that obsession and build on that obsession. It is such a powerful thing. I think it's only just going to get stronger and better, especially as you're now starting to see a lot of the major CPG conglomerates focusing on building their own. So that's the first. Second, when it comes to heritage brands, but thinking about a brand that's really having a 20 to 30 year both sales and ambassadorship life cycle for people. And there's two kind of directions for this, and they primarily focus in the health, beauty, wellness worlds, where I'm seeing a product that someone is going to be using maybe early in their, I was focusing maybe on a post-collegiate woman, 25 to 40, that has discovered this product and just really just has it as part of her routine. And this is something where you expect her to use, she's going to be using for the next, again, 20, 30 years. So that's one. And the other is, I call it a multi-generational opportunity. So one product I'm looking at in the hair care space, it is primarily focused on that post-collegiate woman, both in terms of for travel, for fitness purposes, for medical purposes, in terms of post-procedure, post-operation. But it's also a product that they can see as these women become mothers, and they have daughters, where they can use it for their daughter's hair as well. And that's something where, just again, it's a multi-generational perspective, where it's like a natural tie-on, and as that young kid grows, that she also potentially will be a future customer consistently from it, and just keeps growing on from there. So that's the two. Going to the infrastructure side, on the creator economy, empowering from them, is you've got incredible influencers that are building just their own personal brands to it, right? And the fact that even younger generations want to be an influencer as a job, and it's obviously incredibly unsustainable right now, right? Like, you think about affiliate revenue, which is unsustainable for actually building a real life and future from there. It's a nice side gig, but it's not sustainable from it. And then you have various equity partnerships that have existed for some companies, but that is also admittedly not sustainable, because not everyone is also on the same page. And so it's more like, why can't you build the infrastructure between supply chain, manufacturing, full like start to finish round of services for some of these influencers, especially if they've focused in spaces, or like part of their product line or category or sector is just part of their calling card per se. And so how are you seeing companies that are just building all those as well? So product studios that are focusing on like the home goods or CPG or food and beverage walls from there, I'm always keeping an eye out for. We invest, we're looking at one of them right now, and closing on it. So there's that. And then trying to remember right. Thank you. So I talked about that there's a direct-to-consumer boom in the early 2010s. In the late 2010s, you had this lifestyle brand boom, where you had a lot of unsophisticated investors in consumer coming in and kind of pushing money towards marketing, throwing on the wall, seeing what sticks. And both of these booms were really focused towards tackling antiquated industries, antiquated sectors and spaces. And in the direct-to-consumer boom, the antiquated industries took quite some time to evolve. In the lifestyle brand boom, most of those competitions evolved very quickly. In infrastructure, when you ask, a lot of major consumer brands, or even smaller ones, they run into such walls where it comes to selling in retail, managing their whole business model strategy, supply chain inventory, logistics, etc., dealing with just like very expensive options or brokers and just general walls that they have to like come over and cross or like pay to play almost. And so you're starting to see more of these tech-enabled platforms that are tackling these things and making just more affordable and sustainable and scalable options for these brands. Whether it's a company that's helping consumer brands to find offline retailers or find the right retail opportunities and get same-store sales, a company we invest in. Another one that's focusing on building out a massive third-party logistics network for all kinds of brands, including perishable, if you sell on Amazon. So truly giving a real reason to sell on Amazon, company we're looking at. Companies that are focusing on the world of consumer insights, looking at competitive dynamics from there as well, just like giving these different tools that are helping them grow and exist from that platform. So, it's very much admittedly stream by stream that you're seeing. And those are really the four that we're at least focusing on for the VHS side of things. Again, two within infrastructure and two within brands.
You said that's the four that you are focusing on. Those are four big categories to focus on. So best of luck with those as well. And look, I've picked out a couple things here. First of all, when it comes to that creator economy, right? So I want to understand what your thoughts are on the evolving role of influencer marketing in building and sustaining brand resonance, right? What are your thoughts on that? Where do you see it going? As you said, some of it's unsustainable in terms of, I think I read a report recently where the majority, not the majority, but the largest group of people coming into university, they're the top one is wanting to become an influencer, right?
Yeah.
So how, first of all, do you make it sustainable, in your opinion? And how do brands use that for brand resonance?
Yeah. To make it sustainable, you have to find businesses that actually care about the power of influencer marketing, because there's two sides to it, right? It's building the right brands that actually are giving some of these influencers like, look, you want to take this as a full-time opportunity. Either you can work with us to find marketplaces of brands that you want to sponsor and work through there as well. And there are a lot of great companies that focus on that. Or you build the whole tools where it's like, if you want to actually launch a product, you can work with us to grow and build those over time. Now, that's also a relationship-driven business on it, meaning that, let's say you're a product studio that builds out everything in the home goods world, and influencer X has been really a big person within the space and is like ready to launch her own line of products. Like, great, partner with this business and you work with us, but our contract first starts for the first year. It's like, great, we can launch a few kind of products, and you also have to focus on using your marketing tools and everything to sell it from there. Like, we'll help with the first levels of pieces to make sure to get you off that ground and help make sure that we'll cover some of those things. And if the relationship's good, right, and if it's sustainable in terms of like it creates great sales and creates great prominence and something that they're actually also dedicated to versus just like, oh, I want to do this on the side, if that kind of relationship is that sustainable, that's great. That becomes a long term. If it's not, then it's an opportunity to amicably end the relationship from there. And so it's also a level where it's like you can't just 100% cater to an influencer, because if you are, you're paying to play ultimately from that, and you're running the danger of them just also admittedly like fading interest in the end of it. Like, it might just again be the new flavor of the day for it. And it's not against these. It's not to say that I'm against the influencers that are focusing on it. It's more to be the right business minds, right? It's far too often some of these incredible creators don't have the right business strategies on it, and it's that kind of just relationship and connection and bond that needs to exist ultimately from there. And it's also, right, going back to influencers directly, where it's like you have to recognize and be realistic about how difficult and unsustainable in general the opportunity to doing it as a career is. I mean, there's a data point that I read a while back that I think it was like 35 to 40% of YouTube influencers live below the poverty line. And it's one of those pieces where it's just like, look, all for it if you want to try and test this out. But as my parents raised me on this, is you don't half-ass anything. If you truly are passionate about something, like, spend the time. If you've lost the passion, break apart. Like, stop like just kind of dawdling and dilly-dallying into it. So I think it's all relationship driven to make it. Like, you truly are dedicated to this space. That's great. And the partners that can also help you grow, you'll find them, and they're continuing to grow and rise. And I'm looking for those to admittedly invest in. But it's also that kind of relationship that has to be a two-way street.
Absolutely. I think, coming to one of your points about you have to want it, you have to work for it. I think we live in such a world, at least younger generations, where you're fed content of this is quick ways to make money, right? I know it's happened throughout history, but I think right now it's because of social media, because of all of this. But then you look at people who are really making it. At least one example is Mr. Beast on YouTube, right? He's been doing this for 14 years, and he only made his first million about 3 years ago. Stuff like that, he spent 11 years working at this. But anyways, look, with regards to strategies for brand resonance in a promiscuous market, and I'll get to what I mean by that. So in an era where consumers, especially Gen Zs and millennials, are increasingly open to trying new brands, what strategies do you believe are most effective for brands to resonate deeply with their audience beyond the product itself?
Yeah. So I give a lot of credit to Gen Z and Gen Alpha in that, because they're so digitally connected, basically born with smartphones in their hands, that they are also not just, of course, open to trying new brands, they're also doing a lot of their own research from there. Now, admittedly, there's a lot of misinformation that exists in this current state and age, but they're getting a lot of their information from the world of social, primarily from the TikToks and Instagram Reels of the world. What I think is really important for a brand to recognize that is, like, first off, recognize, like, what's the kind of what are the kind of talking points, or what are actually the kinds of conversations that those generations are having about your brand or your products directly. If there's a product that truly is just incredibly sticky to it, learn from it and lean on them and grow it as an opportunity where it's like, okay, if it's a door to opening up your entire brand and just seeing like what that kind of journey grows from it, it's incredible. I mean, I would say that Glossier does an incredible job, whether it's product by product, sector by sector, area by area, that they're learning from these customers. And
Yeah.
I will give the company a lot of credit to even when it started with Emily at the helm to even now, where it's a whole different team, that the communities that they build out within their stores and within online, and what teens talk about and teens talk about with the brand, it's that sense of like obsession that it creates. And it's not so much about fun, about fueling the obsession to it, but it's learning from it and be like, this is awesome. Let's figure out then like how can we not just of course turn the spotlight on y'all and share also like what people get excited about it, but like just grow with it, right? Grow with them. And it's just so interesting where on one hand you get, again, the Glossiers of the world, like focusing on there, and then you get the other side of it. And I've been talking to so many friends in the beauty world about this, where these teens and tweens are so excited about going to the Sephoras at the mall after school. And that was like during my childhood when Sephora was basically created, and that was the destination, because it was a completely different experience for us in that it was all of these beauty brands that we had never really seen before that were at a store, and we were all enjoying it, but also gave you an opportunity to even have like a Clark Kent Superman effect where you can come in, get some makeup done, get some like touch-ups and everything, and come out feeling like a different person. That's surprisingly very popular during prom season. But I look at that kind of return to this world, the way, again, tweens and teens, and Sephora is no longer that kind of brand. It's very much more of like a convenience-driven store on it, because it has so many beauty brands that exist. But I also see them at their evolving, like we have to make sure we're getting the right new brands that they want to see offline and being able to enjoy and take on, the Rhodes of the world, the Ceremonias of the world, and selling them in our stores, but also having it as part of their experiences, again, for makeup and community events and whatnot. And then you look at, on top of it, brands like Drunk Elephant that have been around for such a long time, and all of a sudden are getting this like whole new customer away from it. It's the double whammy where it's like you're going to Sephora specifically to get Drunk Elephant, and Drunk Elephant's now admittedly like openly welcoming these new sets of customers. It's like, hey, welcome in. Like let's learn more about you, and let's teach you about like what we're doing. And I'm excited to see brands that, again, they're opening those doors from it, because I also think about going back to the early 2010s, when e-commerce and direct consumer were starting to grow, the luxury retail world, the luxury brands, shut off all of that. They're just like, no, people should want to go into a beautiful store and check out the things. I'm like, sure, store traffic could be really high, but you're also spending so much on overhead. You're spending so much on these beautiful, beautiful spaces. And so even if you get 100 people coming in, or one or two of them that are buying something, that's not an incredibly solid ROI. It's just really disappointing that it exists that way.
Yeah, and look, there's two things. Sephora, it's funny you mentioned that, right? And it's also quite surprising. Look, I've been in the state. I went to the States for a couple of years ago, so I'm not really the target demographic for Sephora. But when it opened in the UK, so it opened in London 2 years ago, I believe, their first store. And my group of friends and their target demographics, they were so excited by the prospect of that. It kind of made, some people I know would go after work and hang out there. And they're not school kids, they're a bit older. So I think that brand was very strong then, if you mentioned that was the case when you were younger. But yeah, talking about luxury brands, I think, as you mentioned, maybe in the 2010s, it's not that they kind of missed that direct-to-consumer train. But then when you look at it today, with the rise of digital experiences, I would say they're some of the leaders in that space. When you look at like Tommy Hilfiger and Fortnite, or perhaps Gucci World and stuff like this. So this leads to a question: with digital platforms such as Roblox and Fortnite becoming new arenas for consumer engagement, how do you think brands should and can leverage these spaces to create memorable experiences that resonate with their audience?
So first off, to address your first piece in terms of how luxury brands have definitely been on the forefront from it. I mean, they've also evolved, right? Like for a long time, at first, they just wrote off the whole thing where it's like, if we're gonna have anything on a digital store, it's like it's almost gonna be impossible to buy anything on there. It's just gonna be almost like artwork. But then you start seeing a lot of them that were like, okay, maybe we should just consider having like a right e-commerce partner from that. That's why Ukes started becoming the backend provider and building out actual sustainable like sales channels online for these brands directly. Then you saw them starting to build stuff in house and everything. Ukes merges with Net-a-Porter to become Ukes Net-a-Porter. That sells to Farfetch and so on and so forth. Or actually, I don't remember if it's sold or not. Regardless, doesn't matter. So they've evolved, right? They recognize that over time. It's like, look, we finally are starting to listen to our customer, because not just for the fact that we need to, it's like our declining sales channels and things are just dying from there. When you think about just other various tools that larger brands can actually start tapping into, like the Robloxes and whatnots of the world, it's, again, you don't want to fall into the trap of like seeing just what sticks and just like throwing things around. Again, it just goes back to learning from your customer of like what are the things that they're actually excited about, and also like what they would like to see their products on. And if you're going to do something where maybe you want to test something like putting together an ability to drop, let's say if you're a clothing brand and you have the opportunity to drop your stuff on for your avatar in Fortnite, great. Like if you actually are dedicated to this, like, and you've done the research back end from their customers to be like, would you totally buy this if you were a Fortnite, player and get this? And it's like, I love the best example for me is that Travis Scott and Nike and Jordan brand partnering with Fortnite, where it's like, hey, one of the most, sought after shoes, the Travis Scott Jordan 1, you have an opportunity, to purchase at like a fraction of the cost compared to resale, that you can put it on your avatar. It's like, oh my God, like I actually feel like I've got this pair now, right? That's some sort of like desire and want from there. And I think that was just something that was very cool, where it's like, it was just one thing from there. It exploded into ultimately a partnership that they built out with like even building out a whole Fortnite concert with Travis Scott and everything. I think it's also those things where, again, you learn from your customers, right? You learn from them in terms of like what works and what they're excited about. And that to me is like, I'm not going to recommend any specific areas for brands on there. But like, if you can also lark within your ethos of like, what are the kinds of things that really resonate to people, as well as, what are the kinds of places where they're spending their time? And then you just lean on them to be like, would you want to see something like this? Like trying to take as much as you can in terms of learning before, to test and learn, if that makes sense.
Yeah, no, that makes sense. And look, conscious of time, because I could spend all day speaking about this. It's definitely extremely interesting. So I'll have a couple more questions. And one of the ones, and the EU passed a law today on something around or recently about greenwashing. I don't know what it was. I just saw it on the Financial Times, something about greenwashing. So from what you've seen, your experience, what are the keys to communicating a brand's sustainability efforts authentically, right, to build resonance and trust with customers, ensuring it's maybe more than just a marketing tactic?
Yeah, it's a good question. I mean, above everything else, if you're going to be doing any sort of initiative from it, don't make it feel like you're checking off a box. Like, whatever you're doing in the world of sustainability, how does that actually apply to your business model and ultimately your brand ethos? So I look at a company like Cotopaxi. It's an outdoor gear brand. They are a certified B Corp company. They have a double bottom line, meaning they have their net income, and then they have, with some other sustainable measures and donations and outreaches, and then they have the second, net income bottom line that they mark. And that's always been part of their ethos. You know, when they even started as the business, they're like, almost was a 1-for-1, like buy this product, buy this backpack, you know, portion of proceeds get provided for water, you know, for charity water, buy this water bottle, it provides an ability to build a well from this. And that was great and all, but it was also very specific and targeted in terms of like actions. And so then they changed the model to where it's like, you know what, we're gonna focus on building out a foundational atmosphere to it, where like our part of our profits are going to go towards it with every year, and that's part of our model from there. They also launched a amazing race type system called Gestaval, which was a mixture between outdoor activities but also volunteering and giving back. And that was something where it resonated so much with customers, regardless of how much you also bought from Cotopaxi, but it was just part of the brand's ethos that existed to it. And that's something that always existed from it to now, the fact that like it raises a significant amount of venture capital, but it also sold to a private equity firm, Bain Capital, but specifically their ESG division of Bain Capital, because they also like, this is literally part of the business itself. And so if you are going to do anything that is going to be focusing on sustainability, whether it's in terms of manufacturing, whether it's in terms of giving back, whether it's in terms of like the nonprofit side of things, you know, it's about also what kind of story you tell, the reasons behind doing it.
Yeah.
And if it makes sense that you're doing it, like in terms of the focuses, then that's great. Like I'm excited to see like more that's happening from there. But you know, people are very aware as to cutting through the BS of companies, and like maybe it's just like, again, they're trying to score a couple points, and maybe it's something that they could be easily just launched from it. Like customers are going to press on you on there too. And so I care very deeply about making sure it actually, I guess it really means it's genuine, it's authentic. And I hate that authenticity is kind of thrown around like a buzzword, but it's still so important. Like you have to take that time and make sure that what you're doing actually like truly resonates with people. So
absolutely, it's part of my view of it, my limited view of it. It's part of building a brand, right? And a brand building exercise does not take a day. It's not just a marketing post you put out. It needs to be your ethos, and it needs to be how you operate. At least that's how I see it. But look, considering the time, I just want to kind of ask question about VHS. Where are you guys now? Where are you going? You've just done your first fund. Is there plans for a second fund? So yeah, it would be great to know more about that.
You know, again, like we closed out 2023 with about a dozen companies or so, and we're working on closing a few more. And we're trying to make a few more commitments basically before the summer. Around that summer, we'll probably put a temporary lid on fund one and focus on just like current portfolio and stuff. We'll probably go out to raise a second fund next year. You know, the next year or two, really. The fundraising climate is quite interesting, to say the least. But what I'm just really excited about is this is a very full circle moment for me. I'd always wanted to build something of my own in this space, especially after spending so much time helping others and contributing to just creating these incredible organizations and helping them grow, you know, and going through the best and worst of times with them. But it's also just an industry in a space that I am very deeply passionate about, because it's the kind of joy and surprise and delight and everything that you're seeing in the world of consumer. And it is a very difficult industry in the fact that like people's choices and preferences are of course volatile. But what I think is just exciting for me is that I get to work with a lot of my old friends I've known over the past decade, 15 years or so. And my goal is just to make VHS one of the cornerstone investors. Like our check sizes are definitely going to be significantly larger in future funds, but it's more about like really being able to help these incredible people, business owners, grow sustainably and in a real scalable fashion, and give them the real opportunities of their own destinies. Like instead of just like raising crazy amounts of money, raising crazy amounts of valuations, and basically kneecapping yourselves, you know, how do how do you build real futures, I guess.
Absolutely. Well, thanks for that. And for investors interested in the consumer brand space, maybe how can they get involved with you? Or I know maybe Fund 2 is not for a bit longer, but still, how can they start getting that conversation going?
Of course, they can definitely reach out to me by email. It's Sumeet, SUMEET, at vhs.vc. Website's just vhs.vc as well. It has all the information about our thesis, our portfolio, our board of advisors that we launched last year, incredible experts and veterans within the consumer world who come help with our deal sourcing, analysis, and portfolio companies, and as well as just easy opportunity to reach out. I'm also relatively still active on the social world, on Twitter, at PE Feeds, PE_FEEDS, and otherwise I'm pretty active all over the place. So always happy to work and meet incredible people.
Fantastic. And yeah, what I'll do is also put, I think you have that DocSend document about the thesis of your fund. I can put that in the description. And yeah, if anyone wants to get in touch or find out more, they can go via there. Last question. I ask this to every speaker. Maybe let's stick to three key components for a company looking to build foundational growth, going back to that 2010 piece that you were talking about.
Yeah. Growing with your customers, consistently keeping your periscope up, like you're building your business and you're almost having a periscope in a submarine up. So what you're doing with your business, that you're also keeping an eye out in terms of if it makes the most sense. And a level of eternal curiosity. You're keeping an eye out on what's going on with the trends, not just, of course, within your business in the sector, but just in general. Like, those are the kinds of people, to me, that are the most successful kinds of leaders.
I love it. Well, look, Sumeet, it's been an absolute pleasure. Thank you very much for joining us today.
Thank you so much, Hugo. It's been a pleasure.
What if you could simplify your capital raising? CRIISP Capital HQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Hi, everybody. So my name is Dan Huber. I'm based here in Zurich, Switzerland. I run a single family office for the last 20 years. Before that, I have been in the financial market, active with a company. Some of you might remember www.oanda.com. Was one of the companies I was involved at that time. Early 2000, I started as a family office investor. And besides my background, I'd like to give you a little bit of an introduction to one of our latest investment. It's called ADNA, Authenticated DNA of Companies, which is hopefully not only solving a problem we had in our family office, but maybe some of your investors or family office people that are watching this, as well as startups or SME companies, can basically identify themselves with it. So we tried to solve this problem actually quite early in 2010, 11, 12, but it didn't really work. And then with the arrival of blockchain, we really thought it would be time for another try to establish what we basically call a permanent pre-due diligence data room, which serves startups, SMEs, as well as the whole investor community. So we position ourselves as a platform that helps to solve some corporate governance and compliance issues. And what we're trying to solve, or have solved actually with a running platform, already exists in other industries for many years. So for example, in the airline industry, every airplane has a black box. Why? Because the airline manufacturer, as well as the airline itself, wants to know what happened during a flight with the pilot, with the condition outside the plane, with the plane itself. Similar in the modern electrical cars or any cars today, you have an accident chip, which records everything that happens to the car, to the driver, etc. And quite similar to this, we as investors have always had a problem with startups knocking on our door and basically asking us for an investment. And then we said, yeah, could be a match. Let's give us some high-level documentation. And of course, we waited for 3 days or 3 weeks sometimes until we finally got something, because data rooms are usually incomplete, both at the startup level, but also some SMEs never have their data ready. And of course, if you've ever been involved in an operational position, you know it's quite time-consuming at the time that somebody knocks on your door and says, oh, cool, what you have done here in the last couple of years, we want to buy your company. And the stress for the management team starts. And last but not least, documents need to be authenticated, meaning C-level people need to prove that they have the real thing uploaded and approved. All the documents are signed. And of course, that leads to this traceability and verification that we think, in a nutshell, leads to one thing that in today's investment world is so important after all these FTX cases and others that we have had to witness: trust. And trust you receive if you have authenticated data and create what we call a full data integrity, thus achieving a high level of trust. So our life cycle, of course, is very simple: shareholder agreements, perpetual integrity, physical assets. On the startup side, usually very rarely exists. So startups have usually a few documents, but then, of course, as a startup, you are planning to grow into an SME company. And over the years, more and more of the documents arrive, and really important contracts and new CVs of management people, loan agreements with banks, etc., which eventually, after 5 years, 10 years, sometimes 20 years, leads into something that might be an M&A transaction or handing over your company to the next generation. And this is basically also demanding that the whole history, or the whole DNA, as we call it, is always ready and authenticated. How we do this, very quickly, before I show you the product live, is of course, somebody uploads a document, either an internal or an external document, and somebody else in the management team approves it. On very important documents, maybe even the board of directors approval is needed. We have a concept of external key partner verification. We could be your fiduciary company, your lawyer, or even a board member could take this role. And last but not least, currently, since last year, we are hashing all of our clients' data room once a month on currently 2 or 3 blockchain layers. We're just expanding our blockchain offering because it's not our data room, it's our client's data room, and some have a preference for this layer 1 blockchain, some have a preference to other blockchain layers. So I stop my pitching here very quickly, and I'd like to show you now the full screen of our product. So very simply, we have here the actual year that we're in. We are collecting something that we call the key folders on these different topics. Here we are quite stubborn. We say every company has to have that. A lot more flexibility is, of course, already done here on the corporate folders. I would say the first 6, 7, 8 folders of our technologies is quite common in most of our clients' customer or data room. As you can see here, for example, if something is missing that you really need, the administrator can upload that. Last but not least, if, for example, somebody like me, it's set up as an owner in this company, wants to have his private stuff as well, he can add that. It's not a must-have, but he can do that. As you can see, we are working in the previous pitch. You saw that little color scheme. So, of course, the goal is to have everything in dark green, which is the sign for completeness. I'll show you here, for example, an example of 2021 on our own ADNA data room. So walk the talk. We're using this for our own purposes. And as you can see, everything is fully completed, approved. For example, if I go in this year into the corporate folder, a small tutorial comes here. And I, for example, want to see our chartered documents. I can open this. And basically, I can see here that these up here on the upper right-hand corner, I can see that these are the people that have been approving this particular document at the time it was uploaded. And I can see when they have done it, etc. If I still have today a comment to this document, I can do this here. So this is in a nutshell how we do it. And a good example here, for example, why is the tax folder, even for the year 2021, not fully completed or dark green? Well, because even in very efficient Switzerland, we haven't received a tax audit for the year from the Swiss government, nor have we had the social security audit of our company and all its employees. So this basically, in a nutshell, is what we do. As administrator, of course, I have very simple things. I can look at all of my history so that, for example, in this presentation today, I have viewed a document, creates a log. Since I'm an administrator in this company, I can see how many gigabytes of data we already been using. And just to give you an indication here, our data room has been totally completed for more than 4.5 years. And we're using 1.6 gigabytes of a total of 5 gigabytes that we have on the cloud. I can define very simply who in our data room has which rights. So I can set up different people internally. I can also invite other people, like investors, that might be interested from the wholesale investor community to view certain things. So I can give them access to it. I can set up my own customer roles if we haven't matched that. I can see, of course, who are the active users. I can also have inactive users. So if a CEO or a CFO eventually leaves the company, I can set him to inactive or her. And last but not least, I can define what and who can see what in particular folders on my system. So this basically in a nutshell is what we do. Of course, the system does give me some indication if I have to do something. So, for example, a new document, our pitch document was uploaded by one of our co-workers here, Urs. And now I'm being asked to approve this document. And while I'm in the live demonstration, I quickly do this with you. So this is actually a pretty large document. So it will take a second or two to upload. And basically, you see here this pitching document that I'm going to be switching back in a second. And since I know it's the right one that Urs, my colleague, has uploaded, I'm going to approve this and say, yes, it is the right version. So basically, I'm doing this approval now. It gives me a confirmation that I have approved it. I have no pendings anymore, so I'm basically done and can return now to whatever else I'm doing. Updating our own data room as it is today, it needs the whole management team at ADNA anywhere between 15 to 20 minutes a month, because it's not your expense reports or something that you upload into ADNA or into your ADNA. It is really just the very, very important elements. So very quickly now, switching back to my pitching information. What we do and how we do it, you have seen now on the product demonstration in the live mode. Of course, the process of how we do it is company owners and executive people as well as board members have a very important role. External parties that are interested in this authenticated DNA stuff is, of course, either on the banking side, on the auditing side, lawyers as well as investors, eventually corporate buyers, and key partners basically monitor from an external position a little bit that the company is really updating the right stuff in the right order, in the right format. Our marketing positioning is that, of course, we want to become the company's single source of truth, which then eventually can serve all kinds of different external as well as internal bodies and organizations to make sure that what you're handing over to these people is the final and actual version and the latest version that you have. Some of the founders, quickly, I'm coming more from an investor venture capital background. Donny Bernard is our CTO. Urs is a guy who runs a large M&A boutique here in Switzerland. And our president of the board, Urs Rechsteiner, is a lawyer. Last but not least, everything that you've seen now is also since December of last year available on mobile. The ADNA version on iPhone is released and actively used by startup companies as well as SME companies that we have. And we are working currently on the Android version. So this should be released next month. So that basically is in a nutshell what we do. And I hope you found that interesting. If you're a startup, definitely a suggestion from an investor point of view, do this because it could be very helpful in your pitching to investors, showing them a little bit of, let's call it good governance and compliance. And investors usually like that you have, even you're just 6 months or a year old, you have your company and everything within your company a little bit in good order. With this, I'm basically concluding my pitching as well as my live presentation.
Hi, Daniel. Thank you very much for that.
Hi, Hugo.
It's really cool. I think I think we're going to dive deeper into ADNA. Maybe the name behind it would be very good to understand. Compliance, the evolution of it in digital finance, and when a company is compliant, its impact on the efficiency in moving in the capital markets. But before we get into that, I'd love to talk a bit more about your personal journey. I know you've talked about it, but could you maybe take us through your journey so far?
Yeah, I mean, as I said earlier, I wanted to solve with ADNA a pain point we had in our own family office, and this was at the time of the investment. We were waiting for documents. Finally, we got some documents, and then we wanted to make sure that at the time when we transfer the 500,000 over to the startup company or sometimes even SME companies, we wanted to have a clear hash, a clear freeze on the documents that we were given. Okay. And already at that early stage, this kind of hashing the data room on public blockchain at the day you're transferring the money is a protection for me as an investor, but as well as a protection for the management team of the startup or SME company, because it's both ways. They can prove to me what documents they have given me for my due diligence work, and I can prove that I had these documents or I didn't. In classical M&A technology elements nowadays, you do this on encrypted USB sticks and et cetera, et cetera. So we wanted to have this a little bit more of a dynamic, making sure that both sides understand that this is the material that we had for the due diligence. The second part was, I don't want to do micromanagement in investments that we're involved in, but I want from time to time see how the company is doing. And with ADNA then starting to turn into a platform where I can monitor a little bit, how well updated they have done their things is very nicely. And the very nice thing about what I like, things in the ADNA are always at the same place. So I don't have to look at the Dropbox structure that I don't understand. I don't have to look at the SharePoint structure that I don't understand. It's always at the same place. So the shareholder agreement is always there. The financial information is always there. And I know it because it's in every company the same.
Makes sense.
Almost the same.
Almost, but yeah, I mean, the structure is pretty straightforward, especially by the looks of the demo. And look, going from what have been your challenges so far moving from an investor to a CEO?
Not
learnings, maybe not challenges, learnings would be more.
I think it's good sometimes as an investor to jump back into the CEO role, because it really shows, how many loose strings you have to tie together, how you have to make sure that your investors, in my sense, my family, of course, is happy about the reporting and sees that we're making progress and that we are, hiring the right people and taking the right steps and, do the minutes and do the board minutes and the management minutes and publish them and et cetera, et cetera. So I think it is a good exercise for all kinds of investors, or particularly in my case, to sometimes jump back into the driver's seat, which is not what I'm planning to do for the next 5 years within ADNA. But I think helping this company from an operational point of view was a good exercise and a good learning point for me again, and hopefully helps my investment questions and style as well.
For sure. And look, moving on to ADNA at a very high level, we'll go a bit more in depth later on. How do you differentiate yourself from other data management solutions in the market?
I think the big differentiating is that we are tying documents to people, irrevocable. Thus making sure that, people understand establishing a company or managing a company in a C-level position brings a lot of fun and a lot of work, but also brings some responsibilities towards yourself, towards your co-C-level people, towards your board, and last but not least, towards your investors and the society. Because, driving a car today needs a license. In Switzerland, in Australia, in the UK, everywhere, I'm not saying that establishing a company should require a license, but I think people have to understand, starting a startup is not only fun. It brings some real important responsibilities with it as well,
Absolutely. And look, now let's moving on to the evolution of compliance in digital finance. I know you were recently reflecting on your panel participation at the World Economic Forum in Davos recently. What is your perspective on the current state of compliance?
I think from a legal point of view, there's a lot of compliance rules in place in various jurisdictions. Some go overboard with their compliance requirements. Some keep it very minimum. But in general, I think people should view compliance as part of establishing a company, like benchmarks. So whatever jurisdiction you're in, you don't have to be a lawyer to understand every little detail of compliance, but you have to apply common sense to your compliance measures and to your compliance steps that you're taking in the company. And I think the best would be to say, okay, what kind of compliance elements would I love to see from a company that I'm maybe not in the C-level management team reporting to me, So in a nutshell, I would say we have enough compliance rules and we have enough possibilities to control from a legal point of view what governments or tax people want to see. But you got to do it. I mean, and that's the point. You're gonna have to once in a while sit down and go by the rule. Whatever your jurisdiction you're coming from is requiring your company to basically have as a compliant element. And in a nutshell, it's not that much. But as a CFO usually, or as a CEO combined with the CFO, once a month, you should spend at least 1 or 2 hours on those compliance issues. Because if you don't do it and you always postpone these things to, I don't know, end of the year, and then end of the year is very busy and blah, 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 they're never going to do it. And so that's why we have a technology platform like ADNA. Technology helps you to push. And it's not something that you immediately have to do now on the 31st or tomorrow on the 1st. But the system, the software pushes you every month to do certain things. Because otherwise, the color starts going from dark green to orange to red. And if your board members see certain areas red, they're probably going to call you and say, guys, what happened?
For sure. It's a good point. And can you talk a bit about the name? How did you come up with it?
Very simple. We looked at what we did and we said, yeah, we're collecting the DNA of companies. And we're authenticating authenticating and hashing this particular data. So the name was actually very simple. We're named after what we're doing, and basically, as you have maybe seen at the last slide in my presentation, it's your company authenticated. That's it.
Simple.
I like simplicity. And of course, scalability and simplicity is usually a good match.
Yeah, absolutely.
For a startup.
And look, coming back to a compliant company, what is the impact that a compliant company has on multiple things, right? But the first one is on, for example, let's assume a company is raising a Series A, right? What's the impact of having a compliant deal room, due diligence materials on perhaps fundraising?
Very simple. No stress for the operational people. I mean, if you have your data, everything compliant and ready and testified, anyone knocking on your door or anyone really starting heavy due diligence, you have it. And it really, I have a very good friend here in Switzerland. He sold quite a prominent software company in the financial market a year and a half ago. And he said, Dan, what you're showing me here, we would have needed 2 years ago, because our whole management team was going at 5 o'clock in the morning into the head office to do exactly what you're showing me. And then, of course, from 8 o'clock in the morning till the rest of the day, we had to, still run the company. So if you do this while you are starting and growing your company into 1 year, 2 years, 3 years, and look, and this is very honest, one of the reasons why we started ADNA as well, how many startups have we seen in our life that 4 founders were knocking on our doors and we gave them some money? Then eventually, after 6 months or 12 months, from the 4 founders, 2 have left. For various reasons. And you want to make sure, even if you're a little bit more mature SME company and you have a management team and suddenly somebody out of the management team is leaving the company, or you want to fire this person from a board perspective, you want to be in a capable position to do that. So compliance to me has again a lot of elements that are found in trust, because the company has all its DNA ready for whatever purposes there might be. Like you said, next financing round. Maybe there is some merger discussions eventually happen between two parties who know each other already for quite some time. There is maybe a bank who wants to grant you a substantial loan and is interested in really looking into your DNA, seeing that you're not hiding anything from them. And that all equals to trust.
Yeah. Core. It's the core. It's the core of a business, external and internal. Great. And look, could you maybe elaborate a bit about the technology behind ADNA? I know it mentions blockchain. Can you maybe talk a bit about that?
Yeah. As I said in my entry statement, we tried to build ADNA a couple of years ago on Web 2.0. And we spent a couple of $100,000 into that project, and then I think like 2011, 2012, we realized it's not working. The stickiness was missing. When we were introduced to blockchain technology, summer 2017, we realized that this blockchain DLT technology is what we were missing. Cryptocurrencies, and of course, that's not something I want to talk about, but the basic DLT blockchain layer was very, very convincing to us because it has this decentralization aspect and it has this irrevocability, which we think is very key to not only what we're doing, but a lot of other things that people are doing on the foundation of blockchain technology. So I think for us it was a real game changer because we really believe in I think somebody very high up in IBM once said what the internet did to communication, blockchain is going to do to transactions.
Yeah.
And I think it was the CEO of IBM who said that. I forgot her name or his name. No, I think it was a woman, her name. And I really believe in that. I think in a couple of years, we will see a lot more transactional elements that have its foundation on blockchain. So for our purpose, it's not only a marketing thing that we, as I said, just last year started to add, but it has a very high impact on what we're doing, because the next thing we are just in progress of doing based on blockchain is starting to NFT, non-fungible tokenize, our clients' most valuable assets. So it might be a patent, it might be a source code, it might be machinery that you have. And we want that our clients have them again ready for whatever purposes they need it eventually in a digital form. And NFT, in that sense, is a perfect solution for that.
Yeah.
NFT hasn't been around when we started in 2018, So I think the whole evolution that everything around blockchain is taking is very good for the purposes that we're planning to do in the long run of ADNA. This NFT technology that is now been around for 2-3 years has, I think, really matured that we can start now integrating that, as well as the hashing.
Can you maybe talk a bit about some examples that you see the NFT side of ADNA taking in the future?
Yeah, I mean, a very simple example could, for example, be if an investor comes to us and on our next financing round says, okay, guys, I don't know, I give you 2 million on X valuation or XX valuation, but I need security. I want additional security. So by that time, we probably have our whole source code in an NFT. Now, of course, lots of people who listen to this or watch this, they will say, yeah, but the source code without the team is not much, But still, just as an example, you could NFT a source code, and basically pledge that for whatever grant or loan or investment you do. Or so, for example, a machinery company that gets a loan from a bank, and the bank says, "Look, you're not a quoted company. We need additional security. So maybe You own the manufacturing building that you're currently manufacturing. And then you can NFT that real estate and basically pledge that NFT against a loan. And the nice thing out of that, of course, is again entrepreneurial driven. You are starting to create your own track record on loans, because those 15 NFTs that you have given out maybe for your building, after 3 years or after 5 years, they come back into your credit folder that we will then have at that time in our ADNA setup. We currently don't have it. So I think it is really something that, I had a presentation the other day where ESG was a big topic. And of course, we have an ESG folder in our data room. And I met a CEO who said, Dan, I really like what you do here, because I sometimes have people who, are questioning, are we really doing what we're saying we're doing on the ESG side, And here I have an irrevocable, authenticated, fully approved C-level management, board management people, data document, which basically shows that we have done what we have talked about. So I think the NFT side will become, especially during the active life of a company, quite interesting in the sense that, it helps you to be more dynamic when somebody on the investor side, on the public side, maybe questioning your ESG activity, you need to prove that you have done what you said, or you have what you have,
I think, we kind of spoke about this, not on this call, but if a company goes bust, using the NFT side, creditors can actually come in and just take that. So I'd love for you to talk about that a bit.
Here you're touching on my second pain point, why I founded ADNA, or we founded ADNA. It's not only me. And my second pain point is clearly, as an investor, I'm not better and hopefully not worse than anyone else. I invest into 10 companies and 5 of them, they go bankrupt. Total loss. 3 of them basically left pocket, right pocket. They don't return much. They don't even pay for our time. And 1 or 2 make it all up. Okay. That's fine. So probably most investors that listen to this, they will agree that that's the life of an investor or a VC. And my problem with those 5 that go out of business is not that they go out. Of course, we lose money, total loss. But the problem I had or still have is I'm confronted what here in the European market is called an insolvency manager. Usually a person coming, or always coming, mostly coming from the government side. And of course, these people don't understand what kind of assets are still available in this company. And insolvency laws, at least here in Europe, they're quite clear and regulated, and you have to do what you have to do. But if certain assets, and those really important assets, are already in an NFT, you could basically much, much quicker put those NFTs onto a marketplace and say, guys, here's a company 20 kilometers south of Stuttgart with these kind of assets, maybe 2 or 3, that has gone out of business. Who in this world is interested in buying that? And an NFT then, of course, is testified as really still existing. So this machine is sitting down here on the on my ground, and it is physically still here. So making sure that NFTs aren't being sold 3 or 4 times, because with digitalization of NFTs, that could be something that some people would try to do. And last but not least, it is helping the government to efficient, or hopefully more efficient, and hopefully also more profitable run down companies that, go out of business. Which, by the way, just to give you an example, is a huge market. In Germany alone, 35 billion euro every year, repeating, go down. Of course, there's a lot of coffee shops and hairdressers and things, but they are companies with real interesting assets. Maybe not for somebody in Germany or Switzerland, but maybe somebody in Mexico has a need for this 10 or 15-year-old machine. And if he knows that this machine is available, he might buy it because he sits up on a lot of cash, which he hasn't invested in Mexico directly. You know? So this is but here we're clear. I mean, even though we are talking to some recovery departments of larger banks, which, usually have quite a lot of companies that are not in so great shape in their recovery department. But we know this second pain point will not be solved immediately. It probably will take another 2 or 3 years until we can really then start creating this marketplace for distressed sometimes or insolvent assets. You know, and I've talked to some of my friends in the hedge fund business or distress business in the States, and they say, yeah, this is cool. This is cool. And one of my best friends said, Ben, this is so typical that it comes out of Switzerland because, and I think he said that. Otherwise, I will say, Switzerland used to be the world champion in recycling. You know, We're recycling papers and PETs and PET material and lots of other things. And he basically said, yeah, well, why don't we try to recycle companies? And we're fully down to earth with our feet on this topic. I mean, lots of companies that go to insolvent, there's no asset whatsoever that should be recycled.
Makes sense. And look, the platform obviously holds a lot of sensitive documents, right, from these companies. What measures do you take to ensure data security and privacy?
Of course, very much. I could show you a graph on that if you like. Just to illustrate that quickly, let me quickly switch back. So, of course, very good point and very important point. We basically go out of business in no time if we don't make sure that documents are safe. And so we basically double encrypt every single document that is uploaded. First, we virus check it, then we encrypt it. We're just adding a technology that you can erase names, blackout names or things that you don't want to be shown on a document. And what is important, the security code or the key generating technology sits on your side, not on our side, it sits on your side. And the double encryption eventually leads to the point that if somebody really ever is able to break into your data room, he sees not the structure, he sees a whole bunch of encrypted documents. And as soon as he or she tries to pick one, he probably might be able to pick one, but then the alarm goes off and he is not sure if he picked the rent contract from your company or he picked the shareholder agreement. He doesn't know because he can't see it. So from a technology point of view, of course, we have applied whatever today is possibly available to make sure that your data is very, very safe, because as you said correctly, we are not collecting guinea pigs of your company. We are really collecting the really, really important stuff. And by the way, I had a client from Germany the other day who said, then, you know, our general accounting and documents and co-working documents that we're using on various other platforms sits here in this ERP system from SAP, and my DNA data sits somewhere else. I find this as a diversification of risk. If we can talk about portfolio management strategies as a diversification of risk, already that is a good point. Because he tells me he's being hacked on his SAP system twice a month, 3 times a month. You know,
that's a lot.
It's a big company, by the way.
Yeah, and look, you know, you've earlier this year. Well, we're only 1 month in, but you've released an app, mobile app. What was the thinking behind that? Most of these B2B softwares are usually web-based. So what was the thinking behind it?
Two things. I think since we are rolling out our technology or our platform, especially into the startup scene through incubators in various countries that find our, let's call it, good governance and compliance elements quite useful and supported by a technology for their incubation programs. So because of the startup scene that we are usually seeing as clients, mobile app is a must-have for that generation. And the second point is also for investors or board members that are traveling, that are moving around, and sometimes sit for an hour and a half in traffic jams or at the airport, and they have a little bit of time to look at their companies, either as a board member or as an investor. So it's both. It is the young generation want to have these things in a mobile app, and the more gray hair oriented guys, it's convenience. It's convenience. Yeah. I think it has also a practical application that, when you're moving around, even as a CEO, and you're sitting with your investor and he says, I need to see the last, the last document, you have it on your mobile. You can basically open it on your mobile on the fly. So it's both generation, technology-oriented younger people on the startup scene, but then convenience for anyone else involved with a company or a startup.
Makes sense. And look, a couple more questions. I'm aware of time, but how do you envision the future of digital compliance and its impact on global finance?
Good question. Since I'm not a lawyer, I think I'm not really qualified to answer this in detail. I can just say from an operational point of view as well as from an investor point of view, I think we need to make sure that all of us play by the rules much more. We need to avoid these FTX or whatever cases or Credit Suisse. I'm sitting in Switzerland, Credit Suisse as an example. And particularly board members and particularly investors have to understand that these compliance as well as corporate governance elements are on the to-do list in their job description, at least here in Switzerland. And so I think we will have, an increase in awareness, both on the financial world, including banks, as well as board members, as well as private equity or venture capital investors, that due diligence doesn't stop on the day that you transfer the money. You need to continue watching and watching closely.
Right. Well, look, that's all we have time for today, Daniel, but it's been an absolute pleasure. Thank you very much for joining us today. And for anyone interested in finding out more about ADNA or Daniel, there's several links below or in the description that you can find, including how to get in touch with them. But thank you very much, Daniel.
Thank you very much, and I'm looking forward to work much closer with the Wholesale investor team, as well as your whole platform, which I find a very good contribution. Hopefully, we can also add a little bit of contribution to your business success.
Thank you, Daniel.
What if you could simplify your capital raising? CRIISP CapitalHQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors, where your capital raising is working 24/7 for you. Are you ready to raise smarter?
Hello, everyone. I'm Maria Halaz, and I'm the CEO of Stride Equity, a venture-backed equity crowdfunding platform. Welcome to this presentation on how to utilize venture capital and equity crowdfunding for accelerated growth. I want to thank Wholesale investors and CapitalHQ for the opportunity to provide this presentation to you. Before I start talking about the utilization of these different options, I just wanted to flag quickly what are the potential options for funding at each stage of your company's development cycle. And of course, the really early stage, the pre-seed stage, the first option is to bootstrap or self-fund, following which you might get the 3 Fs, the family, friends, and fools investing in your business. And of course, at that stage, if you are advanced enough, if you can convince angel investors or other external funding options, syndicates, then it may also be an option for you. At the seed stage of development, certainly venture capital, equity crowdfunding, and also angel investors become options for you. In terms of Series A, which is a more advanced stage of your company, you would have a market fit and the ability to really show that you can grow and scale, and you have revenues and potentially even profits. At that point, venture capital and equity crowdfunding remain really good options. Whilst at the latter stage, which is Series B and Series C and beyond, venture capital, private equity, of course, remain very important options to fund your business. And of course, you might want to consider an initial public offering or a listing on a capital market. So in terms of the money that has been invested in Australia at different stages last year, and prior 3 years, you can see that the majority of the money has gone into the Series A and Series B investments in companies. And whilst angel, pre-seed, and seed investments are much lower, they do represent a solid amount. And of course, these companies would require lower capital injection in any event. Last year, we've seen the venture market shrink from more than $7 million to about $3.5 billion. That has been invested across 413 deals by our funds. And of course, that's a 54% drop from the 2022 levels. The market has become slightly more competitive. Almost half of the investors felt that the pre-seed and seed stage deals became more competitive, but only 19% of investors felt that the Series A and B deals were more competitive. However, with the IPO option not really being available and a lot of built up capital in the funds, Series C deals became also less competitive. Angel investing is the first option, of course, when you start looking at what are my potential options to fund my business. And whilst it's not a consistent and easy to find group of people, there are many, many angel investor syndicates that are out there in Australia and overseas today, and they're growing consistently. In fact, over 330,000 angel investors invested in Australia so far, and there's a strong rise that you can observe over the last 10 years. In particular, under 40-year-olds. So that's a generation that is really started investing. As the number of technology companies started proliferating, you see the interest of this generation in those companies has been intensifying. And a lot of these investors feel that in the coming years, they want to remain investing, remain on the market and investing. So it's a really good opportunity for you especially if you've got an earlier stage company to go and seek out. One of the points that is important to make is that angel investors don't just invest by themselves as high net worth investors or in groups or syndicates, but they might invest together with venture capital groups, or they might invest through equity crowdfunding platforms. This slide is up to 2022. We don't have an updated information on that, and you can see it's a little bit up and down as far as the applications, a number of applications for angel investment is concerned, and that's mostly around probably the unavailability of reliable data. However, the applications are pretty consistent, and the funds invested are pretty consistent from an angel investor source. When you look at the landscape, and these are just some examples of the angel investor syndicates that you can find. It's very, very easy to find them. You go to their platform, you look at their offering, you see the conditions and terms of how much it costs you to raise money through an angel syndicate, and then you can make a decision very easily. These are quite transparent groups that you can approach for funding. The next opportunity for funding is crowdfunding. In Australia, you can look at donation-based, which is really not issuing equity for anyone. It's really, you might have a very special humanitarian project you want to raise money for, and that is a donation-based crowdfunding. There's a rewards-based crowdfunding option, and that is if you want a very specific, exciting new product and you offer that product or a discount on that new product once it's available to your investors, then that's a reward-based crowdfunding. And of course, the most common and highly regulated form of crowdfunding is equity crowdfunding. To get to equity crowdfunding, you really have to be pretty certain that you've got a defendable product, service, or platform. You demonstrated early product market fit, that you already know where your customers are, who they are, what the economic numbers are, what is your business model, what is your pricing by and large, and what works on your market. And most importantly, you really have to have your legals sorted. Your company needs to have a constitution. You need to be in a position to be able to issue shares for your new investors. So what is equity crowdfunding? It really is accessing investment, equity investment from retail investors. So it's not different to angel investment or even a VC investment. The difference is that you've got more investors because the individual investment by these investors is usually lower amount. So instead of the venture capital putting $500,000 or $2 million into your company, we're looking at retail investors who can put up to $10,000 individually into your company. You can raise up to $5 million annually through equity crowdfunding, and that can be a standalone investment, or if you really want to boost your growth and you're going to need more investment, it's a great opportunity to syndicate equity crowdfunding with angel investors or VCs and really put a larger pool of capital together. It's really important that you prepare a strong disclosure document, and the ASIC regulates equity crowdfunding, and there are licensed platforms that can conduct these offer campaigns, and the disclosure requirements are quite significant in as far as your business, your financials, and your prospects and your risks, and how to mitigate risks are concerned. Very importantly, when you raise money through equity crowdfunding, you're going to become exempt from the usual limitations of 20 shareholders for a private company or 50 shareholders. And so your ability to take 200, 300, 400 investors into the pool and still operate as a private company is there. The only restriction is that if you raise more than $3 million, you do have to audit the company once a year. Equity crowdfunding has become quite significant in terms of how very early stage companies raise their funding. And in fact, every year in the last 3 years, it leveled out, whilst, as we saw before, both angel investment and venture capital has slightly dropped back. Of course, venture capital dropped back significantly, like 54%. but equity crowdfunding seems to be quite stable. There is a pool of investors who continue to be interested in quality offerings. So equity crowdfunding intermediaries raised around just under $300 million for early stage companies since 2018, when the first licenses have been issued by ESIC. So the industry is very young. There's much more growth and opportunities there to access that pool of investors through equity crowdfunding. And in fact, if the government really will go ahead and makes the requirements for wholesale investors significantly stricter, equity crowdfunding is an option to access those investors that will fall out of the wholesale investor, sophisticated investor basket in the future. Those investors will still be available to invest in your business through equity crowdfunding. Currently, we're looking at just over 100,000 people in Australia actively investing through crowdfunding platforms. And you know, when you compare that to the close to 10 million ASX investors, retail investors, then there's quite clearly a huge gap, and there is an opportunity to grow that number significantly with quality offers. And in fact, you know, to be successful, you increasingly have to be well organized, more advanced in your business, really well structured, and have product market fit, have a solid management team and board, and really show execution capability in your business. There's also an alternative equity crowdfunding model, which is the Stride equity model. We are a venture-backed equity crowdfunding platform. What this means is either we invest through our own funds, or we provide cornerstone investment prior to an investee company going onto the equity crowdfunding platform for an investment from retail investors. Normally, when we see a company, and the vast majority of companies don't go through the process successfully, we do due diligence. To us, it's really, really important to show execution capability. So we need strong management and founders. Obviously, a great idea is great, but there's many, many great ideas out there, and strong execution is the key to business success. Very often you see businesses pivoting from one idea to the other. Doesn't mean they're not going to be successful. However, if the management or the directors are not able to deliver, then nothing will save a good idea. So to us, that's very important. Once the companies go through our due diligence process, we either secure cornerstone investment or invest ourselves, and we put essentially a campaign through our platform, our licensed platform. Initially, it's in the form of an expression of interest campaign where retail investors can show how much they're prepared to invest in your business, following which we go into an offer campaign. At that point, an information memorandum is a proper disclosure document is provided to retail investors. In the crowdfunding landscape, you see a number of companies. There's about 14 or 15 licenses that are out there today. We see 6 to 7 players that are active in the market, and they're all very, very different. So before you engage with an equity crowdfunding platform to raise capital, it's a good idea to look at what their characteristics are, what their focus is, whether it's industry type of investment or the investor base that they're talking to. And now we talk about venture funding, and venture funding can be early or late stage, and also venture debt, which is becoming increasingly important to access for companies that are not able to secure venture capital, but perhaps are at that stage of growth where they can show strong revenue and perhaps even profitability. So we've noted that venture capital has fallen from 7.4 billion to 3.5 billion between 2022 and 2023, and the deals also fell significantly. I think the existing investee companies had a lot of pressure last year to become more efficient. The investments that have been made at a lower valuation, and of course, they were probably smaller than anticipated by companies. So their investee companies have been under significant pressure to make themselves or get themselves closer to profitability. And I think this will continue to be a focus for venture funds when they look at a company. How close are they to profitability? Now, last year has been slightly traumatic, and as we all witnessed some of the failures, 40% of the VCs reported that they've had failures, and 90% of the investors witnessed layoffs within their portfolios. However, the good news is that investors expect deal pricing to stabilize this year, according to Fulcro Ventures report, which is the reference for most of the numbers that I'm quoting in this report. So this is just the venture capital raised over the different years. And in 2022, we had a big anomaly. About $1 billion was raised by Blackbird at the very end of the year. Otherwise, as we can see, barring a few really bullish years, we can see that there is a leveling out of the raising of this money as well. And that just is reflective of the institutional investors' appetite for very high risk long-term investments. This is really just a summary of what we've discussed. I think what's important to understand is that there is probably an overestimation of the dry powder that is in VCs. Although they're really keen to invest and they've got money to invest, they also have very hungry investee companies that will continue to need funding as they reach their various value inflection points. Concurrently, IPO activity remains sluggish. Last year, there were only 45 companies IPO'd as opposed to around 120 the previous year. And so we're really seeing a quite conservative IPO market, again, until the macro environment is changing and becomes more positive. This is unlikely to change. So there is a significant demand on existing VC funding. And whilst the number of VC funds are raising external capital, these are smaller amounts and certainly not in the billion range that could make a significant difference to growth companies. Very important to note venture debt. And this is an area that many people tapped into, many companies tapped into. This is money that comes in the form of a loan. You really need to have revenue and ideally profitable or close to profitability, and you have to repay that cost. This is a shorter form of funding, 3 to 4 years, as opposed to venture capital, which is 10 plus years in most cases. In 2022, there was a record year for debt funding as it is a very attractive non-dilutive way of capital raising. And this is just the venture debt amounts. And as you can see, 2022, 2023, they leveled out. And of course, it's a really interesting way to fund growth when you're very specific about your numbers, where you really know the market and you secured customers. So that's definitely there for companies that really just want to scale into a specific market or grow in a very targeted way. 74% of VCs, in fact, reported that their portfolio companies took on venture debt last year, and 5% of the surveyed startups have taken on venture debt in an early stage of their development. This is the venture capital landscape, and of course, Blackbird, Airtree, and SquarePeg are the 3 large funds. Tractor Ventures provides venture debt, and I understand they're currently raising further funding. So this is definitely a source of funding that people should be looking at. And when we look at corporate venture capital, it's really companies like Telstra Venture or funds like Telstra Ventures that can look at any stage of investee companies so long as you fall into their investment criteria. So I want to thank you for your your attention today. I also want to thank again Wholesale Investors and CapitalHQ for having me to present on options on how to fund your company into growth and scaling. My name is Maria Halas, and my contact details are on the screen. You can reach me on my email, halas@strideequity.com.au, or on phone if you have any questions. Thank you again. Bye-bye.
Capital raising is not an event. It's a process. Navigating the labyrinth world of capital raising is not just frustrating. It's a time-consuming diversion from your core business, an emotional roller coaster that leaves many founders drained. But what if you could simplify the journey? CRIISP Capital HQ is your beacon in this complex landscape. Benefit from our proprietary network of 33,000 plus investors and deal makers, further amplified by AI/ML matchmaking. Extend your reach globally with access to over 200,000 angels, VCs, and family offices. Our intelligent deal rooms and streamlined tool suite can cut your capital raising time by up to 80%. But we don't stop there. Our platform equips you with capital raising intelligence to increase your conversion rate with investors. At CRIISP Capital HQ, we turn the daunting marathon of capital raising into a strategic sprint, where your capital raising is working 24/7 for you. Are you ready to run smarter?